Good morning, everyone. I will now call the hearing to order. I would like to begin by acknowledging that we are in Treaty 1 territory and the traditional homeland of the Métis Nation. This morning, I will be chairing the hearing. My name is Robert Hutchings. On my direct left is Ms. Billinghurst. On my far left is Mr. Laurendeau. Representing the City of Winnipeg Assessment and Taxation Department is Mr. Pohl, and our secretary today is Ms. Neepen. We will be hearing applications for revision of the assessment roll in accordance with the Municipal Assessment Act. The matters for which revision is requested have been described in each application, and we will limit discussion to those matters. The statements that applicants or the assessor make at this hearing are sworn testimony, and anyone speaking to the matters must be sworn in. Be advised that comparisons of assessments of properties are not considered evidence of market value by this Board of Revision. The Board of Revision is appointed annually by council and is independent of it and the city administration. It makes its decisions on the basis of the evidence provided at this hearing and issues a written order that will be mailed to all parties as soon as possible. Please note that the board's decisions with respect to an application may be appealed to the Manitoba Municipal Board if the matter pertains to assessed value or classification, or the Court of Queen's Bench if the matter pertains to the application of exemptions from taxation. Should you wish to appeal, information on how to do so will be included with the board's order. With respect to the hearing process, I will confirm the matters to be addressed with each applicant. Following the swearing in, we will then have the assessor's testimony, followed by questions that the applicant may have, and then the applicant's testimony followed by questions. Each side will have an opportunity to summarize if they wish. Once all the evidence about an application has been brought forward, the applicant may leave. The process will repeat for each item on the docket today. The session will close after all the applications have been heard, and the board will deliberate in private and make its decisions. You will receive the order by registered mail as soon as possible. As information, all public hearings are recorded and will be part of the public record. And can everybody please make sure that their cell phones are on complete silence before we begin. Okay, good morning, Mr. Pohl, Mr. Reimer. Michelle, could you swear in the applicant and the assessor, please?
Can you state your full name, please?
Jeremy Wright.
Do you swear that the evidence you're about to give at this hearing should be the truth, the whole truth, and nothing but the truth, so help you God? Can you state your full name, please? Do you affirm that the evidence you're about to give at this hearing should be the truth, the whole truth, and nothing but the truth? So help you God.
Okay, first property on the docket is 447 Portage Avenue, and we're dealing with a 2020 realty assessment. And I note, Mr. Pohl, that there's a request for increased value on the property?
Correct.
Okay, when you're ready, please.
We all have the increased letter on the first page. File number is 194896. Roll number is 130525500000. The original assessment for 2020 was $67,260,000. I'm making a request for increase to $75,183,000, and I'll get to that change in a moment. The building was built in 1987, so 20 stories. It's approximately 268,953 square feet of leasable area. There is 185 parking stalls indoor. All that has been confirmed at municipal board level, so we're good on parking stall counts and areas. On page 3 is our workup for our OFA comparables. For 247,000 square feet of inventory reviewed leading up to the reference date, we have an average of $18.44 a square foot, a weighted average of $18.53 a square foot, and a median of $18. So it's a very tight range. On page 4 is the Cushman-Wakefield's Q1, highlighted in yellow is the CBD Class A buildings. We have an average net rental rate of $19.93 a square foot. On page 5 are comparables for parking. Comparable number 10 highlighted in yellow, is the subject property, stabilized at approximately $130 a stall. So, move over to the parking income, it's on page 6. We're using our downtown net stall rate of $138 per stall on about 185 stalls, which gives us NOI of $306,360, capped at 7%, gives us our $4,377,000 for the parking income stream. On the next page, on page 7, is the original workup. The original workup at a rental rate of $16.38 a square foot. That is simply too low for an OFA, a newer OFA built in 1987. After review the marketplace, the $16 rent is not appropriate, it should be increased. On the following page is our revised workup. The revised workup uses the weighted average of $18.33 a square foot, or 268,952 square feet. That produces a potential rent of $4,929,890. With PGI, when our 7% for vacancy is taken into account, our effective gross income is $4,929,890. Bear with me. Can I get a calculator? Just wanted to- May I get 5 minutes just to correct this error?
Of course.
I have a vacancy that was changed. Bear with me.
While he's doing that, Mr. Chair, can I ask you a question?
Okay, I'll call the hearing back to order. Okay, Mr. Pohl.
I just needed to take a minute to make sure everything was correct.
Okay.
For the effective gross income, it reads $4,929,890. That is the potential rent. That's a mistake updated in the brief. The numerical values are correct. I run it on a separate spreadsheet. The effective gross income should read $4,584,798.
So we're talking on page 9?
Page 9 where it says effective gross income, just the vacancy was adjusted.
4,584,798. Well, that's what's there.
Mr. Chairman, I think Mr. Pohl is referring to page 8, not page
Oh.
9. On page 8 is where that typo.
Yeah, it's just a typo. The actual numerical value, the value at the end is okay, but it's just,
Oh, yeah, on the other page you got it right.
But all the
Yeah.
other math adds up.
yeah, we're not using the other Rachel. We're just continuing on with what we're recommending for the revised. It just, it didn't update, so I'm just correcting it. The actual value itself is still correct at the bottom end.
Okay.
I always do it independently in a separate spreadsheet. So, again, our expenses at 2%, our shortfall at $13 gives us a net operating income of $4,248,356,000. Capped at our 6% gives us our rounded value of $70,806,000. So, on page 9 is the summary of the two income streams. The summary of that is $75,183,000. So that's what we're recommending today. On page 10, our capitalization chart, top column, where it says property type on the left-hand side, downtown A is what we're using. We're using 6% for OFAs. Colliers is reporting between 5.5 and 6.25. CBRE is reporting between 5.5 and 6. Professional Whitfield between 5.5 and 6.25. We turn over to page 12. There's a picture of the property, a couple pictures of the property. I'm sure we all know where this building is. We've passed it many times. It's at the corner of Portage. So it's Investors Group there, it's owner occupied, so there is no rent. The parking is ran by Fort Knox Parking. Page 16 is the item that shows that. And a little bit of capitalization rate information that we have on page 1 of our addendum, which is just after page 16. If you go to page 1, we have 294 Portage, capitalization rate of 5.88%. That is an OC. And we have 177 Portage, capitalization rate at 6.35%. Again, another OFC in downtown. So those are the two buildings that sold that are reflectable. I mean, they're an OFC, but just indicating some of the capitalization rates that are low for downtown in this cycle. So with that, it's a pretty simple workup today. It's just simply that the rental rate drops. Our model predicted too low of a rental rate. We've adjusted that back into the market, and that's what the essence of the increase is for. But I won't be questions.
Thank you, Mr. Pohl. Mr. Reimer, any questions of the assessor?
Thanks, Mr. Chairman. I'm going to start. The brief that's in front of this board, there's been some confusion because there was actually, I believe, 2 applications filed originally. We filed one on behalf of Investors Group, who's the owner. And I believe Mr. Story, who's listed on this brief, filed one on behalf of, I'm assuming it's Story. So the file number, just to be clear, the file number that is on the docket and that I'm representing, is obviously 44740, but it's 19-3076. So if I could ask the board and Ms. Needham to reference 19-3076 and of course reference Altus Group as the agents for the applicant Investors who's shown as the owner on the tax bill. So that's just by way of administrative clean up a little bit. Okay, so Mr. Pohl. Oh, I'm sorry.
So just to let you know, I'm gonna just update your brief.
And I just did that on my
Okay.
as well, so I guess there's some confusion in the processing of everything, but that's okay. We're all good, I think we're all on the same page.
Full, could we, and to be clear, Mr. Chairman, to frame the discussion, we're not disputing the parkade value, so that's not, there's no issue on that. So it relates just to the office building, the office valuation. So Mr. Full, could I then ask you initially to turn to your page 7? So if I understood correctly, this is the original valuation that the department put on the office building, correct?
Correct.
Okay. Now, and this is derived from the mass appraisal model that the department had in place, correct?
Correct.
Okay, so the parameters from top to bottom, including that 1638 rent and down to 6%, that's all model driven?
Correct.
And the, for the rent, the model will look at various characteristics, one of them being that this is an OFA.
Yeah.
Another being the size of the premise, correct?
Yes.
And so the 1638 was the market rent that the model deemed to be appropriate for a premise the size of 268,952 square feet, correct?
Well, there would be no, it's a projection based on how the model works, but
Yep.
in relationship to a comparison to a CRU that size, we wouldn't have one quite that size.
Right,
So
right,
there'd
but-
be no way to accurately project.
But this is a multiple regression model, right?
Yeah.
So it's based on statistical, and the model runs this multiple regression analysis based on the statistics that have been fed into it.
Yeah.
And part of those statistics would relate to the class OFA rents that the department had gathered from anything as small as, say, less than 1,000 square feet up to whatever the largest tenancies would be. And if I'm understanding the multiple regression model correctly, the model then extrapolates a market rent in each case based on those parameters that's been given, correct?
Yeah, further away from the actual rent size that you have to get to where you are, it's not as reliable.
Okay, but you're agreeing that that would be the rent the model thought would be?
Yeah, exactly, that's right.
Okay, so then if we turn to page 3, so, now Ms. Paul, in the first two comps, number 1 and 2 on Graham Avenue, were you aware that this is a single lease covering the 2 units of 29,000 feet roughly?
Correct, but we're showing it how that shows it in the rent.
Yeah, understood, but we can agree that's one lease transaction for 29,000 feet.
Yeah.
And it's, I'm taking a very simple approach here, it's about 17 bucks a foot, maybe 17 and a little bit once you, okay? So we've got that one for 29,000 feet, and then moving to comp 28, that's another 20,000 foot unit for 1412. Correct?
Correct.
And then the comp 30, this is at 360 Main Street as well. Comp 30, 39,629 feet at 22 bucks.
Correct.
Now, were you aware that that lease, that was a lease renewal that involved TIs of over 30 bucks a foot on a 5-year term?
No, it was not.
Okay. So, and then at comp 29, that's again the 40,816 feet at 1738.
Yep.
Okay, so Mr. Pohl, when you take comps 1 and 2 treated as one lease, which is effectively what it is, bless you, and then you take comps 28 and 29, the average of those, if we take a simple average, and I'll work this through with you, but make sure I'm not mishandling the math here. So we treat comp 1 and 2 as a $17 rate, comp number 28 as a 14 and 12 cent rate, and comp number 29 at 17.38. If I divide that by 3, that comes in at $16.17. Would you agree with that math?
Yeah.
Okay. So the remainder of the comparables we can agree are all significantly less than 20,000 feet.
Correct.
Okay. What the department's position, though, is notwithstanding that those largest indicators and the model extrapolating this rent for a very large space, the department's chosen to just simply apply the weighted average shown at the bottom of page 3.
I'm sorry, I had this thing shut off. I get flipped the wrong way.
So,
Okay.
you see the red?
I see the red now.
Okay.
I see red too.
So going back to the question that I had been posing, on page 3, the weighted average of 1833, that's what the department's now applied to arrive at the new value, correct?
Yes.
Okay. So then, if we turn to your page 8 now, And thank you for correcting that math error, actually, or that.
Yeah, I did that double check.
Yeah,
Jumped out.
yeah, no, and I agree that, based on your calculation, I would agree that's the number that should be in place. So there's the 1833 that we just talked about, and then the department, though, has chosen not to apply the 5%, what was formerly known as the 5% management allowance, correct?
Correct.
And the 6% cap rate, again, that's a model-driven rate in this case.
Correct.
Right. And Mr. Poe, we can agree that this building was built as a single occupant.
Yeah, it's built for investors.
Yeah. And we can also agree, and I think you alluded to it briefly, but we're located here at the corner of, at the north side of Portage, at the corner of Portage and Colony, correct?
Correct.
Okay. Mr. Chairman, those are my questions. Thank you.
Thank you. Marla, any questions of the assessor?
No, I have no questions.
You? Marcel?
Only one on your page one of your cap rate evidence in the back. Which properties did you say were the two best?
No, what I'm saying, okay, sorry, that you're looking at the cap. On the back, page one, what I'm saying is, I reviewed these two properties for, I personally reviewed 294 Portage and 177 Lombard. Those are the two nearest properties that have sold to the subject. They are a lower class, but they're still reflectively getting around a 6% average of both out capitalization rate. So if we had OFAs that sold in the reference period or big enough, we would be able to make capitalization rate for them, but only a small pocket, so it's good they don't sell.
You used 177 and 294. Okay, that's good.
You bring in your best evidence that you can.
Yep.
It's not always, you'd like to get an OFA. It's not so.
I'm good.
Thanks, Marcel. Thank you. Okay, and I have no questions either. Thank you. Mr. Reimer, when you're ready, please.
Thanks, Mr. Chairman. So if I could ask initially if we could all grab the original brief.
Which brief?
The thick one with the brief with our evidence on it. It's got a total of 75 pages, I think.
Has the address on it.
Has the address and the phone number on it.
Okay.
All right. So,
Sorry, Lynn.
turning to page 2 of those materials, then the request this morning is to reduce the assessment from $67,216,000 to $58,150,000. That's assuming no change to the parkade value. The parkade, as I mentioned earlier, is not under debate this morning. So turning to then page 3, just the aerial shots, and one of the concerns we've got with respect to the department's, both the initial position or the initial assessment and certainly the position advanced this morning is that the department's classified it as a Class A building, and we're not disputing that classification as an A building, but we're certainly suggesting in no uncertain terms that this location is vastly inferior to the remainder of the Class A buildings. We're at the north side of Portage, at the corner of Portage and Colony. The skywalk that is there goes to Portage Place, and this is a building that's on the very, very periphery of the central business district, and that we're suggesting would certainly have an impact on the rental rate that would be achievable for the property. So moving on to, no dispute as to the characteristics as presented by Mr. Pohl, so I will skip right over to page 7, please. So the primary issue, there's three issues. The primary issue relates to the market rent, and the context in which this building was operated in the reference date was well put by the Cushman-Wakefield Q118 report for the Winnipeg office properties, and that's at the top of page 7, and they stated that the overall asking net rent in 2017 was 8% higher compared to 2016, but this is the key. With rents in Class B and C buildings, both in the central business district and the suburban market, driving the increase. Asking rates in Class A buildings have not followed suit, as these landlords are aggressively competing for new tenants and trying to retain existing ones. Another important element that is involved in the increasing occupancy costs are sizable increases in operating expenses and property taxes. These costs were 78 cents a foot higher in 2017 compared to 16, with the Class A buildings in the CBD generating the largest increase. So you've got two factors going on. You've got basically specifically the B and C buildings, the rents increasing while the Class A rents were remaining static, so there's a narrowing of the gap in the net rents that are being achieved in these various properties between the BCs and the As. And then on top of that, you've got an erosion of what would be achievable for Class A space because your occupancy costs are going up. So of course tenants, at the end of the day, tenants are paying net rent, but what they really care about is what's the gross rent they're paying, including the occupancy costs. So when the Class A occupancy costs are rising, which they are, and the Class A landlords are competing and operating in a very competitive environment because of True North and the different things that were going on, it causes certainly a difficult climate in which a building like this is operating, especially given the location of this property. So they go on to state in that report, landlords in the CBD will need to be aggressive as tenants pursue opportunities for superior quality space or more attractive leasing terms. The key factors in the decision-making process by tenants will be the leasehold improvement allowance and the commitment by landlords to undertake significant building upgrades. So extremely competitive environment, particularly so for the Class A offices. So it's in this environment that we're suggesting the office rates be considered. Now, at the time that I prepared these materials, I was basing my assumption of the assessor's valuation parameters based on the original, $16.38 a foot, which was the model ribbon rent, if you recall. That is higher again now, but certainly we're suggesting that the net rent should be no more for this property at this location and this size particularly should be no more than $15.50 a square foot. So what we've got at the bottom of page 7 is a chart of, and it's a mixture of OFAs and OFBs, and recall the statements of the Cushman report. The OFB rates are the ones that are coming up. The OFA rates are remaining static if the landlord is investing significant sums. So there's a narrowing of that gap, and more importantly, you've got an extremely large, you've got 268,000 feet here that to apply the market rent to. So I focused on larger tenancies in OFA and OFB buildings in the downtown area that were negotiated generally between 2014 and 2018 actually. As you can see on that chart, you've got the top one, and this is actually one of the same ones that Mr. Pohl had, the $22 square foot rate on a 5-year renewal. That's the one that I mentioned that I have been advised that the tenant improvement allowance for, and it was a renewal, so the TI that was put in to refresh the space was over $30 a foot. So there's a reason why this one seems particularly high and would not, of course with the subject property, we've got no kind of space with that kind of money being put into it with that kind of quality. So that would be well above the rate that would be achievable for the subject. Then moving down, you've got the OFBs, Portage Avenue, 35,700 feet at 1926, 19,500 feet roughly at 1750, 40,000 feet at 1738 in an OFA building on Main Street. Another OFA in Graham, 29,000 feet at $17. Smaller tenancy here, 15,741 at $17. Then you've got a larger one, 48,000 feet at $16. Another 24,091 feet at $15.75. Then you've got 20,000 feet at $14.12. 36,000 feet at $13.50, 76,100 feet at $12 for an OFB on Main Street, and then the two OFB rents on Carlton at for the larger tenancies, 120,000 feet at $11.50 and 36,000 feet at $10.50. Now it's important to note when you look at the effective ages of these properties, for instance, the building on Carlton has had very, very substantial work done to it, and there's a reason that the effective ages for all these properties are what they are, but in that one in particular. So I'm suggesting to this board that the best lease comparables are those that would certainly be north of 40,000 square feet, and even that, and I think Mr. Pohl's comments are fair, that the larger the tenancy you get relative to the lease transactions, it's difficult to predict, but economies of scales would certainly dictate that when you've got 268,000 feet in this single occupant building that you're trying to apply a market rent to, that would generate a rent at the, based on economies of scale, at the lower end of the range. Now our average, as you see there, is $15.65 for all of them, including that $22 outlier. The weighted average is $14.71 and the median is $16. Again, focusing on the larger tenancies here, we're suggesting for the subject to apply an overall rented rate of $15.50, which we believe is extremely fair in this context. So, moving on to page 8 now, there was one other transaction I didn't have in the chart because it was a little older again, and I was trying to stick with leases that were negotiated closer to the reference date. But in the middle of that page, I quote the example from the Great West Life lease in 444 St. Mary, which is another good quality Class B office. That was 111,000 feet. That started though in 2009, and it had a net rent of 9.25 a foot. But again, because of the older age of that lease transaction, I didn't have it in the chart. At the end of the day, Mr. Chairman, we're suggesting that the rate of $15.50 for this very large space relative to the large lease transaction indicators is very fair, and that's the rent that we're going to apply this morning. The department's applied a market vacancy allowance of 7%. We do have commentary on the vacancy allowance, but if you move to page 9, I won't spend a lot of time on it, because at the end of the day, we're not disagreeing with the 7%. Certainly, it's appropriate, we believe, for the Class A product in the environment they're operating in as of the reference date, and we will also apply the 7%. We're applying the same shortfall rate, so no issue there. The non-recovered expenses, so the 2%, which we're suggesting is a structural expense, structural reserve allowance, we agree with that, but we are continuing, as has been well documented over the past couple of months, we're continuing to apply the 5% rate as representing an appropriate stabilized allowance for non-recovered expenses, and we have applied that rate in our valuation, and I'll get to that separate presentation pardon me, in just a couple of minutes. So then capitalization rate. The capitalization rate we're suggesting, Mr. Chairman, again, given the environment the building's operating in, is 6.25%. I'm sure the board's seen the commentary at page 10, pages 10 and onwards. So at the end of the day, the cap rate's influenced by, we're suggesting, 3 major items: the perceived risk with the income capacity, investor expectations for appreciation, and the required returns in other investment vehicles. Now, a big part of what we are looking at here, if one goes to page 11, for the first time in a very long time, the Bank of Canada's benchmark rate had actually increased 75 basis points, as shown on the first chart on page 11, and predictably the 5-year mortgage rates also increased in that period from 2.39% in April of 16 to 2.99% in April of 18, which is an increase of 60 basis points. That cost of money is going to have an impact on cap rates, and certainly we're suggesting that that would be a factor that an investor would look at. And we do conclude, based on that information and some of the other information that we've got on the following pages, that cap rates should have ceased compression, and in this case, that the cap rate should remain at the 6.25% that was applied with respect to the 2018 assessment appeal. Page 12, we've got a summary of the Winnipeg cap rates and the reports by the brokerage firms that shows again, reinforces the submission that we're making that there has been no compression in the cap rates. Then at the bottom of page 12, and again, I'm going through this very quickly, but just I trust that the boards have seen these office or these cap rate discussions several times in the past. The city applied cap rates are summarized at the top of page 13. So for the Class A downtown office, which is what we're looking at this morning, the cap rate applied for the previous assessment was 6%, and in the present assessment, as indicated by Mr. Pohl, is also 6%. We're suggesting 6.25% in this case, which is consistent with what we suggested in the previous assessment cycle. So the office cap rates that we had a chance to consider are located at page 13, ranging from a low of 6.49% up to a high of 8.94%, and as Mr. Pohl had also indicated, there's no Class A office properties obviously in this mix, but we're certainly suggesting that the rates of return that are being expected by investors, when you're talking about a Class A product, sure, it's a superior quality product, but there's also a higher risk because of the environment in which these A buildings were operating. So certainly we believe that those indicators would well support the 6.25% for this property at this location as of the reference date. So our conclusions at the top of page 14, we are suggesting for downtown A properties cap rates of between 6.25 and 6.5. We're using 6.25 in this case, and so the conclusion, page 15, the subject property cap rate, the announcement in early 16, of course, of the True North Tower, which will bring roughly, actually it's closer to 330,000 feet as it turns out of office space, not including some of the retail space. That's obviously going to present a risk in the Class A market, and we're suggesting that would need to be recognized. And given the circumstances in which the property is operating in a very limited market for tenancy as large as the subject, we are applying the 6.25% in this case. So then moving to page 16, our valuation is set forth there, 268,952 square feet at $15.50 a foot. And then running it through using the 7% vacancy, the 5% non-recovered, and the 6.25 cap coming in at $53,773,000 rounded. And then turning to page 17, you can see our valuation based on that revised valuation for the office component and the same valuation for the arcade as the assessors got for the property. Pardon me, results in a total value of $58,150,000. And that is our request this morning. So, just to quickly take the board, I had mentioned the cap rate applied for the 2018 assessment. That's for the board's reference, located at pages 26 and 27 that confirm the 6.25 rate. I've attached the municipal board orders relating to this property from previous cycles, but given that there's no discrepancy in the physical characteristics, so I don't believe there's a need at this stage to go through those. But then my next question, Mr. Chairman, is there's the non-recoverable study which relates to the 5%. And I know that Mr. Lorando and I know Ms. Billinghurst have heard this a few times. Mr. Chairman, have you had the benefit of, hopefully the benefit of hearing this argument?
Yes.
You have, okay.
Yes.
So I can, then and I know Mr. Poole has, and we've been through it a few times. So
I think I'd like to review it, Mr. Chair.
Yeah, so I'm going to take a
From
sort of
both
a higher
sides.
level, a higher level review.
Not if we ever rebuttal, obviously, I'm not sure as the panel seen the updated.
No.
Okay.
That's why I'd like to see it.
Okay, so should I go through it in detail then? Because if there's updated rebuttal,
The only really one thing that's updated is we did all the comparables. We did 29. Three of them were determined we couldn't do anything with them, so we let them out. But
Okay, if
of
that's
that,
the-
the rest of it is.
Why don't you guys explain it to us after you've put your
okay,
presentations
well,
forward?
sure, why don't we do this? So then, if I could ask Mr. Chairman, the board members, Mr. Poole,
Sure,
to
Mr. Chair.
pull our non-recoverable expense study. So this relates to the 5% allowance that we have suggested that should be reinstated for the subject. So turning to page 1, and what I'm proposing is this, I'll go through it at sort of a higher level as a refresher. Perhaps we can listen to Mr. Pole's updated rebuttal, and then if I might be permitted, if there's anything in there to go back into the study, if I might be permitted to do so, but that way we'll save everybody a bit of time. Does that make sense?
Yes.
Perfect. Okay, so page 1, fundamentally what we're suggesting is this, that the allowance is not and is never intended to be an expense relating to the standard management fees that are charged by the owner or third property manager relating to the day-to-day operation of the property. These management fees, and there's no dispute on this, these management fees are usually recovered in whole or in part from tenants when they're on net leases. What we're suggesting, and this is at the middle of page 1, what we're suggesting this allowance has always been intended to be is a stabilized expense involving a number of typical non-recoverable expenses relating to the proper and competent operation of the property. These expenses that we're describing here are never recovered from tenants, even those under net leases. So the department's valuation procedures manual reinforces this, and copies of several manuals are attached. What the manual stated in these through the late 90s and early 2000s, even with net leases and competent management, there will still be expenses incurred by the landlord that are non-recoverable from the tenants. Examples of these are processing payments and chasing bad debts, and in our respectful submission, leasing commissions, advertising, marketing costs. These types of expenses, leasing commissions being the most significant of them. So this is what we believe the true intent has always been. So moving then to, and again on page 2, it's just further quotes from the department's manuals in the previous years that reinforced the intent of the expense, consistently saying there's still additional management expenses incurred by the landlord that are non-recoverable, and certainly we're suggesting that should continue on with the present assessment. So at the bottom of page 2, of course, the NOI calculation, it sounds trite, but the NOI calculation has always been and continues to be net operating income equals a potential annual net rent minus vacancy loss, plus other income, minus non-recoverable operating expenses, which is what this 5% allowance relates to. So the valuation principles at the towards the bottom of page 3 now. So there is the non-recoverable expense allowance is discussed in the case studies and appraisal excerpts that we've got attached to these materials, which states that appraiser should also account for non-recoverable expenses, also called non-rechargeable expenses. The most important non-recoverable cost items to be aware of are space marketing costs, which include both tenant inducements and leasing costs, and an allowance for structural or mechanical repairs. The other costs associated with leasing space is leasing fees or commissions. And of course, fundamental to this approach and to all of our valuations is the principle of anticipation, and that principle is stated at the bottom of page 3. In the income approach, an appraiser analyzes a property's capacity to generate future benefits and capitalizes the income into an indication of present value. The income, or the principle of anticipation, is fundamental to the approach. It goes on to state at page 4, anticipation is fundamental to the income approach. All income methods, techniques, and procedures attempt to consider anticipated future benefits and estimate their present value. The income approach supports two basic methodologies: direct capitalization, which uses the relationship of 1 year's income to computed value, and yield capitalization, which considers a series of cash flows over time together with any reversion value of resale proceeds. This is the DCF analysis. Now, I know in the past, in the past couple of months, the department's seems to have put quite a bit of stock in the fact that the inclusion or the accounting for these types of expenses is, the impression that they seem to be saying is it's really only relevant to the DCF analysis. That's wrong. This, when I say that the principle of anticipation, as I've read here, is fundamental to the income approach, it's fundamental to the approach whether you're using the DCF or whether you're using the overall capitalization rate, which is what we're doing this morning. In either case, it's the anticipation. What do I foresee the income in the future to be? And part of that, whether you're doing DCF or the approach we're taking, is what am I expecting the NOI to be? And part of the NOI calculation is what do I expect my stabilized expenses are, and part of that is the leasing commissions that we're talking about this morning. So it all ties together based on the principle of anticipation. And while it's certainly, when you're talking about a DCF approach and you're taking dollar for dollar, you're taking these figures out of the cash flow over, say, a 10-year horizon, it doesn't mean it has any less relevance for the methodology we're using, but you're not taking an NOI calculation, you're taking a stabilized allowance based on the principle of anticipation into account when you're capitalizing the future benefits into a value, which amounts to a 1-year stabilized NOI. So the management fees and the recoverable management fees on page 4 and the non-recoverable management related expenses are found in the office property valuation text, and there they talk about the recoverable expenses, operating costs such as payroll, cleaning, utilities, maintenance, repairs, ground and parking area maintenance, management fees and insurance. Those are all part and parcel of the recoverables. For office buildings, the total operating costs are often surcharged by 15% management fee that's recovered from the tenants. And then leasing and capital costs shown as non-recoverable expenses. The appraiser should also account for non-recoverable expenses. The most important non-recoverable cost items to be aware of are space marketing costs, which include both tenant inducements and leasing costs, and an allowance for structural and mechanical repairs. And that's what we're talking about this morning. Now again, moving on to page 5, we take a look at what some of the other provinces are doing. The SAM evaluation guide, that's from Saskatchewan. They, again, at the middle of page 5, they reference the non-recoverable operating expenses, which are not passed on to the tenants. And then on page 6, they actually reference in their materials operating expenses that are typically not recovered are legal and audit fees, structural repairs, advertising and promotion, and leasing commissions. And again, that's what we're talking about this morning. MPAC, that's the Ontario Assessment Authority, also talks about, now I'm on page 7, the non-recoverable operating expenses. And there again, they state there's typically 2 areas towards the top of page 7, 2 areas where the property owner has to cover expenses: non-recoverable operating expenses, which are not passed on to the tenants, such as legal and audit fees, advertising and promotional fees, and we're suggesting certain leasing commissions, and expenses operating with any vacant space, and that's the shortfall allowance, so there's no dispute on that. on that point. Turning to page 8 then, so there are many non-recoverable operating expenses that are shown on a typical statement for a given commercial property. For me, as we show at the middle of page 8, leasing commissions, professional fees, tenant improvement allowances, owner building maintenance, free rent, asset management fees, marketing and advertising, various financing fees like covenant fees and such, bank service charges and fees, depreciation, mortgage interest, utilities for vacant units, and bad debt expense. There's specific, out of all of that list, there's only 4 items that we have considered in our study, 4 and 4 alone. Because the other ones are either not part of the evaluation, such as the mortgage interest, or they're covered off by other expense allowances already provided, like the bad debts, where our vacancy allowance is intended to include both vacancy and bad debt, and utilities for vacant units, well, that again is shortfall. So there's only out of that list 4 items that we are including, and that's at page 9 in the middle of the page. Leasing commissions being by far and away the most significant, professional fees, asset management fees, and advertising marketing. So those calculations are set forth in the column that's in the chart that says percentage of EGI, effective gross income, 3-year average with no TI, and I stress that. We have provided an additional column for the reference of the board that includes TIs. We're not relying on it. If you include TIs, the percentages get much higher still, but we're suggesting we're not including it in our request, and we're certainly focused on the column with no TIs included. So then if you go to page 10A, the next page, this is the chart where we have taken, this is again based on a review of 3 years worth of statements, and it's based upon 3 years and the 3-year average of non-recoverables of those items that I mentioned, not including TIs. The column is second from the right-hand column and page 10A. So as you see, it ranges from a high of 31.05% to a low of 2.77% based on our reviews of the 3-year statements for all of these properties. And the average is 7.42% with a median of 5.75%. So we certainly are suggesting this fully supports the retention of the 5% allowance, and we're asking that the board maintain that allowance this morning. Just for the board's reference, it's not intended in any way to be comprehensive, but at page 10B, we've got a chart with some of the structural or capital costs for the board's reference. Now, I've mentioned this in the past that it can be, in a lot of cases, difficult to determine the capital costs that would amount to relate to the structural allowance because these items don't hit the income statements. This is by definition part of the balance sheet equation. And so these properties shown on the chart are properties where we actually had the balance sheet or where they've used the assessor's form and actually listed the capital costs separately. There's a section on the assessor's form that does that. So it ranges from 2.81% all the way up to 58.9%, obviously very, very high. But again, the 2% we believe is, if anything, conservative, but certainly appropriate to retain as a structural allowance as well. So in conclusion, we're asking for the 5% and the 2% to continue to be applied, starting at pages 10D through to page 18 are the details year by year and with the expense items listed of all the properties shown in the chart relating to the 5% expense. Pages 19 through 22 are the similar details for that reserve, and again I stress it's not meant to be comprehensive, but it is there for the board's reference to provide any additional comfort as to the analysis that was done. Then turning to pages 23 on are I've made reference to some appraisal texts, I've made reference to some assessors' manuals as well as manuals from other provinces, and that for the board's reference these are the pages relating to all of those citations. So that is that information. I also have rebuttal to the departments, the chart of market rents that Mr. Cole has presented.
Okay, let's hear his presentation first before we get rebutted.
He did present on the market rent issue.
Oh, on his market rent, okay. I'm sorry.
That-
That we're dealing with,
Not the non-recoverable, yeah, no.
okay,
So really, and this is just getting to the, I'm not gonna belabor this, but there are some retail restaurant units that have been removed, and some of the semi-gross rents were adjusted, and of course, some of them, as I had alluded to in the case of the one at 360 Main, some of the other ones had significant TIs. So I'm putting it there as with the board's reference, for the board's reference. Fundamentally, it's a question, I believe, of the very significant size of the subject and the larger tenancies that, quite frankly, we've both presented, which I am suggesting would fully support the rental rate of $15.50. So subject to questions and then subject to discussion based on the rebuttal of Mr. Pohl to the non-recoverable. Thank you.
thank you. Well, let's deal with this first, okay? Let's get this, any comments on this?
I would kind of prefer to do the non-recoverable first and then get into the actual.
Okay, all right,
That way.
we keep track.
Your comparables 9, 15, and 23 for your study.
What page are we looking at?
They're not, it's the chart on the,
Hmm?
sorry, what page is it? I just have it on my,
You're talking the non-recoverable
Yeah.
chart, correct? Okay, so say again. So, Mr. Chairman, we're at page 10A of the
10A.
non-recoverable expense study,
Okay,
so,
the chart. Yeah.
10A.
okay.
We have a lot of paper.
That's okay, I'll, in that patience,
You got lots of patience.
it is a lot of people. Okay, so we're all on that page. So your comparables 9, 15, and 23. These are the three that we weren't able to determine any adjustments for. These are all multiple roll numbers, information that was received from multiple roll numbers.
They're all, those properties are accounted for as one economic unit, so the income statements would be for, the department's got them assessed as more than one roll, but the income statement relates to.
So you have, we weren't able to determine anything from these because we couldn't tell where the money was flowing around from. So you looked at, because of, I'm assuming you handled these under appeal, all this is handled?
We are
So
very.
you have intimate knowledge with the ownership group and you can question, okay. So, all right, with that, that's the only thing I was gonna question on. For the non-recoverables, I'll hand out my rebuttal for this.
well, maybe we'll let the panel ask questions first. Marcel, any questions? You need a minute?
What,
On
do
the,
you put any of the information from the actual leases? Or capture any of the actual costs from the leases when you're doing it? Or are you using?
We're talking the non-recoverable study now, right?
Yes.
Okay.
Or are you using the information that they provide to the city on that questionnaire?
The information and the percentages are based purely on a review of the income statements and what's reported on them. So do we go behind the income statements to look at the leases?
Yes.
No, it was based right off the income statements themselves.
So how do you know what the actual costs are if you don't see the lease? Because you don't see the true recoverables.
Well, no, we actually do, because the income statements have consistently recoverable expenses and listing all the items, and then non-recoverable and listing those items, so you can calculate it very precisely. The income statement will reflect the terms of the lease as to what's recoverable and what's not, 100%, or else there are accounting methods that would be subject to audit and fraud, essentially. So absolutely, it's on there to
Okay, so when we get back to the other thing, we'll have some questions on that.
okay,
Let's let the city finish. Go ahead.
thank you, Marcel.
I'm sorry, you did.
Marla, any questions?
No, I don't.
Okay, my only question, Mr. Reimer, is, so how do you know that the tenant or the property owner isn't getting 5% more in the lease to cover those?
But that's the income statements, and this is to Mr. Lorna's question, this is really important. These income statements will reflect the 5% that's on there, it's gonna be shown as management fee revenue. It's actually shown as part of the recoveries that they're getting on the statements. And so you've got the net rent, and then you've got CAM revenue, and then you've got tax, like not CAM revenue, CAM recoveries, you've got tax recoveries, you've got management fee recoveries.
Why don't
And
you
then-
walk us through the sheet? There's one here, isn't there?
Well, this is an owner occupied, so this one's not gonna actually show any rent, or this is not So the income statement here is not gonna show any recoveries. It would be like a negative $1 million, so it's not gonna make any sense. So, but when you've got a leased property, you've got on the top line, assuming it's all net rents, you've got net rental revenue, you've got CAM recoveries, you've got tax recoveries, you've got management fee recoveries, and any other income signage or whatever it is. So that's all top line. And then you've got the expenses, and the expenses nearly invariably are presented based on all the recoverable expenses, and that all relates to, forget about the net rent on the top line, you've got those other three categories, CAM recoveries, tax recoveries, and management fee recoveries. All of those recoveries relate to the recoverable segment of the income statement. How much were the property taxes? $100,000. How much was recovered? $87,000 because they weren't quite full the whole year. But if they were full, then it would be $100,000. Similarly, for the CAM recoveries, things like utilities and waste and snow clearing and all these day-to-day operations, expenses are, if it's 100% occupancy and fully net lease, they're all, these expenses shown as recoverable, and the CAM and tax recoverable income, or the CAM and tax recovery income, is going to match. Then, and this is to your point, Mr. Orlando, and to your point, Mr. Chairman, if you've got a third-party property manager that's managing the property, they will typically, there can be variations, but they will typically base their management fee on 5% of gross or net income. So then they're going to show management fee expenses in the recoverable expense line, and that in the same manner is going to link up to the management fee recovery on above the expense line. So it's all matching up, and if it's 100% leased and 100% net leases, that's all going to match up. But then, this is our entire point. Underneath that, then you've got basically what amounts to a subtotal. All the net rent, all the recoveries, minus all the recoverable expenses, you get a subtotal. And then below that, and this is where all of this comes into play, that's where you have your non-recoverables. And the non-recoverables are leasing commissions first and foremost. They will be structural repairs, because under net leases, for in nearly all cases, the net leases will not include any allowance for structural repairs. That's the landlord's responsibility. You'll have advertising and marketing for the building. The tenants under net leases are not paying for the landlord to lease up the space. That's the landlord's cost. So all these things we're talking about here, that's underneath in the income statements, that is underneath the subtotal for non-recoverable expenses, and it's only after deduction of that segment that you come into the NOI that we use to value our properties. So that's how that all functions, and certainly, Mr. Chairman, that's why we're saying, first and foremost, the 5%, we are not disputing that management fees, quote-unquote management fees, are typically recovered under net leases. We agree. We've always agreed with that. Our fundamental point is that's not what this allowance is. So that's the area of dispute.
Yeah, okay. I'm going to speak out of turn here a little bit. So, Mr. Pohl, I'm sure you didn't make this decision to remove that 5%. It was done probably by the modelers, possibly. What's your understanding of why it was removed?
It's just not reflective of the percentage, and as we go through my rebuttal, we'll see.
Okay.
We have 29 that the evidence, although we don't provide direct evidence, when we get rebuttal, when we're rebutting the information from the appellants, that's the best comparables that they're showing us, and when we go through them, it proves that point.
Okay,
so,
thank you. All right. Okay, so that's my last question. Okay, so Mr. Pohl, your rebuttal, we're gonna deal with now.
I understand we've talked about this lot, so I'll kind of go through just a quick, on the first, a little bit of the first page and the third page, and then I'll go straight to the comparables that we reviewed in full. So, starting at the bottom of page 2, and we're fully understanding now that the management fee of 5% is typically recovered by the tenant, where there's no disagreement, as Mr. Reiner said. So if we start at the bottom paragraph, page 2, the Assessment Taxation Department has allowed for a non-recoverable expense. Non-recoverable expenses include, first point, a general 2% expense allowance and a shortfall allowance per square foot for the count of non-recoverable expenses during times of vacancy. So we're not dealing with a vacancy shortfall, we're just dealing with the 2%. This 2% has always been there. We've taken away the additional 5% for that management fee. When we just stick with the 2%, the 2% 2% general allowance, or general expense allowance, was always intended to include expenses incurred by landlord that are not covered by tenants. Those expenses could include advertising, promotion, professional fees, structural repairs. Previous jargon at the Board of Vision may have referred to the 2% general expense allowance as a structural repair allowance. That jargon was oversimplified. So, some main points, and then again we had like a little summary of the rest of the rebuttal. This rebuttal package justifies the following. The historic 5% management expense was in fact an expense related to the standard management fees charged by the owner. The expenses Altus Group determined as non-recoverable are contrary to assessment case law in Manitoba and are not to be treated as expenses. Again, TIs, free rent, tenant inducements. We have the orders attached to that. And the back of this version. The expenses Altus Group determined as non-recoverable are typically important when using a discounted cash flow method of analysis. We're not doing a discounted cash flow. Altus is not doing a discounted cash flow. We can't do a discounted cash flow. That incurs post-reference information. And a lot of the stuff that you would have is as far as expenses may be amortized out over the period of time, so we shouldn't be looking at that. Assessment management fees are non-allowable operating expenses, or asset management fees, I should say, are non-recoverable, or non-allowable operating expenses. They're typically below line items in the NOI, and when they're reported, it gives you an indication that they should be reported as part of the operating expense. Altus Group's analysis of an EMI does not exist in appraisal theory. It is flawed. The use of medians rather than averages changes the result of Altus Group analysis, inclusions from 5.75% to 4.78%. After analyzing the effective gross income, or the EGI, for 29 of the indices of the Altus Group study, the Assessment Taxation Department has determined a range of non-recoverable expenses. The vacancy and shortfall is between minus 0.71% and 5.2% of EGI, with a median of 1.06%. So with that, we'll go to page 13. And this is the main point. We've asked all the appellants when we're going through these to provide us with the indexes of property addresses, roll numbers that they're using for their analysis for comparables. Altus was good enough to provide us in full. We have asked Mr. Mark Newman. He's considered it but hasn't given it to us. We've asked Mr. Rocky Neufeld. Rocky Neufeld denies and will not give it to us. I have no experience with Trevor Smith, so I'm not sure if he's been asked yet or not, but I'm assuming it's when he's been asked. But Altus has been the only tax agency that has actually given us their comparables. So when we go through the 32 comparables, and again, this was management going through the 32 comparables, you'll be seeing this document verbatim. It's the same one that's seen over and over again. It won't have any changes from any particular assessor. When you go through the comparables, using a percentage, I guess you're 4 columns in on your left. Percentage of EMI for 3-year averages, they show what they show, and you get 5.75%. When you use a median, just everything the same, you just use a median, you get 4.78%. When you do it how we're approaching it, when you take it up effective gross income, and you take out your TIs, you take out your items that case law has stated we cannot use, your actual median drops to 1.06%. We're giving 2. So these are 32 of the Altus has chosen comparables to use. The 3 here, which I've highlighted, 9, 15, and 23 prior, they were on multiple roll numbers, and in discussions with management, they weren't able to break out or do the same analysis that they did for the other 29 properties. So we couldn't really do anything with those 3 properties. That's why I asked, is it coming off the IE? Is there any other internal information that you don't known to since they handle deals? three we can do it. So by providing this rebuttal evidence, hopefully we're showing that when we're taking out leasing commissions, when we're taking out TIs, when we're taking out asset management fees, when we're removing the expense items, the non-recoverable expense items that Altus is using, and applying a median to effective gross income, you're actually getting to a number closer to what we have, where it's actually quite a bit lower. So at 2%, we think it's reasonable for marketplace. That's what our analysis has been. At this point, I can go through the rest of the document, but I think we've all heard all the pages. We've heard everything in the document.
But you had something new.
This was the new. It was only we didn't have the 29th year. I think we did 11 of them. So it wasn't that many. With that, that's all. I'll go with the non-recoverables. Can I get on to providing my rebuttal information for the rest?
I think we'll have questions.
And so just kind of package this issue and then we'll move on.
That's kind of how we've been treating it. I think it's
okay.
easier that way. It's more clean.
Yeah, so, Mr. Chairman, may I have a couple of
Yes.
questions? Okay. So, Mr. Poole, on page 6, and just to be clear, we're agreeing on more than we're disagreeing, I believe, as usual. Page 6 at the bottom, the department is not disputing that non-recoverable expenses must be considered in appraisal theory and literature, but rather the department's suggesting that, notwithstanding that it is a valid approach when you're appraising property for the reasons we talked about, anticipation as such, you're suggesting there's a jurisdiction, or the department's suggesting there's a jurisdictional exception.
Precisely.
Okay. So if when we're just leaving aside for the moment that jurisdictional exception, then you would be taking these items, and specifically the leasing commissions, because most of this seems to turn on leasing commissions, you would be taking that into account using the direct capitalization method, correct, as a stabilized amount?
Yeah, and just to be clear, if we were looking at market value, I would be able to do discounted cash flow. You guys, assessor, would be able to go forward, but we can't. So it's not just the non-recoverables, it's a jurisdictional exception to not look at anything post earnings too.
Well,
So it does take into account.
But I guess I didn't suggest the DCF, Mr. Poole. I'm suggesting the appraisal theory that I've mentioned, and you've mentioned in that paragraph, the appraisal theory certainly suggests whatever method you're using in the income approach, whether it's direct capitalization or DCF, you're projecting into the future and you're looking at what the NOI would be, and that would include accounting for the non-recoverables. Can we agree on that?
Yeah, but with the assessment case law that we have, we remove some of those.
Yeah, that's the jurisdictional exception. Okay, so we're
Just when
agreeing.
you do a direct capitalization method, we can't look post reference, we take the information coming up into that point and we use it there.
Indeed, and so that we can
Discounted
agree.
cash flow, you can't pull back, we don't know. And some of those expenses that we're reviewing may be large reported now, but amortized out over a number of years.
Okay,
So it wouldn't be fair to be including that.
Leave aside the DCF, Mr. Cole, because we can agree we're not using the DCF, right? Okay, so we're using the direct capitalization. Within the direct capitalization, we can agree that anticipation is fundamental to all this.
Absolutely.
Okay, and within the whole entire principle of anticipation is you're projecting, using direct capitalization now, you're projecting, you're placing a value based on the anticipated benefits in the future. That's how and then you're capitalizing those anticipated benefits. Within then method, of course, the fundamental to that is what's my NOI going to be, right? And the NOI calculation would be predicated on all of the items, the rent, the vacancy, and projection, but including, again, leaving aside jurisdictional exception, including some kind of stabilized allowance for these other non-recoveries, correct?
You agree, that's right.
So the NOI calculation, NOI is fundamental as part of the anticipation. So within the NOI calculation, and as the department stated in its manuals, you've got potential net rent, vacancy allowance, and then you add other income as appropriate, but then you also deduct expenses that aren't recovered to arrive at your NOI, correct? Okay. So then, to be clear, so we're agreeing that notwithstanding the jurisdictional exception in appraisal theory, it's an appropriate consideration, and rightly so. Then on page 13, fundamentally, and I don't want to misread this, but I believe it to be the case that the entire difference between the department's analysis and our analysis, not entire, but most of it, relates to the removal of leasing commissions, as you said in your comments, correct?
Yeah.
And in a couple of cases, I noticed you've removed asset managements, but again, leaving us, I want to be very clear on this. The department understands that we did not, in that column that I talked about, we were not including TIs. We can agree on that, correct? Like the one column that we're relying on?
From what you're indicating, that's okay.
Well, but let's, and again, I want to be very clear as to what we're talking about here. So, Mr. Chairman, could I ask Mr. Poole and the board members, keep page 13 of the department's brief open, and open our brief on page, again, on page 10A. So let's have these charts side by side. Because this is certainly fundamental to the positions. So on our chart of page 10A, Mr. Poole, the second, not the last column, but the second last column from the right, that's, the department understands these are the percentages we calculate, not including any TIs whatsoever, correct?
Right.
Okay. It's that column that the department has then modified in your page 13 by removing, because in the column I've just referenced, there was no TIs in any of those figures. And so the department has removed, TIs weren't there in the first place, but they removed leasing commissions and in a couple of cases asset management fees, correct?
Right.
Okay. All right.
I think fundamentally what I'm seeing here is that's the problem. Like at least what I reviewed after the deal, let's go back and look at numbers. You're also accounting for the TIs on the top of the rent.
I'm sorry?
The reflective market rent is dropping downwards.
No. Where are you getting that from?
When I'm looking at a marketplace, when we're dealing with OFAs today, when I'm getting a market value that Altus presents, say $18.02, when they're not presenting that $18.02, when they're doing their analysis on the rent roll, then they're not using that market value. You're reducing that rent. You're reducing it, and you're taking it off, and then you come.
Absolutely not. We are not.
No matter where you put it in, whether it be rent or you put it in expense, you shouldn't be looking at tenant inducements at all.
Mr.
You shouldn't be looking at
Mr.
asset
Poole, we
management.
are absolutely not. And I can tell you bluntly, based on my review, the potential, or sorry, the rental income that is shown on these statements is in no way an NER, like a net effective rent. It is actually the gross rents being received, the face rents plus recoveries. If you have evidence that somehow in a particular case, the top line revenue that's being used to calculate the EGI is a net effective, I would like to see that evidence. I'm stating categorically that's incorrect.
So, for example, when it comes off particular 2-1 Portage, we had.
Which one?
I'll present it in rebuttal, or it's an appeal that was done in the past. At 2-1 Portage, we had the analysis from Altus as a market rent at $18.02, and yet that $18.02 was not put on the entire property.
Well, okay, but you had one rent. How, Mr. Poole, I must be misunderstanding you. Why would you take one rent from one unit as representing the whole property?
Altus did a market rent study. That market rent study.
For 201 Portage?
Yeah, came to $18.02.
Okay.
So why would you not?
Well, you know, we're talking about
I don't know what you're,
appeal, so maybe.
I don't know what you're referring to, Mr. Poole.
Yeah,
At this point, I think we're getting a little too far into.
No, I actually want this information on the record, so if you guys, Mr. Chair, I think it's important we have this information on the record. I want to get this thing resolved once and for all. I'm tired of the.
I'll have a rebuttal, so.
Okay, yeah, because Mr. Reimer right now doesn't know what's being referred to.
I don't know context for that.
Maybe
but
we'll deal with it with rebuttal.
But certainly I will, Mr. Chairman.
That's getting more into the analysis.
Let's get into the analysis then.
Okay.
I'm lost as to what.
Yeah.
I guess Mr. Poole, you suggested that somehow the top line figures on the income statements would represent a net effective rent? I think that was the question, or the insinuation? No.
You said.
Absolutely not.
So for other fields that I've dealt with, say Great West Life, when we're seeing low $12, $13 rents applied to OFA spaces, how do you get down to market comparable of that range when the market comparables that we brought in are within a quarter of each other on $18 or $18.38 or $18.02? How do you get down to, I'm not saying for this particular break
Well,
here.
but all I can
But
answer
for
is what
Great
the
West
evidence
Life, when you're
presented.
bringing in those comparables that lower the averages down, there's only one way to do that. That either is an outlined rent or TIs, expenses and everything are taken off to work its way down.
Mr. Pohl, I have no idea what you're talking about with 60 Osborne. If you want to present rebuttal, let's go through it. I'm going to tell you this. Page 7 of my brief, my evidence in chief, those rents are face rents as shown on the rental. To answer the first question, is the income that's shown in these income statements for this analysis are as the face rents. There's no erosion based on any
This is your evidence you're talking about.
So now, yeah, you know, I can't comment on 6100 Osborne. I can certainly comment on my rental chart on page 7. These are face rents as shown on the rental.
Fair enough. Okay, so, non-recoverables, I'll put this aside. I'll hand out my rebuttal for your rent.
Why don't we just do it this way?
Yeah.
Michelle?
Send Michelle.
Michelle. We got long arms.
If you could turn to your page 7 of your brief.
Yes.
His brief? Your brief? His
His
brief.
Yep. You can agree that comparables 2, 7, 10, 11, 12, and 13 are OFBs.
2, 7, 10, 11, 10, 11, 12, and 13 as well. Yes.
Yeah, so the remaining are OFAs.
Yes.
On my chart, on the top chart that I just presented, those remaining OFAs are identical to the.
Well, let's make very sure. Let's make very sure. If I could have a moment, Mr. Pohl. 4960. That one is good. 19451. 4816. Yes, indeed.
Okay. We can agree that the average for your large spaces in your OFAs is $17.25 for
Yes,
average rent.
absolutely. Yeah.
An average weighted rent of $17.72 and a median of 17.
I'm assuming that, I won't run the math, I'm assuming you have, but yes.
Okay. If you look at the comparables that was given by Altus, you were at the deal, and so was, although you handled mainly the non-recoverable.
Yeah,
Or Rod handled the rest of it.
Yeah.
These were the comparables for market rent that Rod presented,
Okay.
Slaughter presented.
Okay.
You can see the average rent is $18.02. So the difference between large spaces and your average spaces, smaller inclusive, is approximately $18.02. It's about 1.7% difference. So you can see that there's not a large differentiation between what we have here today, which originally was 1638, or the numbers that you're asking for, $15.50.
Well, with respect, Mr.
So
Pohl.
just look at your information, it's about $17.72 weighted.
Yeah, but Mr. Pohl, I would agree with the math. I entirely disagree with the conclusion. Our property is 268,000 feet. So you've excluded the Class B large ones, I believe, based on the context that I mentioned. It's entirely inappropriate. So mathematically, absolutely, remember and know that the $22 rent, which we both have for 360 Main, includes a significant TI to bring that space to a higher quality than the subject. There's a reason why it's that high. So if you would take the $22 rate out of your top chart in your rebuttal, I'm sure that would significantly impact your average and weighted average, and I would encourage you to do that because that's just not comparable. I've included it because it's factually, it's there, and it's within the parameters that I searched under. But when reminding me, Mr. Pohl, of the Class B rents that are stated to be going up, the Class A rents that are flat, and the environment in which we're operating, and then the largest tenancies on my chart being far larger, the bottom, or the 76,000, 120,000 feet being much closer in size than these. Granted, they're in B buildings, but they're not low-quality B buildings. These are good-quality B buildings. So I'm suggesting the conclusion you're coming to is simply not correct. But mathematically, no question. When you've got on your bottom chart the $18 that was presented for, I guess that was this for 201 or which was?
201, yes, sorry,
okay.
at the top right now.
So I mean, you've got 1,430 foot tenancy, you've got an 1,800 foot tenancy. Well, sure, but those aren't in any way comparable, so I just don't accept that conclusion.
So my interpretation is you're bringing in OFB rents, lower rents, which are pulling down your averages. When you actually just isolate it out to the OFAs, using your own numbers, for your comparables as shown, we have $17.72 per square foot for average. You're saying that's not reflective. Your comparisons that you're using shouldn't be used for, this is the best information we have to largely use.
If I were to suggest, Mr. Poole, if you were to take out that $22 rate, because I believe that's skews it high and it's based on very specific, very expensive arrangements by the landlord, if you would take that out and do the averages for the remainder, I think you'd get something that's much closer to the market.
Getting back to your page 7, your top portion of your page 7, you put a lot of weight on asking rates not going up in Class A office buildings.
That's the statement that was made, certainly, yes.
Are you aware of any municipal board orders or orders from this tribunal level here that asking rents, not actual market rents achieved, should be put more weight to?
Oh, no question. That was to describe the market. Absolutely.
So we're dealing with actual events that know that have occurred, not asking rents.
Oh, for sure, yeah.
So the best market evidence we have are the comparables that I put on my chart, which I see average $18.33 for my 36 comparables.
No, Mr. Poole, it isn't the best evidence.
I'll respect my opinion, but that is the evidence that we have. We have about 36 leases that leased up for our base.
And the closest in size, not even half the size of the subject, but the closest in size is 120,000 feet for a very, very well updated and a building with an effective age that's newer than the subject, also on the north side of Portage, for $11.50 a foot. So absolutely not. The best evidence is not your chart. Your chart is absolutely unrealistic relative to what we're talking about here.
I agree to disagree on simply pointing out that your numbers from all this pointing backwards, we're getting to about $70.72 a square foot for the large CRU spaces. Broad analysis, inclusive of the smaller spaces, $18.02. My review is $18.33. That's very tight.
Yeah, I guess I'd suggest if we were dealing with an 8,000 or 10,000 or 1,000 foot unit, I probably wouldn't dispute the $18. That's not what we're dealing with.
So your analysis is that roughly you're looking for about a 20% reduction in the rental rate based on
From what?
from whether it be $17.72, $18.02, or $18.33. Your analysis, you're coming back to $15.50.
Absolutely. I'm not looking for any reduction in rental rate. The original rental rate applied by the department, I believe, was $16.38. I am looking for a reduction from that based on these lease transactions, including the $120,000.
The numbers at play are
Mr. Poole, with respect, this is meaningless. The chart on top is exactly right with this part of what I have in my chart. I've explained the $22 rent that I believe is an outlier. But this bottom chart, with whatever was submitted in Tool 1, I place no weight on it whatsoever.
You don't place any weight for an OFA building
with 1,700 foot tenancies, with and located at the corner of Portage and Main relative to the corner at the very periphery of Portage and Colony? No, not for that. I've made these choices very deliberately on size, and one has to look at the location of this. When you've got Portage and Main with the concourse and very well connected, and then this property that's got a skywalk to Portage Place on the corner of Portage and Colony, it is not. The rents on the bottom, with respect, Mr. Poole, the rents on the bottom of your page have very little relevance to what we're talking about.
All right, that's all the questions I have.
Thank you. Marla, any questions
No.
of the Mr. Poole?
Like, who am I asking?
Yeah.
Yeah, I know, I got it right.
No, I don't think so.
Is this Mr. Poole?
Yes, Marcel.
I thought it was me.
It's him. He's made his presentation.
But he presented this rebuttal, that's what we're dealing with.
Haven't you put your whole thing forward already?
Yeah.
Yes, you
Mr.
did.
Chairman, with respect, I think the questions are, I think they're coming here now.
Yeah.
They're coming
Well,
in.
we're still questioning this rebuttal. You were just questioning his rebuttal, weren't you?
I presented a rebuttal and I was questioning him.
Okay. Okay.
Based on the rebuttal.
All right.
So it's now the panel's turn to question.
Okay,
Mr. Ryan.
Marla. Or you want
I
to-
think I'm good.
Yeah.
Which property were you talking about at 1150 on Portage? I know the
Oh,
church that I
that's,
got.
That was
that's 300 Carlton.
It was 300 Carlton?
Yeah.
Yes.
It's government space.
That's the number 12 then?
Yeah, as I say, that building got an effective age of 1990 because there was huge money put into it.
Okay.
Anything else, Mike?
No, I'm good.
Okay, Marla, are you okay?
Yeah.
All right, thank you. Okay, Mr. Reimer, so are you saying that a larger office B is better evidence of market value than the office A that are smaller?
If you've got an 1,800-foot unit at the corner of Portage
No,
and
but
Main.
I'm talking about, sorry, I'm gonna refute it. They're your comparables. These bigger office A's that you presented are,
On page 7?
yeah.
Okay.
Yeah.
There's three things at play here.
Okay.
There's the size, which is extremely, we're talking about significant size. So yes, the first answer would be the best comparables in terms of size on my chart are comparables 4, which is 40,000 feet, and 7, and then 11 and 12. So recall, Mr. Chairman, this property is located on the north side of Portage and Colony. We're on the other side of Portage Place. We're west of Portage Place. So this building was built in 80, and as I mentioned earlier, I'm not disputing the classification, but I'm certainly saying the lease indicators. When you've got a 1990 variant age placed on Carlton, which is just north of Portage as well, for 120,000 feet, that's a very good indicator. More so, and I've put all of these comparables in because it was for larger lease transactions, closest to the reference date that I could find. But the gap between these buildings, including the 1990 variant age Carlton, and the subject, which is at the periphery of the CBD, the gap isn't very great. So now I'm looking at what are the large transactions, and certainly the Main Street, which both Mr. Pohl and I have submitted at $22. That seems like a bit of a at the high end because, and there's a reason for it, it's because of the TIs put into it. And when you look at some of the other larger tenancies, I believe Floyd supports 1550.
Okay. When we look at your page 7, the comps, okay, so the subject has a underground parking on-site, underground parking, 180, around 180 spots, I believe.
Yes.
Do any of the comps have any parking?
Yeah. Portage Avenue. Let me see. Main Street and Portage Avenue, and Graham Avenue Wood, so that's the comps there. Now Carlton Street. Let me see if I have that information.
I shouldn't say any, I should say as large a parking spots.
Well,
as
certainly the
subject.
360 Main and and
That's comp number 1?
yeah, and Portage comps number 1. Mr. Chairman, I believe, put it this way, I believe they all have sufficient parking. I'm not aware of any parking issues, except for, that's not quite right. Comparable number 11, that's 423 Main Street, that does not have sufficient parking, so that would be the exception. I mean, there's parking right close by, but not underground there.
Okay.
Yeah.
And the subject property, is it 185 parking units run by North Portage Development, I guess?
Yeah.
Okay, that's for staff parking, or that's,
Yep.
is it, it's strictly for staff parking, okay. Yeah, without the addresses, I know you said it's parking, but I mean, is it the same size parking as?
Well, I'm stating, Mr. Chairman, that if you want the addresses, I can certainly get it.
No, I'm just
But yeah,
wondering.
they do have sufficient parking with the exception of number 11.
Okay, what do you mean by
Underground
parking?
sufficient. Sufficient for the people in the building, like they've got adequate parking. There's no dearth of parking with any of these. So 360 Main, 200 Portage, 200 Graham, 201 Portage.
Okay, 200 grand, where would the parking be for that?
I believe that is, I believe it's underground. I thought it was. See if I have those documents here.
Which building would that be?
That's the building at the corner of Graham and, get the precise location, Graham and Ford, so it's just, no, that's 240. It's to the immediate east of cargo. Cargo's 240.
So that might be an outdoor parking lot or something adjacent off the back lane, so it wouldn't be an in-ground parking.
200 grain?
Yeah.
200 grain is parking underground.
I thought it was underground.
They have
I thought
about
there was-
17 stalls,
Okay.
16, 17 stalls on the surface.
Yeah, and then the rest is
And then
underground,
it goes-
Okay. Okay.
So 423 Main is, I guess, number 11, that's the one that I know that has, the underground is not sufficient. That's the one I know.
Yeah, okay.
But then again, Mr. Chairman, I remind you, we're not using 1150, or in that case, 12 bucks, we're using 1550 for something that's also on the periphery, so we believe we're being fair with it. But the parking question is a good one, but certainly the rent we're applying is.
So why do you think the number one would not be good at $22 a square foot?
Because it's 40,000 feet instead of 268,000 feet, Mr. Chairman, and it includes that a very specific expensive TI, bringing that to a level of quality and a level that the subject is not. The subject is not allowed to 30 bucks a foot put into it. So that is very much an outlier on the high side and very much smaller. Again, the Carlton Street one.
So what's the quality of this subject property?
Well,
That's
it's good quality, but it's not totally refreshed, huge TI put into it quality. That's my point. All of these buildings here are extremely good quality and have had significant sums of money put into them. 360 Main Street, the top one, that is an outlier at the top end because of a very specific expensive TI put in on the renewal.
Okay, and regarding your comment about the TIs and the leasing, and it seems to me that you agreed with the assessor that, am I wrong here? The TIs and the leasing fees and all that shouldn't be included in expenses. Did you say that?
Wait a minute.
It's jurisdictional, you said in Manitoba?
Wait.
Case
Two
law
different
said.
two different things here, Mr. Chairman.
Okay,
We're not calculating an NER. Mr. Pohl's exactly right. The position the department's taking is we're not taking the $22 rent in this case and taking off $6 a foot. Okay, so that's absolutely right. It's the 5% non-recovered as a stabilized allowance for these non-recoverable expenses. Forget TIs, because we're not suggesting TIs. We are suggesting leasing commissions. But the question in this case, Mr. Chairman, fundamentally, and I remind you this, the question is this: what would the rent be achieved for the subject property? And if you're looking at rental comparables and there's one that seems extremely high, or for that matter, one that seems extremely low, you've got to look at the reasons underlying that. The $22 rent is, and you'll see it from the chart, it's much higher than anything else, and there's a reason for it. So if our subject property had just had 40 or 50 bucks put into the entire space, the entire building, which would amount to a TI, or not a TI, but an improvement of upwards of sort of 15 million bucks, well, okay, then we've got a different level of quality, but that's not what we have here. So then when you look at the remaining lease indicators, and Mr. Chairman, with respect, I would suggest to you very strongly that the best indicators are these larger ones that at the top end are 17 bucks, and at the low end are 11.50 or even 10.50, because it's those size indicators for very good quality office space in the downtown. All of these buildings, with the exception of Carlton, all these buildings being in superior locations to the subject, that's what's going to drive the market rent for the subject.
okay. So the flip side of that coin is, why would you accept the lower ones if the high one isn't? That's an indicator of something going on a negative side there, isn't it?
Well, but
If you're
Mr. Chairman, I
dumping
put it in
$22
there.
square foot.
I put it in there at 39,000 feet at $22 with an explanation of why that's so high.
Right.
That, with respect, at the corner of Portage and Main, bears very little resemblance to 268,000 feet at the corner of Portage and Colony at the very west end, the periphery of the
Right.
central business
What
district.
about the lower ones? Lower ones.
And the 120,000 feet, comparable number 12, I'm suggesting in no uncertain terms with the amount of money that's been put into the building, this is just off Portage, but it's also on the North Portage. That's, in my opinion, the best single indicator of all of them.
So a bunch of the office A's are in the $17 range, I think it averages out to, let's say, $17.50 a square foot for the office A's. If we dump the $22 one, it's still $17.50, I believe.
No, Mr. Chairman, I don't think that's right. I'm gonna correct you on that. Okay. If you take, so I'm going now to Mr. Pohl's evidence, the rebuttal evidence.
Yeah.
So if you take 17, and I'm gonna do the simple average. the average is 1645.
Okay, so if we take Mr. Pohl's evidence and dump the low one at 1412, dump the high one at 22, I think if you're dumping the high, you should dump the low also, probably. The average is still coming out at over $17 a square foot.
Mr. Chairman, it's not 268,000 feet located at Portage and Colony. This is my point. It's
Okay.
not comparable.
All right. All right. But my question was regarding the 5%. It seems to me we were talking about whether the TI should be included or not.
No. The TI should not be included in calculating a net effective rent.
For leasing?
And no, the leasing commissions are a fundamental part of it, absolutely, but the TIs are not included.
See, this is what I misunderstood. I thought the assessor asked you if you agreed there was case law not to allow leasing TIs and in expenses, not allowable expenses. Did I miss something there?
Yeah, that's generally, I have it on my page 5. Basically, that's my question was, are you including TIs? You're saying no, but you're including leasing commissions. So whether you take a leasing commission off the top of the rent, or you take a leasing commission off the expense, you shouldn't be including leasing commissions anyway, based on
Our position very fundamentally is, so Mr. Chairman, this gets to the heart of the matter. Recall that the charts, when you had the two charts side by side, and using the column, forget about TIs, because we put that in there, I'm actually going to take that out because it's causing confusion. I put it in there for reference. But we're not suggesting that the TIs should be included in any calculation. Okay. So now when you look at the column that we had for the non-recoverables relative to the departments, the difference in almost all the cases was that leasing commission, the department took out leasing commissions because of the jurisdictional exception. We included the leasing commissions, and we're not, there's two methods to account for these. What landlords, quite frankly, will do is they will calculate the NERs, and they will take leasing commissions out and do all these things. We're not. We're not saying that you take out leasing commissions dollar for dollar. What we are saying is the expense was fundamentally meant to relate to non-recoverable management. The most significant, there's some other items that involve, like I mentioned, advertising, marketing, and such. But the most significant recurring expense within that 5% is leasing commissions. And so we're not taking it off the top line to calculate an NER. We are saying that's an appropriate inclusion for the purpose of the 5% stabilized allowance.
But, am I missing something here? But there's case law to say that you shouldn't be including it at all?
Okay, so then we didn't go through that in detail, but I do want to address that, and I'm happy to do that. Mr. Chairman, in these municipal board decisions, the appellants were seeking NER calculations. They were taking off free rent, they were taking off TIs, they were taking off leasing commissions off the top line, which is specifically what we're saying we're not doing. We're not taking it off the top line. If we were, we would come in at a much different NOI in our chart. We are saying, because leasing commissions can vary from $0 to hundreds of thousands of dollars in a given year. What we're saying is an investor using the principle of anticipation would certainly account for an average stabilized allowance of 5%. And the municipal board cases that the department is referring to, in those cases, and so I'll go through it very quickly, since the question's been asked. So if we take, Mr. Pohl, do you know if this document would have changed? Actually, I can put
no, the page 5 would have been.
That's just what my question was. So, Mr. Chairman, so if I could ask on Mr. Pohl's rebuttal document then, and the page references will be the same as what he handed out this morning. If I could initially ask the board to turn to page 17. So, page 17, number 4, the assessor did not, and this is in the middle of the page, the assessor did not permit any deduction for tenant inducements. The owner's agent says it was necessary to offer tenant inducements being leasehold improvements or money for leasehold improvements, or in some cases free rent, simply to commence tenancy. And then what the board says on the next page, it's in this context that these decisions are made. So the owner's asking for an NER calculation. And the next page, on page 18, the board states, the board reiterates that tenant inducements, leasing commissions, and leasing expenses are not expenses which may be used to reduce income for the purpose of calculating market value. But Mr. Chairman, please be clear about what was being asked. They were asking for an NER. We are not. We're not taking this off the top line. And if you turn to page 20, then what they did do is to have the 5% management allowance there. Again, they're not accepting the NER calculation, but they are including the management on pages 20 and 21 at the 5% rate. So then if you turn next to the department's rebuttal, page 36. It's two big paragraphs. The last paragraph, it's 1, 2, 3, 4, 5, 6 lines down. It starts, the rent used by Mr. DuPont for the restaurant was based on the deduction of an amount for free rent. The board has consistently taken the position that tenant inducements, including free rent, do not reflect the market and will be given no weight. Well, again, it's looking for an NER calculation, and when you turn to page 38, they of course didn't accept that to reduce the top line revenue, which is not what we're suggesting, but they applied the 5%. So, you know, I guess what I'm suggesting, Mr. Chairman, notwithstanding the department's position as to jurisdictional exception, we certainly believe the 5% is a stabilized allowance for the non-recoverable, and that's fundamentally the difference between the department and us. It's not entirely, but for the most part it relates to leasing commissions, and that's why we are including leasing commissions in our calculation. Not as a top-line NER calculation, but as a stabilized non-recovered expense at the 5% rate.
Clear as mud.
So, just to clarify, it's, you're accepting you can't put it in a certain part of the calculation, but you can put it somewhere else at 5%.
But
so why is that
allowance.
right when they've told you you shouldn't be using it?
Because
I'm just asking an honest question.
Absolutely.
Yeah.
The 5% is, recall, Mr. Chairman, that the department's own materials, and certainly our position is that the 5% is has always intended to be an allowance for non-recovered management-related expenses, even where tenants are on net leases. This has not changed for the past 40 years. Net leases have been around for this long. The department's position has changed, but the structure of the leases and the recoveries have not changed one iota. So if we were to start requesting NER calculations, our values would plunge, because the NERs in most cases, not in this case because it's owner occupied, but in most cases, the values would plunge, because now we're taking off all of these hundreds of thousands of dollars, and in some cases millions of dollars that are spent on TIs. We're taking it right off the top line, which is going to take your NOI from, you know, something, let's say, approaching $1 million to something approaching 200,000. It just, those kind of NER calculations, that's specifically what the municipal board said you cannot do, and we're not. But certainly, as far as a stabilized expense, and again, recall that the direct capitalization approach, which is what we're doing, it fundamentally involves the principle of anticipation, which in turn involves an investor saying, I'm projecting based on 1 year's income, what within that would I use as my valuation assumptions, and we believe the 5% as a stabilized, not the dollar for dollar NER, but as a stabilized long-term allowance that could be used in year one is appropriate in this case.
Okay, so last question. What is a jurisdictional exception?
I'm going to let Mr. Pohl answer that. We don't agree with the position, but I think that's the department's position.
Basically, if governing, whether it be this level of this level of tribunal, or whether it be the municipal board, or whether it be Queen's Bench makes a decision that applies to how we govern assessments, that's what we have to do. For example, post-reference is an easy one. You can't look at anything that happens after the reference date. That's why you can't do discounted cash flow. So there's an exception that doesn't allow for me to do that.
So you're, to put it simply, you're waiting for the board to rule?
No, the board's already ruled. We don't include those.
Sorry,
inducements.
Jeremy, would you mind speaking up?
We don't include tenant inducements for free rent. We don't include leasing commissions. It's already ruled a number of times. We don't use that to calculate market value, and that's at the municipal board level. We're simply taking that information and taking it out here, presenting it here at this level. But there's already been clear decisions on that.
Right.
So that's why I got back into it, like, how are you getting these rents? Are you taking it off the top? Are you lowering it? So it just doesn't make sense.
Yeah, go ahead, Marcel.
Now that we're into this, to you.
To me.
Yes. The media orders that you presented, how many of them didn't have the 5% in final calculation?
Or would you?
You supplied all these unit board orders
No.
in the back here.
How many didn't have the 5%?
How many didn't have the 5% calculated into it after? I think they all did have it, but I'm just gonna see.
Yeah, but, I'm trying to understand the question. That 5% was for management fee. We're taking that out because we're covered. Not, this is additional management expenses. So when we're talking about the management fee, we're agreeing now between all of us and ourselves, hopefully the rest of the agents as a group, that 5% is ultimately recovered, so we remove it. So the remaining 2% is the same that we always apply.
So this is a jurisdictional decision you have made, not using a board order. Because the board order never told you to take it off.
Say that again?
The board order never told you to remove 5%.
No, the board order confirmed that 2% was for non-recoverables.
But the 5% is still there on every order.
5% for management fees?
Yes.
2% for non-recoverable expenses. We've removed the 5% management fee. All of this is agreed that the 5% is recovered as far as a management fee. They have now equated that 5% to be other expenses related to management.
No, what they're saying now is it's just a recoverable fee. And nobody's calling it management anymore. You stop calling it management. They don't call it management.
Management related.
They don't call it
These
that.
are one of the things that I was trying to ascertain.
We're calling it a non-recoverable.
non-recoverable.
It's a non-recoverable, it's not recovered,
And-
even with tenants on mat leases.
So,
But
Mr. Chair.
hold on. You're saying the 5% that you're seeking is still related to the management outside of the traditional fee that's recovered.
It's got nothing to do with okay, there's management fees, which is what we're agreeing, they're recovered on net leases. You've got these ongoing, the 4 items that I referred to.
Management-related costs.
Non-recoverable, yeah, exactly, because if you're not leasing your building, you're not managing it properly, you're gonna get fired. So leasing commission being one of them, advertising, marketing, these items. So non-recoverable, which we're suggesting has always been the intent to be off. So
Yeah,
that's,
we're-
but we are agreeing the 5% management fee that management companies charge and then collect back, that's recovered. There's no debate about that.
Okay, good.
That's
it. I think we've been good there for a while. So, back to your question, what you're stating is that 5%, you're equating that equal to what the town's representing there. Is that, am I hearing that right?
That's the way I'm hearing it. Did the community board at one point actually took it and dropped it down to 3% because they disagreed with the
So
board?
in certain instances.
So they
if
made
there
an
was-
adjustment.
If there was singular,
Because there was a recovery.
no, I guess at one point in time, it was if you had a single tenant occupied, there'd be less management.
Yes.
So you get 3%. And then if some orders indicated that if it was recovered in full, they wouldn't charge that. And that's the essence of what we presented here, the recovery of that fee that you see in the orders here. We're seeing that's recovered for the majority of the market, predominantly for the marketplace. We're not in disagreement on that. Now that it's fundamentally come back that there's extra management related costs that were never in our fee that we were charging.
But the province still uses it with their assessors, do they not?
I believe so.
So the 5% is still there.
Yeah.
Okay. I've got no
They're
further
fundamentally two different things. When I'm looking at it, and I'm just making it clear, when I'm going through the orders, and I'm just looking at it from my personal perspective, independent of management, TIs aren't included, free rent isn't included, leasing commissions, leasing incentives aren't included. Not only are they not included, they're not included on the expense side, and they shouldn't be included on the rent side to reduce the rent. Fundamentally, what it's saying is, we're not using that information, although it exists, we're not using that information to reduce income or increase costs to determine the market value. Once you get that, and once you see that, you shouldn't be included in any line item. Here. Should be used.
Thank you, Mr. Chairman.
Requirement for summary?
Thank you very much for that. Interesting.
I sum it up.
It was nice to revisit it.
Our rent was a little low. It's out of line with market. I put it back in line with market based on comparables.
Okay. All right, that concludes
Break.
Break, yes.
447 Portage Avenue. We'll take a 10-minute break, please, Michelle. Take a 10-minute recess.
Sounds good to me.
Okay. Thanks, Michelle. I will now call the hearing back to order. Next property on the docket is 220 Portage Avenue. Michelle, could you swear in Mr. Story, please?
Can you state your full name, please?
Sid Story.
Do you swear that the evidence you're about to give at this hearing is true, the whole truth, and nothing but the truth?
I do.
Morning, Mr. Story.
Morning.
Okay, next property is 220 Portage Avenue. We're dealing with a 2020 realty assessment. Mr. Pohl, when you're ready, please.
File number is 194837. The roll number is 120930151100. Address is 220 Portage Avenue. 220, the 2020 assessment is for $27,594,000. The building is a 17-story building located at Portage and Maine. Built in 1965. We have an effective year built of 1975. The leasable area is approximately 177,000 square feet. There is no parking. If you look on page 21, is an aerial photo of the property. So it's right at Portage, just off of Portage, Maine. Got a few pictures there of what the property looks like. Getting back to the analysis.
Did you say page 20? Sorry, Jim.
Sorry, it was on page, pictures on, starting on page 21.
Page 21.
21, 22, and 23. We have an aerial plan view of the property just off of Portage and Maine, corner of Portage and Fort. And then the other two properties, backlights, the different side views of the property. Okay, so getting back to our analysis of the property. There happened to be a sale on this property on page 2. It was a half-interest sale for $20.5 million. Sworn value was $41 million. That value was reported to land titles, but also on page 3 is the artist REIT announcement to purchase the property. On page 4, it was bought. The reported purchase price was $41 million, underlined in red. The artist REIT purchased a new number of properties. They used a weighted average of 6.4% for capitalization rate. So, highlighted blue, artists will purchase the 100% interest in the property, 2 separate 50% interest transactions closing concurrently. So, 2 separate purchases, half the interest come up into full ownership. So, on page 5, for the acquisition, reported it on point 3 highlighted in blue for 220 Portage Avenue. When I looked at it, I looked at NOI of $2,175,422 with $41 million purchase price. Of course, it'd be about 5.3%. And then artist reported a 6.4% capitalization rate. So, the following page is our 2012 INE leading up to the sale, which is where I get the net operating income from at $2,175,000, which is line 218 on page 6 of the INE. So, and then that's just the INE in full. Once we go through the INEs that we looked at, it's stable. So the sale, it's $41 million. Capitalization rate reported at about 6.4%. Assessor derived specifically based on the INEs for the net operating income that we were given leading up to the sale at 5.3%. On page 13, our OFB comparables. And on page 14 on the other side, these are the same set of comparables that's been reported. So there's no changes to them. that I presented, is for 373,000 square feet approximately of inventory. The average rent is $14.96 a square foot. The weighted average is $13.99 a square foot with a median of 14. So again, a very tight range. Below that is the Cushman Wakefield's Q1 2018 report leading up to the reference date for Class B buildings in the business district, center business district, of their average net rent being $15.31 a square foot. On page 15, highlighted in blue, is the Johnson report. You can see the vacancies reported for Class B space and the associated asking rents: 14, 14, 12, 16, 1650, 1750, 17, 10, 20, 1025. For 220 Portage, there's 48,000 square feet of approximately vacant space, and they're asking $17. As far as our analysis, that will be on page, the actual income stream, that's on page 16. We have $177,770, or say that, 177,770 square feet, with an average rental rate of $12.86 a square foot, which produces a potential gross income of $2,285,936. Our standard parameters apply: 9% for vacancy, our 2% for non-recoverable expenses, and our shortfall $11 per square foot, which is on page 17, continuing on to 17, produces a net operating income of $1,862,606, capped at 6.75%, gives us our value at $27,594 rounded. And again, there's only one income stream. There's another summary on page 18. So for our capitalization rates, page 19, for OFB, in our downtown, we're using 6 3/4. Colliers is reporting between 6 1/4 and 7 1/4. CBRE is reporting 6.5 to 7, and Cushman Wakefield 6.25 to 6.75. So we're right in the window of where we should be reflected in other independent outside sources. Over on page 24 is the start of the income expense questionnaire that was submitted for this cycle. Blank, although they submit their income statement, as artistry usually does. As you see, the rent income, they don't start with a PGI and take off vacancy. They just start with the actual reported rent. There is some vacancy in the property as we speak, so the reported income is down. The recovery management is being recovered, as you see highlighted. The rest is just the I&E that was submitted. So you get to page 41, that's just the rest of the rent roll. And the vacant area shows up on page 41, I'll just read it when we get there. So the total occupied area is about 81,000 square feet. Vacant area is approximately 89,000 square feet. They're reporting a total area of 170,639 square feet, so not too far off of our 177,770 nominal difference in change that does happen. Advertising for the property is on page 42. Artistry does a good job of putting in, they're a sophisticated owner, obviously. Of putting in their portfolio for properties that they manage and own. So 224 as reported as such, gives you an overview of the property. So 43, 44 pictures of the property, and this is straight off their website. 46, 47. So go down to page 52, upgrades for 2017. LED-based lighting, HVAC is zoned for tenant comfort, CO2 monitoring for fresh air, windows and window coverings for shading, modernized elevators, modernized washrooms, LED platinum certification, exterior LED lighting, and ceiling systems. So has some renovation work. It's a nice property. Amenities are as such, although those amenities aren't in the actual building. You get to the concourse area, artistry runs on additional property. So that's more of a how they manage it. So on page 56 gets to the leasing details. Their basic rent being reported as $17, highlighted in blue on page 56. Again, same as what was reported from Johnson's report. They don't have parking on this property, although $2.99 for the parking underneath the adjacent building is obviously run by artists, and no matter what artist it's available to the building. So as you can see, spaces that are ready for immediate occupancy, and comments that are how they are, whether they're base or existing, and the size is indicated. So. And a typical floor plate, which is on page 56. As far as the addendum that's attached, we've already talked to that, but I'll speak to it quickly again. On page 60, 299 Portage, or 240, 294 Portage, which is Class C building, Kitty Corner 2 in the MTS Center. I did the analysis on that. It works out to be about 5.88% for capitalization rate. And 177 Lombard, which is of course on the opposite side, behind Richardson building. Its heritage building came to 6.35%. I believe it was 6.38% reported. Assessor calculated right there. So, as far as the non-recoverables, we've, although it's not part of this appeal, we've handled it last appeal. I can address it again. At the time of submittal, these were on page 61. The comparisons that we did do for all Altus's non-recoverable information that's presented to us. Now in full, we were able to give the 29 of 31. So just that by the time that was ready, this had already been submitted. So getting back to the actual assessed value, $27,594,000. I believe about a $13 rent is more than achievable in the property, although there is a higher degree of vacancy. A lot of that had to do with Great West Lights in space. Just because a large anchor tenant leaves doesn't mean that we're going to necessarily drop your assessment down a significant amount. We would have to see a number of years of vacancy occur before we would start to consider this is merely a tenancy that's leaving. And given the fact that that was known, must have been known at around the purchase point. I'm assuming a few things here, but any knowledgeable buyer such as Artist Reef would be investigating whether Great West Light would be remaining on or not before spending $41 million on a property. So, given the fact that we are significantly under the sale of where it was in 2013, again, we're putting reference on that April 1st, 2018 reference date. Our marketplace approach for this, I think $27,594,000 is reasonable, and that's one for more questions.
Thank you. You ready for me?
Remember, I bought you coffee.
And I appreciate it.
Okay, Mr. Story, any questions of the assessor's evidence?
Yes, just very quickly. You did mention on a number of occasions that there was a sale transaction, and the sale transaction was somewhat complicated.
250% or two half share.
Yeah, and you seem to have some knowledge, so obviously you've researched the sale, you know something about it, or are these assumptions you're making?
It's straight from the website that Artist Reed puts up for proposal.
Okay, where they indicated that they had bought 50% interest
Yeah, two
and
times over.
signed an agreement with FAM, with another REIT, to buy the other 50%, subject to some conditions, and subject to some other transactions. Are you aware of any of those other transactions?
All I have is what they publicly disclose.
Okay.
As
And
you see on my
indicated,
pages.
and you indicated quite rightly that they may have paid that for it because they had a big tenant in there. Great West Life had 75,000 square feet, is that
Approximately, yeah.
you aware?
About that,
So when they bought it, there were two tenants in the building, essentially. There were some smaller ones, but Royal Bank, it was a Royal Bank building called, and Great West Life,
yeah. Correct.
right? You may or may not be aware that Artis is, one of their prime lenders is Great West Life, and one of their bankers is probably Royal Bank. That may or may not have influenced the transaction.
I couldn't.
And you did indicate that the building itself has 0 parking.
Correct.
And you indicated that, let me go to page 41, sorry. Go to page 41. On your brief, you'll see that at the reference date, the vacancy was 52.9%.
Yep, as I indicated, about half.
And in your opinion, you indicated that the assessments would go haywire if every time a tenant moved and vacancy dropped, albeit short-term, long-term, if the assessment changed. Is that what you said? Did I hear you?
What I said was we wouldn't be looking to adjust for a large vacancy due to one tenant leaving. If
Okay.
you have an anchor tenant.
Okay.
We're doing a market-based approach, meaning if this space remained vacant for a number of years before
Mhm.
it got reabsorbed, you
Yeah.
can look at it and on a more of a intermediate, long-term kind of situation. But we wouldn't be looking to adjust this vacancy in the immediate future downwards, or the valuation downwards based on a vacancy adjustment. The same way as if we looked at a building that was occupied by one anchor tenant, we would still be giving a marketplace vacancy
Okay.
on the property, so. That's more of a
But you
business strategy
recognize,
versus.
Mr. Paul, that the reason we're all here, that we come and have these wonderful meetings, is to try to determine what an asset would sell at a particular point in time,
Yeah.
which just happens to be April 1st of 2018, correct?
Yeah, that is-
And at that point in time, 52% of the building was vacant.
Right.
Do you believe that would or would not influence the purchase price?
As far as, determine
A
what market
purchase or
value would
buying
be.
it at arm's
a
length
lease-
by
a-
definition.
A leasehold value would, because there's less of a leasehold and interest in it, obviously, it would affect that. But as far as you determine market value, I don't believe that a small period of time from actual vacancy would deviate from the market value that you get for the property.
What is a small period of time? How many years or years?
Well, it would take, if you see this space being around 70,000 square feet or 80,000 square feet vacant for 3 to 5 years with no real change,
Mhm.
that's when you can start looking at it.
What if you also had this
If,
in the-
if you see this space being leased up quickly, you can see it being reabsorbed into the marketplace. You could also have a property owner like Artist Reed have a number of tenancies waiting to come into the property. It may be beneficial to have that property cleared out of old rent, lower old rent, as I'll get into my presentation as far as Great West Life is concerned, because you can put that rent back up to market.
You know,
You can put it back up to market level. Great West Life has a very good tendency of occupying spaces for a number of years. And I'll let you may or may not know, this space here, 220 Portage and at 444 St. Mary's, I've reviewed in full. I've indicated from and it's sitting at the municipal board for 444 St. Mary's. Great West Life has come in and put millions of dollars into the actual renovation of the actual space, which used to be the old decor space.
That doesn't help our street.
Just so you get a lowering of rent away from marketplace, and that was indicated in the rentals as you were going your way through. So I don't believe that this purchase price was based on the lower level rent that Great West Life was paying.
I'll ask the question once more.
So
Is the intention to determine what something would sell at a particular point in time? Yes or
obviously
no?
what we do it.
If that's the
But
case,
I'm
would
trying to
it
answer your
be?
question in full as far as Great West Life is concerned.
Well,
You can't look at it in
you're talking about
isolation.
Great West Life paid improvements at 444. I don't know anything about
My
444
point is,
St. Mary's.
a very knowledgeable investment fund like Artistry, knowing that Great West Life is your main tenant, and you see Great West Life that used to be at 333 or 330 Portage and left, and you see them coming to 220 Portage and have the potential of leaving, and you see them going to 444 St. Mary's. What you see is under market rents from Great West Life and their tendency to hop from building to building downtown, get the best negotiated rate for themselves, redevelop old spaces that are in that at a reduction of rent. It's good for the building owner. You get a property tenant coming in that renovates your space, and when they walk away, they leave that space renovated. But that wouldn't be a market rent. And when an investment group or company or such as Artistry would be looking into this, I don't believe that they would be spending $41 million blindly. I think they do their due diligence on the tenant. I think they'd realize there's a realistic chance that they'd be able to walk away from the lease. And then you have the remainder of what the market value would be. What could you get the new rent in there? It wouldn't be at $7. It wouldn't be at $11.25. I believe they jumped up to, or anything below what market typically would go for, which would be about $12 to $15 range for old fees.
Can we go to page 13 of your brief for a moment? Excuse me. These are all Class B office, downtown office buildings on your list. Are there any in here that don't have any parking?
Most of them have parking. 125 area has parking. 61 Portage is down Portage. It's included.
Or down your west, yes,
Yeah,
it's got surface parking.
Yeah, but it's way down.
Yeah, it's in your list.
330 Portage does not have parking. 330 Portage is comparables 28, 29, and 30. They don't have parking. Predominantly, though, they do have parking.
So virtually everything in here is parking.
Correct. Predominance is that they would have some form of parking.
Okay. And on the last page, or pardon me, page 14 of your brief, you have, starting at comp number 57 to 71.
Yes.
You're aware what
Yes, that's
property 530 Kenniston is?
That's at the corner of Kenniston. It's in OFB. So, like I said, we brought in our Winnipeg place.
Well, just hang on for a minute, don't jump ahead. Is this building the one that houses Denali, Original Joe's, Stella's, down the mall? It's a shopping center, is it not?
The upper floors are not.
Okay.
The upper floors are office.
Okay. And you think that particular property is a comparable?
I'm looking at office rents in downtown.
Okay. So it's only rents that are used for
I'm
comparable?
also, if you let me finish the question, I'm also looking at rents off of downtown. I'm taking a correlation of both.
Okay.
As you can see, there's not much of a drop from outside of downtown versus inside of the center business district.
So Kenniston, I'll ask the question, are you suggesting it's a comp to this subject?
I'm suggesting that an office tenant, whether they be parking downtown, or renting downtown, or be renting here, would be roughly in the $13 to $15 range, which is exactly what downtown is showing.
And just out of curiosity, looking at your page 14, where you go with comp 51 to 71, on those on those 20 comps, they're all less than 5 years, every one of them, with the exception, I believe, of 1 to 2 years. Now, 5-year leases, we'll go through them quickly, sorry. 386 Broadway, which you know that building well, I think. 3-year lease. Next one is a 1-year lease. Then you've got an 8-year lease at 386 Broadway, and then you've got a 5-year lease.
Yeah.
2 5-year leases, I'm sorry. Now we hit into Keniston. Okay, this is at, and I think it's a shopping center, that's where I live. I go by there every day. So it's just going down the list, from starting at comp 57. 2 years, 1 year, 2 years, 2 years, 2 years, 1 year, 2 years, 3, 2, 2, 2, 2, 1, 2, 2. When we're doing an analysis of leases, we would never take less than 5 years because the owners would ask a premium to take the property off the market.
I think you're not quite understanding what I'm portraying or what I'm showing. If you look at my comps 1 up until 57, 1 through 56, you see that these are all, with the exception of the 2 for comps number 2 and 3, and, oh, sorry, and 4, at 16, 61 quarters, these are all downtown office properties, correct?
Okay.
And you see the rent,
Yep.
they are.
Yeah.
And the rent range that you see at 16, 61 Portage being $14, $13, $13. And you see the rent range that is also between 57 and 71 comps, which is the 530 Keniston. You see that the rent ranges are similar, about $14, $15, $16 on average. That's what we're showing, but we're also looking at center business, downtown, north of Port, anywhere that there is an OFB space. It's in relationship, the rent rates are pretty tight. Now, whether you're telling me the strength of the cup, no, let me be real crystal clear. I brought in all the rents. I reviewed, if there's any outliers, we investigate the outliers. If there's a reason not to.
Are you saying there's not one 5-year lease in 530 Keniston? There's not one 5-year lease?
That's what the rental indicated.
Okay. And are you also suggesting that this 373 is the entire inventory of Class B properties?
I'm telling you, I searched all the OFPs from comparables 1 through to 71.
Yeah.
Every lease that started at approximately May of 16 leading up to the reference date, if there is not an identifiable outlier, meaning it's way low or it's really high, what we can identify, or it's non-arm's length, it's something with the lease, we would kick it out. The rest of them have been included.
Okay.
I'm establishing a market.
And are you suggesting that your median of $14, that came from this analysis?
That's exactly where it came from.
And I'll ask you again. You're confident there are no 5-year leases on Keniston?
Let me rephrase, let me be this.
Would say yes or no.
I use the actual INEs that we get certified as true, complete. If you have other information to indicate, if you know of the property owner, or if you manage the property, or if you have some kind of other information, I'm absolutely willing to hear it. But we take the INEs as being certified as true and complete, and that's what we base our assessment rules on.
Okay. Page 15 of your brief. This is a Johnson report?
Yeah. Did you want to touch on the Cushman Wakefield, or is that?
Not really. What would you talk about?
All right, I'm sorry.
You'd like to talk about offered rents and real rents? You want to talk? I'm not going to ask you that. I'll go back to this Johnson report. What's the date of the Johnson report?
It would be December 17.
December of 2017.
Yeah. By the time we get the actual spring one, by the time we get it, we can't get it.
And at that point, they're showing it's blue and my eyes are bad. It's showing, is it 48,000 vacant?
40,219.
Oh, it's 40,000, okay. 40,219.
48,219 at asking rent of $17, which is
Asking rent, asking rent. That's
precisely what was on there.
Immaterial. The asking rent doesn't mean anything. What people enter into means something. So there's 48,000. When did Great West Life move out? Do you know?
I can't tell you exactly. I'm not sure if it was a full, complete move all at once.
Okay.
So,
Was it in and around early 216?
I believe roughly around there, yeah.
So if that's the case, the vacancy is carried on to December of 217, and actually its reference date, it was at 55,000, right, 55%.
I'm not saying there's no vacancy.
So the vacancy's been around for 2 or 3 years, is that correct?
About a year and a half or so, given.
And are you aware of the new Royal Bank rate that they renegotiated their lease at and what they paid? It's all over the street, so I'm assuming.
I don't look at I don't actively look at post-reference
It's not
information.
post-reference, it's a lease from 1999 that was rewritten at a lesser amount. Are you aware of that?
No.
Okay. And are you aware what Great West Life were paying when they left?
I believe they went from a $4.75 rent at the initial starting point when they were in the league. This is going back.
Yeah.
When they took over the core space.
Mhm.
That was challenged. The municipal board that actually went to the Court of Appeal to determine whether the review of the municipal board order was correct. 5 years later, the second year, the following cycle was heard for 2008 with the municipal board. So it goes from $4.75 up to $7.25, and then I believe it jumped to
$11.32.
$11.25.
Yeah, so right now, or when they left, they were at 11.32?
We had $11.25, but
Yeah, no,
close.
close enough, okay. So there is a history of vacancy over 2 years. If you go to the current date, it would be 216. It's over 3 years, going on
I
4
can't
years.
tell you how long
So-
it would take for them to move out their space. They had 70-some-odd thousand square feet. It may have taken them
70,000.
organizationally, it may have been up to a year to move out of that space. They may have been paying rent on it, I'm not sure.
So we
It's
know
not a
that
small tenant.
we know that they vacated, or at least gave notice that they were vacating some 3 or 4 years ago. And the property still is maintaining a 50% vacancy, is that correct?
At the reference date.
And we're going into something called a shift to quality. Shift to quality meaning that the class Bs and Cs are at some risk because the As are dropping in rates. Are you aware of that?
That's what agents keep telling me.
Okay, well,
The marketplace,
and you don't think that's the case?
the
The marketplace is strong.
I work with a series of knowns. I don't look at a series of events that are expected to occur
Okay.
or may or may not occur.
And were you, I can't remember if we did this together
We've done a
last
lot
year.
of
Did we
talking.
do this last year?
I
Was there an appeal last year, do you recall?
I'm not sure, I may have been. You're catching me on that, I deal with a lot of appeals, I can't remember
Okay.
any particular one.
Well,
Maybe.
Mr. Story, you could deal with that when you're evidence if you wish.
yes, no, I'm getting this. Didn't this much. One thing now. And just talking about tenancy, in the reference period, which we treat as the 2 years prior to the reference date, did you do a review to see if there were any new leases signed in the building?
If you look on my page, maybe I passed over it too quickly. 220 Portage,
Mhm.
comparables 15.
Which
through-
page? Which one?
15 through to 20,
Yeah, which page?
page 13. 220 Portage, $16, $13.78, $15.50, $17, $15, $16. For 1, 2, 3, 4, 5, 6 CRUs. And the CRUs range from 3,500 to, down to about 1,200. So yes, I did look. It's consistent with the average of what they're asking for, just slightly underneath it.
So if we look at these leases, all these leases are relatively small square footage. There's nothing comparable to 75,000 leaving. The biggest one looks like 3,500 square feet. Okay. Those are my questions.
Thank you. Marla, any questions of the assessor?
No,
Marcel?
We don't know when the lease ran out on Great West Lake, do we?
I'm not sure.
I couldn't see the year.
No, see, like I said, they took over it's going back a number of years, I'm well versed in this property.
Yeah.
Great West Light took over the old Core lease.
Yeah.
It was basically subtenant at that point. At
So
that
part of it was paid by Core and then they took over the.
We're not sure ever, but I mean, basically it went to appeal, and all this, the former agent, the late Dave Saunders, indicated the best market price, and I have the order here if you want to read it, I'm sure I've submitted it before, but basically, they wanted the actuals. And this board said, no, we're replacing the lower leases with market value, so they put it in with market value. That appeal, although it was, the order itself was light in explanation for the 2006 level of the appeal, was challenged to the Court of Appeal based on 2 points, the capitalization rate and the rent rate. It was granted leave to review the rent. The capitalization rate was mixed facts, it wasn't allowed. So they were determining whether they should be using the municipal board erred on whether they should be using the rental rate, the actual leasehold interest, or the actual marketplace value. When they went through it, the judge and the board indicated was the municipal board has the right to make that call, that decision, but what they looked at was the adequacy of the actual order in context of everything. Everything submitted by the appellant, by the tax agent, with the municipal order, the order that came from it. In context of everything, they handled it right, it was correct, and they did have that. There wasn't the call that the judge made on whether there was right or wrong. That was preserved for the valuation perspective from the municipal, but they had final say on that. The adequacy admitted the ruling wasn't as great in the ruling as maybe it could have been, but all things being taken into account, a reader could easily discern why it was done. It was a good order, very well, not without, I can't remember how they exactly phrased it, not without,
Prejudice.
no. Yeah. They're adequate, not without, but, and the result arrived by the board, meaning this board, clearly means that it did not accept the lease evidence on market rent, meaning the lesser rent, that the appellants put forward, and instead relied upon, but not savagely, the comparables advanced by the assessor. So basically, it was a good ruling, and everything in context, that the board had the authority to make that call. So it wasn't, at that point, a determination from the Court of Appeal to change that. It was merely the overall encompassing evidence. How did they rule? Was it adequate? A little light, but still okay. So, back to the history. So what we see when we go in, we were dealing with 444 St. Mary's, where Great West Life went to from 330 Portage. I talked to Great West Life. They indicated that they took over the agricultural space. They spent millions of dollars in 220 Portage and had a lesser rent because of it. And then that rent escalates back upwards, pushing market, but never actually at market. And the same thing for 444 St. Mary's. Margaret had, when they moved to 444 St. Mary's, they had $8 rent initially, and they spent just a little under $3 million on the space to update the space. Morgan reports their ticketed rent for that property about $13. When we did the analysis on that property, exclusive of taking away the space from the Great West Life, the building was performing just under that. So then when you see an actual $8 rent put in there, it really sticks out with a sore thumb, or that can't be. What's the reason? The reason why is because it came in at a lesser rent. It's a tenant inducement, basically. You come into my property, you can renovate my property. Okay, you may walk away, but you're going to leave that space the way it is. You pay for the renovation of my property. I'm getting lesser rent, but that risk is absorbed by the tenant. That's being heard for the business assessment side of it for that year, for 2014 at the municipal board, although it's been delayed until the spring because I guess we need to. So when I'm looking at this, these leases aren't they don't have anything to do with that. My main question was, being a sophisticated property owner, Artist REIT, would they have known that Great West Life is leaving? Would they have known Great West Life is leaving with that lesser rent? So they would have to absorb some of the cost of vacancy occurring, but then they'd be able to get rents back up to market at 16, 15, 15, 17, 15, 16, and 13, 17. So as a property owner, you see room for improvement. Okay, I'm gonna buy this property, it's a period of vacancy, but that old major tenant who's paying old rent not at market is gonna be gone. I'm gonna absorb it for a few years, and then I'm gonna start pushing the rent back up. And that's what I see happening here. So, when Great West Life was leaving, when they were actually out of the building, was it a phase taken? I don't have that information.
No other questions?
Thank you. Okay, Mr. Pohl, have you been in this property?
On occasion, yeah.
Okay, so is this this Great West Life area, is it subdividable?
Yeah, it's just separate CRUs. It's not like it's one CRU.
Oh,
You just
okay.
take up a majority of.
Okay,
Several floors.
yeah, okay. All right. that's-
Sometimes you'll get a floor plate, you know,
Yeah,
or some buildings have common open area for your higher end rents, and in some of the phase where they have almost the insurance effects where it would be more of a three-plated floor, or whatever the case may be.
so this vacant area is a summation of all these different units that are currently vacant. Okay, that's my only question. Okay, Mr. Story.
Yes, thank you, Mr. Chair. This will be very quick. Our statement of issues. Number one is we want a market rent of $12.85. We have a decision from this board a year ago at $12 a square foot for the same property with the same vacancy at that time. There has been, Mr. Pohl is right, over time, we hope the building will get regenerated and it might be slowed down a bit by the additional supply that's come on the market, that is coming on the market without any additional obvious absorption. But, so we're asking for a $12.85 market rent on the property, as opposed to the assessment. And the cap rate awarded last year was 7%. And we're looking at the cap rate in Colliers at 7.25%. And we're saying that the continuous vacancy is now going into its fourth year of vacancy. That in itself justifies the extra 0.25%, but the 0.25% is also what Colliers show us in their information. So, Mr. I saw you're looking at your, so I'll go through the brief now, but I just want to summarize by saying we're looking at two things today. Cap rate and...
You're at 1285, you said?
Yes.
The city's at 1286.
Pardon me?
The city's at 1286 on average.
I didn't increase the rental rate.
You didn't raise the rental rate. You got the rental rate at 1286.
Let me check my brief. Okay.
You're bang on both of you. Same amount.
Yes, we just...
The only difference is your 5% and your
5%,
cap rate.
we request a 5% increase,
Yeah.
of course, because that's how the market operates. All the 5% is over the life of a building, there are going to be certain costs the landlord has no way of recovering. And accounting theory tells us that you have to recognize that, it affects value. So there isn't, I don't think that's a big issue. The 7.25 is the cap rate we're asking. That's reflected on our page 31 of our brief. That's the Colliers report at 7.25. I think 7.25, given the massive vacancy in this property, plus where the market is overall, is low. So that would be my request. 7.25.
Okay, for the record, Mrs. Story, what's your value you're asking for?
$24,256.
24,256,000.
Yes.
487.
Okay. Mr. Pohl, any questions of the accountant?
Yeah, you represent Artist REIT?
Yes, Dave.
A number of them are on the docket today. Artistry is a very knowledgeable, sophisticated property management owner.
I believe
Purchaser.
that, yeah.
Okay. They purchased this property in May of 13, approximately. They also purchased the remaining interest that they had, I should say the 299 Fort Arcade earlier in 2012.
Somewhere along there, yeah.
They also purchased 191 Pioneer and 333 Main Street.
Correct, yeah.
Downtown OFBs. They have 275 Portage, right, and
275 Portage owned by Leo Chilakis.
Sorry, my mistake. They
Great exchange?
360, 363 Osborne. Is that also owned by Artistry?
365, oh, sorry, yes.
Okay. So, in around that time, you're moving into the purchasing of downtown OFBs, office spaces for downtown, correct?
Purchasing, talk up a little bit, we can't hear.
Sorry, they're purchasing, an investment firm is purchasing downtown property, office property.
That's the
in
business
Portage.
they're in, correct.
Right,
They take
so-
people's money and invest it wisely.
Wisely, okay. In around that time, we've heard a lot of talk later on about True North putting up their OFA property. At that point of purchase of this property, these properties, Artistry moving into the marketplace here, it would have been known to sophisticated investors such as this, that the Chipman Group purchased the land next to the MTS Center, correct? And they would know that.
You make a lot of assumptions.
That would be.
I don't know that, but are
A
you
prudent
saying that?
investor for downtown marketplace such as this would be
Yes.
fully aware that there would be an upcoming competing office building on those two sites. There'd be a developmental plan coming next to it.
Possibly, I don't know. How would you assume that? How could you assume that?
Would you
That they
think
would
that they
know,
would-
you don't know what they think, they've got
Do you
people.
think that those two lots would stay basic, or the one lot would stay a parking lot, the other would stay a hotel?
Well, as I recall, and I was very much involved in this, the early conversations were hotels. They weren't Class A office buildings. You don't build, the normal marketplace doesn't build 15% more space when there hasn't been absorption.
Right.
For 5 years, there wasn't one new lease in Class
If I'm
A
allowed to
space.
continue.
So I'm not gonna sit here and argue with you whether or not the people are competent or otherwise at Artis. They're extremely competent.
And they wouldn't
And
see
they-
competing
they
property
were-
on the
they
verge of
were-
development, which would affect their properties.
They
if
were
chose to move in.
motivated, you could ask a reasonable question, there could be, wouldn't they be a motivated purchaser to buy 220? And of course they would, because I'm now in 220, I used to be a tenant of Artis in 360. They did a massive reconsolidation for CRA, and all of Artis have moved into 220 Portage, post-reference, but they're there now. Fair tax is in 220 Portage. I preferred to be over there, but we moved, and they were motivated purchasers by having the parking lot, Winnipeg Square, 360 Main, and 220. That was
They're
Portage and
basically
Main.
buying
They
up.
love to own Portage and Main.
They're basically buying, and that's my point, we have a large
yeah,
sophisticated buyer
yeah. I
buying
don't
up
get
all
your
these
point,
office
though.
properties, knowing full well that the organization down the street,
Yeah.
next to the center, bought two sites and we're gonna develop them into competing properties.
You're
And yet
also-
that didn't stop any of these purchases, right?
Well, they had, when they did 191.
Are they just having a debate here, Mr. Chair? or
I don't
they-
understand this.
My
Why
point-
are we arguing about whether they know what they knew? I don't know, I'm not artist.
My point
Rack
is,
them up a little bit.
my point is the scariness of what's gonna come didn't influence prudent investors.
You don't know that. How do you know that?
Okay,
All right,
Good God.
okay.
all right, so getting back to the rents in place. We're not asking for an increase, our rents are basically the same, there's no issue here, but you did review the rents that were being leased out at and around the reference date of the subject property.
Yes.
So you see several market rents at 16,
So,
13.
Mr. Pohl, he's agreed.
He's already
with
agreed
you.
with your number.
Agreed to it.
He's agreed with your 1286, at least 1285.
On your page 2 of his workup, he's at 1285, so.
We're just cap rate.
Yeah, we're just dealing with
We're
five
cap rate
percent.
related to
But
vacancy.
And the
cap,
5%.
but cap rate's
And the
related
5%.
to risk, and that's what I'm getting back to. Risk is accounted for rental rate, risk is accounted for vacancy as well. So when you were talking capitalization rate, that's what I'm trying to get back to. You see a market rent of several rents averaging $15.55 for taking up that space. You're not seeing 13, you're not seeing 12, you're not seeing 10.
We are seeing 12. You are seeing 12, but we've already agreed on that.
I'm
But
seeing
most
the actual
companies-
rents that were in place, contract rents, the leasehold interest of those rents that were in place.
So you're trying to
They're-
rate that,
They're
relate
average,
that to
they're
the
higher than what we have.
cap rates?
Yeah, what
This
I'm
is cap
saying
rate.
is, you shouldn't be adjusting the risk downwards when we have our rental rate where it
Shall I then present my rebuttal on market rents?
Well, maybe answer the question. He's asking you why you think 7.25 is
Because
more.
Colliers are telling us that that's what Cosby offices are, that's in my brief. And I'm telling you that the market hasn't improved over last year. Last year was at 7%, I believe it's declined because there's more supply in the market. They signed an extension, they rewrote a lease at $12 a square foot. That's the Royal Bank of Canada. They bought the building because it had two quality tenants, Great West Life and Royal Bank of Canada. And that's where you'll see, that's the difference between lease fee and fee simple. It's got value to it.
And that's getting back to the risk at purchase point in May of, June of 13, May of whatever the contract was signed. We see assessor derived capitalization rate of 5.3% and an artist reported of 6.4%. That's with the older rents.
No, but they're generated by the assessor, you're
So
making
now we have a bit of a
assumptions.
vacancy
Okay.
that will be absorbed
bit of a
with
vacancy.
higher rents that are put in place.
Okay, yeah, we've covered this
Did
already.
you say a bit of a vacancy?
Okay, no, we've covered this
Period of
already.
time.
That's his opinion. Okay, anything else, Mr. Poole?
No, I think I covered it.
Okay, yeah, I think you have.
Are we, Mr. Chair,
We're
are
still
we
asking
carrying
you
forward the
questions.
argument on the 5%?
You already
That's the
put
last
it.
hearing?
Yes.
Yeah.
You're at 5?
5% non-recoverable.
Okay.
Whatever
We've-
decision you make on that, we'll
We've
carry
got,
forward.
we've got
Yeah,
your
we've got your
information here.
evidence
Yeah,
presented.
because we were on the,
Yeah.
we were on the docket.
Okay, so any requirement for somebody? I think you've summarized well, Mr. Poole.
No, I've summarized enough, and as far as
Yeah.
I think we went over it.
Yeah,
with-
fair enough.
with all.
Enough.
Okay, yeah,
Enough.
and Mr. Story, you're done. Okay, so we've got 5 more properties on the docket. 1, 2, 3, yes, 5. We're gonna take a 30-minute break. So we will resume at 20 to 1. Okay. Where's that? So we're recessed for 30 minutes, please.
Very good, sorry.
Lordy, lordy.
191 then?
Thanks, Michelle. I'll call the hearing back to order. Next property on the docket that we're gonna deal with is 191 Pioneer Avenue. Item number 5.
File number is 194179. Roll number is 1209385750. Property address is 191 Pioneer Avenue. The 2020 assessment is $17,832,000. It's built in 1974, 13 stories. The gross floor area is 124,000 square feet. Leasable area is 106,000 square feet. There is no parking. There are no recent sales. I did not investigate the 2006 sale. That's too far out to have any meaning for here today. Comparables are the same comparables that we went over the prior appeal for 220 Portage. On page 4 is the summary again. Average $14.96 a square foot, weighted average $13.99 a square foot, and a median of 14. Again, Cushman Wakefield report for their average net rental rate is $15.65 per Class B in the CBD district. Page 5 shows 191 Portage on the Johnson report. Although it is 100% occupied, they still list it there. There's no discernible information that you can get from it, other than that it's fully occupied. Page 6 is our workup, but I can go briefly through that now. For approximately 106,175 square feet, we have an average rental rate of $13.82 a square foot, for a potential rent of $1,467,546. Our PGI is reduced by our vacancy parameter, put in at 9%, which lowers its effective gross income down to $1,335,465. Expenses are at 2%, shortfalls at $11. Yields our net operating income of $1,203,645, capped at 6 3/4 gives us our $17,832,000. That's our workup. Page 7 is just another summary of it. There's only one income. On page 8, again, our OFB, we're using, it's on the office section, which starts at the top left-hand side of the graph, or chart, I should say. We're using 6 3/4. Colliers is reporting between 6 1/4 and 7 1/4. CBRE is reporting between 6 1/2 and 7. And Cushman Wakefield is reporting between 6 1/4 and 6 3/4. So we're in range. Photos of the property on page 10. As you see, this is the one Pioneer. Page 11 as well. And page 12. This is owned by Artis REIT. Page 13 is advertising for this property. They consider a bill MTS building. Bill's the main tenant, the only tenant. They call it building 1 and 2 for 333 Main Street and 191 Pioneer. So here's some photographs of the property. They don't have separate listings. They basically run it as one economic unit. So, if you look at page 16, typical floor plate of the property. They're indicating $16 rent. So if we skip ahead to the page 18, which is the I&E, again, they don't fill out the I&Es, but they do submit income expense question. They do submit income statements, which starts at page 20, 21. So we skip ahead to page 23. In 14, running to the end of 16, they report rental rate of $14 net, and then they also report after that, starting into 16, rental rate of $15.65 a square foot. The following page after that, 24. The report, no vacancy in the building, it's 100% occupied by felons, yes. So, the end of the page is the addendum that we've already discussed, connection 294 Portage and 177 Longboard, both being at around just under 6% for cap and just over 6% for capitalization rates. So based on market parameters, I should say, of projecting a rental rate for this property and at $13.82 a square foot, which is a tad above the level we see, within range of what we see. We feel that this property is fairly assessed. The weighted average is $13.99, so right there. So $17,832,000 is the value that they should be maintained today. And with that, I don't have any questions.
Thank you, Mr. Pope. Mr. Story, any questions of the assessor?
Yes, just briefly. If you go to page 3 of your brief again, we talked about it briefly last time. And this is the document, these are the comparables. And you did indicate a moment ago that there is no parking at the subject, is that correct?
Yes.
Yes. And we did talk about this list of some 71 comparables that you've used, and with the exception of 311 Portage, we think they all have parking, is that correct?
Correct.
Okay.
Predominance is that an OP does have some form of parking. Some don't. 330 Portage doesn't.
Well, 330 Portage is commonality ownership of Parquet, is it not Eaton's Parquet? 330 Portage, you said? Newport Center?
They sold it, did they not?
They might have sold it, but it was, at one time it was part of an economic entity, right?
I couldn't comment on that.
Okay. Okay. So basically, everything in here seems to have parking, and that would may or may not affect the market rate, correct?
Yeah, but Artist Reef does own Parquet at 299 Ford.
That's across the street.
I know, but right across the street. So, I mean, given the fact that
Well, the only one on Lombard too, but.
given the fact that they own the principal Parquet for right at Portage and Main,
Okay.
and we're talking about office properties that are surrounding that Parquet,
Okay.
you could say that they have, off-site, they have control and interest of
Okay.
Parquet that be available to tenancies.
And we talked about it briefly before, and we'll just touch it quickly on page 4. These 20-odd 530 Keniston, which is, I believe it's a shelter property, is it not? And you're suggesting that all these 1- and 2-year leases are that's what they sign in that building?
That's what's reported on the income
I
expense.
find that so strange. But okay.
Why?
So these are the offices in the small office building, it's primarily a retail center.
On the main floor, yeah.
Yeah.
On the
Main
upper
floor?
2 floors, no. On the upper 2 floors, it's predominant.
Oh, yeah, but the main floor and the parking and everything is all retail.
And on many OSB properties, the downtown properties, you have an element of retail on the main floors.
Yes, you have some lovely properties downtown. 363, I was there yesterday, went for a coffee, 363 Broadway. That's a Class B building, correct?
They're all Class B.
And it's got a Bank of Nova Scotia, Tim Hortons, UPS. It's
Yeah,
got
yeah.
underground parking. How does that compare to the subject? Superior or inferior?
As far as quality for
Yeah.
park, or I mean directly with relationship to parking?
Well, it's as a comparable. If you had to make a comparable adjustment, would you bring it up to 110, 191 Pine?
They're fairly comparable with the exclusion of parking.
The amenity, but there's also a bank. Are there any amenities at all in 191 Pine?
I don't believe the tenancy for this particular property would be affected whether there'd be a Bank of Nova Scotia there or not. Most of the people who would be renting out of that property at 386 Broadway, I doubt are clients of Nova Scotia. No one's gonna change their banking just because they happen to be employed.
No, but it's an amenity. You get rental rates because you have amenities. Amenities means you can go get a cup of coffee at Tim Hortons or Starbucks. You can't at 191 Pine.
A lot of business offices have coffee makers. We won't necessarily-
Okay. Touche.
I think we have one or two in our building, I'm not sure. I
Okay.
tend to drink it.
All right.
You might be right.
Okay. Anyway, I just found it curious that the way you did those comps.
Just to clarify, I'm taking all of the Winnipeg, both beef. That's what I do. I take all of the particular property type classes that I'm looking at.
Yeah.
I'm taking a broad look, whether they be in this downtown business district or they're outside, and I'm looking at a relationship. We're coming up with a weighted average, and then you can look at every, and that's why I have them the way that I have them. They're per building. You can isolate and see how the individual property is performing based on the comparison within the internal comparables versus the rest of the comparables, and even if you gotta go outside downtown. And it's mainly to show that we're not picking higher rents. We're not choosing a few handful of rents that may be higher than what the market is. I'm bringing in the market entirely.
But they're not all the leases. These aren't all the leases in the B-class building.
These are all the leases that leased up from May of 16. There may have been a handful of outliers that we looked at that we disregarded.
Okay.
And that's
So
similar for
just
every
to
property
recap,
type class.
let's
And
cut-
that's similar for every single property type class that I'm bringing in from the office section. I review the office section's rental rates, top to bottom for every property type class. This is the format that we're bringing in so that we can show the panel the actual marketplace. So that you don't have a handful of comparables from the assessor and a handful of comparables from an agent, and you really still can't make out what the market is.
You're aware that the same lease is in effect today as was there last cycle, or last assessment cycle?
Oh, yes, yes.
Same tenant, occupying the same
All the
space?
same.
Yeah. Same building? Any upgrades that you're aware of in the last 2 years?
Not that I'm aware of, no.
Okay.
I
So the $64,000 question, this for Jeopardy. How does
take
this building-
63,000.
How does this building appreciate by $5 million by assessment from 218 to 220?
As far as, are you asking me what the Board of Revision decision was from 2018?
No, I'm saying, well, I can tell you the board decision.
We don't compare assessments. We don't compare assessments from one cycle to the next. We do take rationale from this panel and municipal board level and any higher level physical characteristics of what's deemed to be accessible, what's not deemed to be accessible. We do take that information in, but once we do a reassessment cycle, we rerun the numbers with the market information that we have. So if there was some space in here that, through appeal process, through discovery that was deemed lesser value or no value, we would maybe make an allowance, we'd take a look at it. So we can put weight on that.
Are you aware of any pending vacancies in any of this building or the neighboring building?
I'm unsure of that, no. I don't.
You're not aware of any major?
No.
Okay.
All
Are
we
you-
get, is what the rental, you represent the property owners, you may have internal knowledge that we don't.
Okay. Well, this has been in the newspaper quite a bit. No, I'll do that. Shit.
Sydney.
Sorry, I never do that.
That's why I don't have a home.
Those are all my questions, thank you.
Thanks, Sid. Marla, any questions of the assessor?
No.
Marcel?
No.
And I have no questions either. Mr. Story, when you are ready.
Issues, what are the issues for today? Number one is market rent. The market rent, we're suggesting, should not be $13.82 a square foot, but rather $12 a square foot.
So we're looking on page 3, Mr. Story?
Yes, page 3.
Okay.
Just going to recap for you.
Okay.
2 issues. And the second is a cap rate, where we're suggesting that a property of this nature with no parking would be at the higher end of the range of cap rate. 5 1/4 is what's, pardon me, 7 1/4 is what's suggested by Colliers. We concur in that regard, and we're asking for a 7.25% cap rate. We're asking for a value of $13,422,863, as opposed to the assessor, who's at 6 3/4 and $13.82. Just of,
You also added the 5% back in.
yeah, we have 5%. Correct. And the owner's. Flip ahead, do some pictures. The rent roll shows a 1565. No vacancy, of course. Page 14 is the Colliers, clearly 7.25%. If you go to page 12, you get a smattering of leases in some of these A B buildings. They're odd leases for the most part. The Bell Canada is mentioned, it's at 1280. The reason being there's some of that space is being forfeited. It's being offered to the market for sublet for the last couple of years. I'll bring that up in the next file. Pattison Group were the only other tenant initially at 333 Main other than MTS Bell. And Coordinated Management is a law firm in 220 Portage. It's 1031. So I just want to show that they're all over the place. Go to the next page. This is how the models have been over the years. 191 Pioneer. The assessor is suggesting 1382 at this time. The 218 model was 1118. Vacancy 9, 6 3/4. By virtue of decision, the cap rate on this property last year went up to 7%. Again, page 14 is 7 3/4%. Page 15 is the decision at 12,666, and I have the decision broken down because they didn't give much information there. But there's a decision. And again, we're looking forward, and perhaps shouldn't be, but some of the new developments that are happening downtown, when we talk about True North primarily, are reasonably attractive and will make it more and more difficult for these older buildings to compete, we believe. So we're suggesting a 7 1/4 cap and $12 as a market rent. I have a little bit of stuff here.
Sorry, what is this in relation, is this new evidence or is
What
this
is
just
the issue?
for border division?
Oh, no, just the decision. No, just how the decision was arrived at, because they don't say, last year.
Okay, so,
This is a decision.
and you have the decision in your
It's
order.
attached, yes, yeah.
All right, I'm not gonna.
It's page,
That's okay.
Page 15 is-
I'm not gonna say it's no, technically it is, but I can get enough that I can get off
Yeah.
the page. That's
Yeah.
simple.
yeah, it's a,
Yeah, you're referencing an order that's there, so.
yes, correct. And with that, I will be open for questions.
Okay, first thing that sticks out in my mind, you're indicated, and just so we're clear, that lack of parking would be considered a risk, so that's your main.
Yes, first of all, what happens is a tremendous, and this, we've had that experience, you were involved with me in the parking lot for 360 Main. If they can deal with their parking and make parking part of the base rent, even if it's 1 or 2 cars, generally they can get a better rent lease signed. So it's kind of generally understood that the rents will go up with proximity parking.
Okay. Well, my next question leading into that would be, this is a single tenanted building,
Yes,
and it's a fairly long-term lease. Started in 2006 and it ends in 21, 15-year
correct.
lease.
Yeah,
And yet, with no parking over 15 years, I had no problem leasing that.
single tenant, it was going to be leased up, it was
Right,
built
but
out for them. That's a build to suit. That $15.75, the lease rate, was the cost to prepare the space for their use, their specific use.
My point is, there is no parking, and yet they have 100% occupancy over 15
Well, I'm
years.
suggesting that maybe they would have had, let's say strip out the build-outs, let's say the actual rent was $11 a square foot, they probably could have got 12 if they had parking, but they don't. They don't have parking. Or amenities, for that matter, there's no gym or.
Can you turn to your comparables? On your page, on page 12,
Yeah.
So there you have 4 comparables, two of them are in each in one building, correct?
They're in the buildings that are under
Right.
appeal today. Yes.
Right, so that would be contract, well, I mean, 220 Portage is definitely not under this building, under this roll number or the associated roll
No,
number.
no, same owner, that's all.
But what I'm saying is, you really don't have many comparables at all.
No,
And the
we have
range-
the lease and we have the
And the range
marketplace.
that you have is between 785 to 1450, so it's basically a 100% increase in range.
On the range?
Yeah, well, you're
Yeah.
going from 785 to 1450.
Mhm.
So that would not necessarily be, in my opinion, a range that is indicative of determining.
No, it's to show where leases are all over the place in these buildings.
Okay.
And one would assume that there'd be continuity from the previous cycle to this cycle.
So,
The lease is still 1575, including build-outs.
getting back to contract rent,
Yeah.
we're to determine what market rent is and not use the leasehold interest in a particular property, so no contract rent.
It
That's
is
what-
contract rent.
Right, but by the municipal warrant order at 220 Portage, you should be aware of that, because that's under appeal today, or that was under appeal today, and it's been referenced many times by myself. We're not to be using the leasehold interest to determine market value, that would be determined at leasehold value.
It's not gonna do it, that's why I gave you those market rents, those don't have leasehold.
Mike, if you let me finish,
Yeah.
191 Portage, or 191 Pioneer and 333 Main are effectively run as one economic unit, right?
Well, by the tenant, correct, yeah.
So you're using 333 Main Street twice over, so that's leasehold interest,
Mhm.
effectively. So you only have one comparable to use for marketplace, which is at 220 Portage, which ranges between $10.31.
And we've told you in a previous hearing that our position is 1285 is a market rent. And let me tell you where that came from, because we cut that short. What we looked at is, it had been $12 in the past. They did some leads, they got leads designation, we put it 85 cents primarily because of that. There were no other improvements done. So that's where 1285 came from in the previous file. And here we're at 1130, or 1113, or 1138 last year. We're suggesting that 12 is appropriate to change.
Given my rent analysis of 71 comparable CRUs, did you complete a rent analysis for downtown Winnipeg or for the areas surrounding downtown Winnipeg?
No, what I did though is I have no life, so I took a drive with all your comps in hand. I tried to find out how your comps stacked up against the properties we're hearing today. And I think that the buildings we're dealing with, because of lack of amenities, because of age, because of location, because of land to building ratio, for the most part, are inferior to your comps. Your comps had parking, had Tim Hortons, had UPS, had banks, so.
And yet this building had no issues with leasing up for 15 years.
Well, they wouldn't have, that's a single tenant with one of those build-outs, you're not gonna expect vacancy through that 15-year period.
That's all the questions I have.
Thank you, Mr. Poole. Marla, any questions of the appellant?
No.
Thank you. Marcel?
No.
Okay. My only question, Mr. Story, is regarding those comps on page 12.
Mhm.
So the Bell Canada, MTS, I guess.
Yep.
Is 333 Main Street is attached, but on a different roll number.
Different
building?
roll number,
Okay,
correct.
yeah.
Yeah,
And the lease rate is 1280
yes.
on that building?
Well, I've got the exact amount. That's what the market rent is. Existing, you mean, prior to this hearing? Yeah, it's at 1382. Oh, I'm sorry, 333, different property. Hang on.
I'll have a follow-up question, I missed one, but I'll wait for the.
I guess my question was,
I'll give you,
yeah, okay. You're using 12 when the same floor plate
yeah. Well,
is he's leasing for 1280, or is maybe it's more? I don't know.
Well, I did the 1284 because last year, in 2017, the 224 is to try to be more competitive.
Oh, what's
went
that,
to
what,
lease.
is this page 12? Is that an actual lease?
Oh, I'm sorry, I thought you were on.
No, page 12, your comps,
Yeah,
class
yes,
G.
it's actual lease, yes.
So it's at 1280, and it's the same floor plate, basically, same building, except a different roll number. So why do you reduce your requested rate to $12 when you got the comp sitting in the same floor plate?
Well, 191 for the previous cycle.
No, but I'm asking you,
Change.
your comps, you're showing the comp on page 12.
Yeah.
And you're showing a comp at Bell Canada with 333 Main,
333, correct.
which is the same building except separate roll number, or
Well, not the same
attached-
building, two different
attached
buildings.
Yeah,
Yeah.
but attached, and it's at 1280.
Yes.
So why are you using in your workup on page 3, $12? Wait, isn't that a good comp?
No, because that's got build-outs in it, 1280.
It's got
1280 would have build-outs.
Oh,
That's a contract rent.
okay,
So the actual rent would be less one would presume. These are actual face value. These are contracts. These are real
Okay.
leases, not market.
oh,
So we're
okay.
suggesting markets, $12, that picks up any amended, any
That's my only question,
TIs
thank
or
you.
anything.
Mr. Cole.
Just one follow-up question. I missed it in my cross-examination, I apologize. Again, this is an artist owned property, reported to the public, operated. Sophisticated property owner.
This one?
It's a
Sophisticated, yes.
property owner.
Yeah.
Can you turn to my page 13? Although the city has it classed as a B, based on our internal classification properties, and I still think it's a B. Artistry is classing it as a B.
Yes, they do in their promotional materials.
Would that not at least indicate that it should be at the high end of a B range?
No, because it's not an A building. It's not even close to an A building. You have to remember that when you start reading Cushman Wakefield at $15, those are asking rates. And these are leasing agents. This is for leasing information. And you've got to take that with a grain of salt. But I've highlighted in my I wanted you to be aware of it, that they did call that an A building a few years ago and it's stuck.
All right, fair enough.
Not 191, but 333, which we're getting to, as we're going to talk about.
Okay, any requirement for summary, Mr. Paul?
No.
Mr. Story?
No, just I would suggest 7.25 is a reasonable capitalization rate for the building. The building has not gone up, if you go from the previous year. Cycle to cycle, it went up $5 million. Very difficult to explain that to anybody, given that it's the same tenant paying the same rent in the same building with no upgrades. I respectfully submit that $12 is the market rent and $7.25 supported by Colliers and decisions by this board on other Class B buildings, I believe, is 7.25.
Okay.
Thank you very much.
Thank you, Mr. Story. Okay, that concludes 191 Pioneer. The next one is 333 Main Street. We are dealing with a 2020 realty assessment. Mr. Cole, when you're ready, please.
Okay. File number 194173. Roll number is 1209385800. Civic address is 333 Main Street. The 2020 assessment is for $30,769,000. The property is a 24-story office building built in 1983. Leasable area is 169,000 square feet with a gross area of 195,000 square feet. There is no on-site parking. On page 2, there's a subject sale history, again, 2006 bought for $1 consideration, but a sworn value was given at $26,392,000. I did not research this sale as it is too far away from the reference date to put any real weight on. Page 3 is, again, we've just discussed this again on the same comparables.
$14.96 a square foot average, weighted average $13.19, and a median of $14 for OHB properties for 71 CRUs leased up approaching the reference date in Winnipeg. Cushman Wakefield reports $15.65 for average net rent for approximately 3.5 million square feet of inventory. Page 5 is the OFB listings, asking rates and vacancies for OFB properties. Again, this one is completely occupied with the exception of about, looks to be just a little over 6,000 square feet. They're asking $17. That would be a 333 Main, which is about halfway down the set of properties. They call it the Main Pioneer building. So for a total rentable area for, just so we can touch base on that, for the total rentable area, Johnson OFB stock review is approximately 4 million square feet with a vacancy of 204,000 approximately, which equates to about 5%. So the vacancy that they're reporting is about 5%. The workup is on page 6. 169,235 square feet at $14.87 a square foot. Produces a PGI of $2,516,738. Our standard parameters apply at 9% vacancy. Gives us an effective gross income of $2,290,232. Our expenses at 2% for non-recoverable. Shortfall at $11 gives us a net operating income of $2,076,884,000. Capped at 6 3/4 gives us $30,769,000. Again, that's a review for the income summary on page 7. As it is the only income stream we have on the property, that's all there is. Similar to the other properties under appeal, on page 8 is our capitalization rate information. Downtown B buildings, total fees, we have at 6 3/4. Colliers reports between 6 1/4 and 7 1/4. CBRE reports 6 1/2 to 7, and Cushman Wakefield reports 6 1/4 to 7 3/4. The property itself is on page 10, highlighted in blue. Again, where it ran as effectively as one economic unit. Page 11 and 12 are some other photos of the property. Again, on page 13 is advertising for the property off Artist Reed's property. Again, they call it NPS Building 1 and 2. They class them as A. We have them as a upper end B. As you flow through the advertising, you can see they have on page 18 starts the income and expense questionnaire. They attach them, but they leave them blank. In lieu of that, they submit their annual income statements, which is the same as which we reviewed in other Arts Roots properties. On page 24, they're reporting a 100% occupancy of under the 6,175 square feet, and we're reporting a annual rent, or I should say a rental rate of $15.65 a square foot. So, and that's reported again on page 23, where it was $14 and now it's $15.65. And we've already touched base, so I'll reference it again just for completeness of the appeal on page 30, which is our capitalization rate information. Again, 294 Portage at 5.88% capitalization rate, and 177 Lombard, a heritage building, at basically 6.35%. So, with that, I feel $30,769,000 is reasonably assessed, and it should be maintained. I don't know what questions.
Thank you, Mr. Cole. Mr. Story, any questions?
Yeah, just 1 second, Mr. Chair.
Okay.
If you don't mind. Yes, could we just for a moment go to our page 29? Oh, I'm sorry, that's our page. That was your page.
My page 29, your page 29.
My apologies. Wrong page 29.
You didn't have a question on this page.
You don't have the rent roll? attached?
Yeah.
Or do you?
Yeah,
Where's
starting
ours?
on page 20,
Okay.
cover letter from Artist Reed.
Okay. Have you toured the site?
No, I haven't been in either one of these buildings, although I have looked at file photos.
Are you aware that Patterson Global Foods are the only other tenant other than MTS?
Yeah.
You know what they pay?
I'm not sure if I recorded it in my brief.
I couldn't find it in your brief, I
No,
apologize.
no, actually, the reason why you can find it in your brief, because, sorry, I guess I should have mentioned it, that I'm not sure if we actually received this INE twice over for both properties. So, do you have the INE?
I didn't bring
Been
it.
treated as one economic unit, so there may have been some overlap there.
So it was missed, because it's a major tenant.
Yeah.
Well, I'll just ask you whether that's what I question then. I'm going to suggest to you that Patterson's Global Foods occupy 23,160 square feet with a lease that expires in '28, and they pay $7.86 a square foot. Do you recall from your
They pay what?
$7.86?
I don't recall reviewing this.
It's in my brief, I'll go
Yeah,
through
no,
it.
I see it now.
Okay.
When was it, I noticed that you presently, getting back to this point, this was not the INE that was submitted to the property, or to the assessment and taxation department, was it not?
I don't know, we don't do the questionnaire.
My issue is, because I've run into this with other properties from Artist Reed, if you look down at your rent, or I should say your rent roll,
Mm-hmm.
you have a Monday, September 23rd, 2019 printing date, and you have effective as of the reference date as at the top of the page at April 1st, 2018. But
Correct.
so this could not have been submitted to the to assessment and taxation department.
Well, they might have submitted one based on the reads here.
And I noticed that on Artist Read on a few other properties, like we go by what's submitted to us.
Okay. So there's a rent roll that you don't have complete, perhaps, I don't know.
No, it looked, I apologize, I went too fast in both briefs. It looked like they submitted the same rent roll for both properties.
Okay. Could be.
If I'm not mistaken, give me 1 second here, I'll go through it. Yeah, that's good. Are you suggesting that a $7 rent is market?
No, I'm suggesting that's what they're paying. If I thought it was $7, we wouldn't ask for 12. You're suggesting 12. If you go back page 5 of your brief, and that's the Johnson report,
Yeah.
could you go to the very bottom of the Johnson report? And could you explain to the board and myself why 333 Main is listed there at 8770 square feet?
Second here.
Do you know anything about that?
For 333 Main on the bottom, at
Yes,
77.
very bottom, yeah.
Just what you see is the sublease.
It's a sublet. So they sublet to somebody. Is that what you're saying?
I don't have any internal knowledge of this, like I
Are you
said.
aware that Wall and East is, we're subletting at 333 from Bell Canada?
Not personally, no. Are you, this board has spoken many times, subleases are a good indication of market value.
No, it's an indication that people are leaving their space. That's a very good indication. when you sublet, means you don't need the space anymore.
Could be a business decision on it.
Well, you can make that
Somewhere
decision,
else.
you can make that assumption, whatever assumption you
But
like,
subleases
to meet
typically
your
aren't
needs,
used.
go ahead, but I'm asking for you, that's a sublet,
was-
and it's Wawanese, that's.
Yeah, but that was spoken to when we dealt with 224H, when Great West Life took over the Agricole space.
No, you
That was a
spoke, you
sublease
spoke
for
with a board
475.
member, I don't know, we
You
didn't
don't have
listen
to
that
debate
way.
it, guys.
Any
You've
question?
given us the information.
Thank you,
Move.
that's
Thank you.
all. Okay, I think I'm fine with questions.
Thank you. Marla, any questions of the assessor?
No.
Maurice?
No, Maurice,
Marcel,
no.
pardon me?
Maurice is.
Close, close,
Maurice was in the other room.
close.
Anything?
No,
Oh, okay. Okay, Mr. Poole, page 16 of your presentation. So the subject has direct underground connection to Winnipeg Square and the parking, and I guess 360 Main Street, is that right? Underground, yeah.
Yeah.
And
And
also,
through 191, there's a walkway through 191 to 333. So both buildings are
Okay.
effectively.
yeah, so the other one was just, okay. And then details, additional rent, and it's star operating expenses includes a 5% management fee. Are they recouping the 5% management fee from the tenants?
That's what it indicates.
Yeah. That's the same as the other one too, right? It's the same voucher?
Yeah.
Richard, that's management fee, that's the man collect the rent,
Okay.
change the light post.
Okay.
And that's,
a given. That's always recoverable.
and there's been no, that management fee is what has always been reviewed to as by us. It's been accounted for where we review the rent rolls, where it's typically always covered. Ourselves and Altus are not in disagreements on that. I think the terminology that separates it is more non-recoverable management costs is what they're indicating.
Okay. Yeah, okay. Just wanted clarification on that. And Marcel, I see your hand up there.
no, it's okay.
Okay,
We'll leave it alone.
okay. Sure?
I can't introduce evidence.
Okay, thank you. Okay, Mr. Story, when you're ready, please.
Thank you, Ruby. Our issues once again are market rent. Cities are suggesting $14.87, we're saying $12 is appropriate for these Class B of this nature. We think these are median or less than median Class Bs. They're primarily because of lack of parking and whatnot. So we're suggesting $12 market rent, and the assessors at 675 cap rate, we're at 7.25. One of the problems of having a single tenant is if that single tenant has any business problems or change of hearts, you can lose everybody, not just one or two floors. So there's risk in having these large single tenants. Bell, on the recent acquisition, lost 500 employees, and yesterday they announced post-reference with 85 more in the Winnipeg offices. So that's a risk of having this type of tenancy. I'm going to ask you to go to page 19 of the brief, and you'll see the decision from last year. And again, it was 7%, taking you from 6 and the city came in again at 6 3/4, and we ended up at 7%. Get the, in a moment. Check this here. Let's see. If you could just quickly go to the rent roll, that would be on page page 29 of our brief. and that would be Patterson Global Foods. You'll see that's the other tenant that was in the building. And there, it's an old dated lease from 2006. However, I think it's important to know that there are ranges of leases in this marketplace. And they're paying $7.86, and we'll be paying that till, imagine, until 2028. So there's one other tenant in the building. There's one vacant space. They show 6,700 square feet. Excuse me for just 1 second. Two pages. Go to our brief at page 49. You'll see the downtown offices at 7.25%. We think that's reasonable, particularly in light of the information that I shared a moment ago, that right now the owner and Bell are contemplating Bell moving their resources into 191 Pioneer and surrendering the lease on 333 Main. So based on the market, I also got some newspaper articles in that regard. So it's more for interest.
Can I see them first to determine if they're, should be submitted?
It's from the Free Press, and it's post-reference, but it was written on, I think, in May 9th, 2017.
Well, then we won't look at it.
Well, it's not, no, I'm sorry, it's not post-reference.
If it's
I was
post-reference.
thinking it was 218, it's 217. 217, Mr. Chair.
I'll let Mr. Poole look at it and see what he thinks.
Well, this is new evidence. Bear with me for a second so I can get.
The meat of it is on page 3, Mr. Paul. Which just talks about the
I'm gonna look at everything. Although the dating of the article is pre-reference, you should have included this in your submission. So at that point,
The article, the
I'd have to object to have it.
85, the 85 article was in yesterday's Free Press, so it wasn't gonna get in my submission.
It's the chairman panel's call on whether to allow the information that should have been submitted before the evidence deadline. It does appear that it's not post-reference, but it should have been included within the submission package.
But some of us made it ready in yesterday's Free Press.
It just speaks to cap rate, it's 0.25% cap rate. And you're about to lose a major tenant. I think it's relevant.
Yeah, but would that have been known to the marketplace at April 1st, 2008?
Absolutely, because the first transaction was in 2006. They laid off 350 people that they weren't going to lay off. And they're now talking about laying off as many as 750 more, plus 85 in particular IT department yesterday. The only one that's intact is the 365, the call center, as far as I know.
Okay, so you made a verbal presentation. We'll decide how much we're gonna put on it, Mr. Poole.
Okay.
How's that?
That's fine. I'm not with that. So,
Anything else, Mr. Story?
no, that would be my position. Thank you.
Have you given us the value you're asking for?
Yes?
No, verbally, have you given it?
Yes.
No, it's on page 3, page 5.
Okay.
Okay, very good.
21,395.
No, read it again. It's not what you're asking.
So what is the value, Mr.?
Well, I'm going to get 21,395.
21,395,000.
Page 5.
Okay. Okay, Mr. Poole, any questions?
pretty much the same as the last property. I don't really have any questions given there's lack of rental comparables, lack of information, and the same issue with it's fully leased up, yet has no parking, and it was signed a long-term lease. I really have no questions. My questions for the last property, 181 Pioneer, overlap this one.
Okay. Thank you. Carla, any questions?
No questions.
Morris doesn't have any questions either.
Mark, so, yeah. I didn't know what I was gonna say. Yeah. Okay, so, Mr. Story, two quick questions. So what's the actual lease rate on this building, 1565?
$15.75, and that's a build-out rate, that's a contract rent,
Okay,
which meant they built to suit, so you can just move in, bring your desk and came
and
in.
you're using $12 to reflect that?
$12, yeah.
All right, and last question. So you're saying that the value is diminished because of the moving out of 333 Main Street, post reference or not? Is that not increasing the value at 191 Pioneer Street?
No, they're fully leased, and they're going to consolidate by moving into 191, not taking any more space, because it's full. They're maintaining that.
Okay.
Yeah, it's a negotiated settlement, I believe, to surrender the lease at 333. And then
All right.
carry on in 191.
Any requirement for summary from either party?
No.
All right. That concludes 333 Main Street. Next one on the docket is 365 Osborne Street. And whose fault is that?
It goes to Gary, how many is that?
Sid, could you turn that off,
I
please?
thought it was, turn that twice.
He's trying,
It's got a mind of its own, that's what I was saying. Sorry.
so is mine.
Okay.
Can I make a suggestion that we stick with 275 Portage? 375 Osborne is outside of downtown, just to stick with the office buildings downtown.
I'm fine with that.
Is that right?
Well, nah, let's just do them in order. We understand the different locations, so. Let's do 365 Osborne Street. Mr. Pohl, when you're ready, please.
Okay. File number is 194180. Roll number is 1209 7637300. Address is 365 Osborne. The 2020 assessment is for £15,611,000. The building was built in 2006. It has 2 stories. There's no basement area. The gross floor area is 76,000 square feet. When we look at the property, we can flip to page 8. It is just off of Osborne Street, adjacent to the rail line. I believe that's transit off to the side. So, and McDonald's at the front, and a co-op out in front of that. So you get access to the property via the lane access off of Osborne. There's ample on-site parking, although we don't have any attributable rent to it, it is employee parking. My understanding is there is no income for the actual parking. So on page 10 is a workup, an advertising for the property on Artistry's website. And the pictures that are shown on the following pages are from that website. If we follow through, we'll just go straight into the INE on this one. It's kind of easier since we're already there. It's on the following page. Page 13, they don't report on the INE. They're giving us income statement. As you can see, the income statement shows commercial rent of a little over $1 million and a recovery of their management fees of $31,000. And a non-recoverable operating costs net the owner of $7,400. So we then would show the rent roll on page 17. They are leased up at $13.75 a square foot, and It's a 5-year term. I should say this is the 5-year term. The lease actually started in 2007, so when the building was built, or occupied, first occupied. So there is no vacant spaces in the property. When we go back to comparables, that's on page 3. These are for larger space, OFS properties. We have 445,000 square feet of inventory leased up at approximately $15.19 a square foot, weighted average of $14.73 a square foot, and a median of $14.73 a square foot. So it's a very tight range. On page 4, we applied a rental rate of $14.89 to the 76,282 square feet, which produces a potential rent of $1,135,839. Our potential rent is then reduced by vacancy of 5.5% down to $1,073,368. Our expenses are at 2% for non-recoverable at $21,467. Our shortfall's at $7 at $29,369. This produces a net operating income of $1,022,532, capped at 6.55%, gives us our $50,611,000. So I just want to point out, if we go back to the income statement that was submitted, at the very bottom, page 15, non-recoverable operating costs net to owner, that the owner has to pay $7,400 approximately. We're given an allowance of 2% on the UGI, which gives it $21,000. They're significantly under what our market projection is. So, also the PGI of what we put on it was 1.135. And the PGI is $1,440,000. So very close. Non-recoverables are actually exceeding our allowance that are under our allowance that we've given. Aside from that, it's a newer building. It's I see file photos on the interior. It's a well-maintained building. It's a nice building. We feel that about a $15 rent is appropriate. So based on my recommendation today, it's to maintain the $15,601,000.
Thank you, Mr. Cole. Mr. Story, any questions?
Yes. You indicated earlier you had not inspected the building, is that correct?
Just
But you also said that you looked at the website and you thought it was an attractive building, well maintained from the website?
Yeah, we have file photos and we have what the website's indicated on our list.
Okay. And is it well finished or is it sparsely finished? How would you describe it?
Open office, cubicle, right?
Call center.
Yeah, call center.
Minimal finish.
Headquarter type property where you have your management offices and 4 areas of road. Singularly, one CRU, a better way of putting it.
And on page 3 of your brief, you've got the subject property at, I presume that's the subject, at Comp 8, is that the subject?
Correct.
75,986 of 1375?
Correct.
And based on your experience, you did comment on some reference to non-recoverables, but go to page 16 of your brief, the appraisal fees at the top, that typically would be non-recoverable as well, correct?
16 at the top.
Yeah.
Appraisal fee wouldn't be, that wouldn't be something that we would be taking into account.
No, I'm just saying, no, in the real world, appraisal fees are non-recoverable, you understand? that?
Yeah, no, as a bottom line item, I'm well aware of that.
Okay.
But my point is, we don't know what this appraisal fee is for. Did they have an appraisal of this property? Is this appraisal fee based on tax agency's fee? What is
No,
this
it's an
appraisal
appraisal,
fee
it's an
for?
appraisal. It's there.
But all I see is the line
It's
on that.
It's an appraisal. I just wanted to make you aware that you're not capturing all of the non-recoverables in your yellow highlighter.
My yellow highlighter on the other page indicates the line item is non-recoverable operating costs, which I've confirmed with Artist Street, Lindsay Jones, that this line item is what they're indicating. That's their actual non-recoverables. to the
Is
owner.
this what you called Lindsay Jones about?
I called her indicating what their line items are and questioning what they are. So we went over a number of properties.
Is this something you typically would do, is phone the owner when you got an appeal the next day?
This wasn't just based on your particular appeals, this was based on our information for reviewing what these non-recoverables are.
And did Lindsay explain to you what the fair value account is?
I gave an email to Lindsay, she has yet to respond to it, so we have an official record. She couldn't answer all my questions, I gave it to her in an email format, I'm waiting for the follow-up from it, I have yet to receive that follow-up. My point is, regardless if you take the $4,175 combined with the $7,428, you're still half of the allowance that we're allowing at $21,467. So your non-recoverables are about 1%.
That's wrong.
Which is exactly what we broke down the 29.
Well, they're
as
not,
far as-
we're not gonna argue this here, but they're not, because it's a different, it's a public company, international accounting system. They capture non-recoverables different, they capitalize them in the asset, and it's not for this hearing. So that, but don't indicate you know something about that, I don't believe you do.
My point is we reviewed, Altus gave us their comps.
I'm not
reviewed them.
Altus, I'm not Altus.
I know, but Altus is represented prior to non-recoverable, and it's been the tax agencies combined front, that the 5% should be put back in. We reviewed Altus's information, it's 1%, and indicating clear when you actually look at the value that they're reporting, it's about 1% here too. This wasn't one of the comparables that they used, so just pointing that out.
Okay.
Thank you.
Mr. Story, anything else?
Those are my questions to Mr. Paul, correct? I'll go very quickly. 365 Osborne is a Bell MTS call center. There hasn't been any concerns expressed about staffing of that particular facility, so that lease we presume will continue on. We have two issues, as we did before. We have $12 as a reasonable market rent for the lease rate.
Is this, again, the 2018 decision?
This is 218, just to get, all we put them in for is so that, because they didn't really explain in the decision how they got the numbers.
Yes, they did.
You know, I think they say they go in the assessment departments, you know. In any case, that's why it's here. And it's $13.98 last year and 7%, so we're asking for 221, we're suggesting a $12 lease rate, between $915,384, vacancy of 5.5%, which is the model used by the city. We've asked for the 5% to be reinstated, cap rate increase from 7 to 7.25. And we're requesting an assessment of $10,691,264.
What was the last time?
Quickly,
Remaining at 690.
sort of, and the space, I should mention, if you go to page 8 of our brief, you'll see that the lease rate on Bell Canada, this call center. Start at $12.99 a square foot and steps up from 207 to 11, $12.99, 12 to 16, $13.25, 7 to 21, $13.75. So we're at the little over halfway through the step ups. And there. If you go to page 10, you'll see the model for last year and this year. And last year, this particular property wasn't listed because it's not downtown. Again, we're suggesting that Collier's 7.25% on page 25 is a reasonable indication of the market. Cap rate. And our page 22, and yeah, Mr. Chair, what I was mentioning before, if you look at the bottom of this, it says, the decision is based on the Assessment and Taxation Department's recommendation. So it didn't, unless you read that differently, it didn't give us the information, that's why we put this in as rebuttal. This is a breakdown. And that's $12,642,000. And that would be my presentation. Thank you.
Thank you. Mr. Paul.
Can you please turn to your page 3?
3?
Are you doing a leasehold contract valuation of the property, or are you doing a fee simple market approach?
Fee simple market.
Fee simple market approach.
And we believe $12 is the current market for this type of property.
So, just to contrast that against the actual leasehold interest that's in place, this was a rent that was
It's 206.
206. So these step ups
Remember
were,
the age.
these step ups are indicated on my page 17. These step ups were in place and already
206.
predetermined.
That's
so they
correct.
weren't renegotiated.
No, they're predetermined.
So
And that was the market at that time. They thought it was reasonable. This also included build-up, but very, very sparse. It's fairly, not unfinished, but it's modestly finished. It's open area.
So, can I get to your comparables on page 7?
Mm-hmm. Yeah.
Your biggest, you only have 1, 2, 3, 4 comparables, 2 in the same
Yes.
building. And you've only reviewed spaces of 1,600 square feet.
That's correct.
Up until 3,700 square feet, so
Correct.
4 very small CRUs.
Yes.
This is a relatively small sample size.
Well, this median's 1186, and we're saying $12, and that would compensate for the fact that they're smaller sizes to some degree.
Okay,
Not
but
12.
this is a 70-some-odd thousand square foot building, correct?
Yes, correct. Yeah.
You indicated, did I know of the property, what was inside of it? Obviously, it's a call center, headquarter type property. Regardless if it continued to be a call center, someone can move into it as a more of a headquarters office, meaning your open area would be your staffing areas and your...
Well, somebody can use it the way it is. Yeah.
And what I'm getting at,
There's
there's
no
not the
there's no executive offices or boardrooms, things of that nature. It's a call center. It's typical of a call center.
So,
And they're cheaper to build.
So, given the fact that I brought in 30 comparables of larger CRUs for OFS properties, there's evidence in the marketplace to bring in larger CRUs. Again, did you review the marketplace to determine whether you're...
Yeah, with due respect, and please don't be offended by this, but I put little or no weight in your comparables because I don't think they're comparable. I think it's unfortunate that you come to the board with more than 50% of the comparables are less than 5-year term. When the market, when it's buying and selling and valuing, have to get a premium to take a property off the market in a 2 or 1 year lease. Go to your page 3, And look at all the leases that are for less than 5 years. And on the other property, I didn't believe that Keniston and Grant is a comparable. So I haven't put the appropriate weight. You think that we should put in your comparables?
22 comparables of my 30 are 5 years or greater.
Okay, that's 22 or 30. It's 60%. Yeah. Why did you, can I ask as an aside, why would you use any that are 1 or 2 years? Why any? This is a distortion, it's a massive distortion.
Are you seeing the strength of a 12-year or 12-month lease is somehow the rental rate attributed to it less than the rental rate?
No, it's got to be at a premium to market because the landlord is taking his building off the market for a 1-year lease. Nobody wants a 1-year lease.
But you don't see a 1-year lease at significantly higher than a long-term lease in my comparables, what I'm showing.
I don't know what the fair market value is on these properties, but I can tell you that when you take a lease, here's a 2-year lease on Waverly, and
You know what,
I guess you got my point.
yeah,
It
we're
doesn't make
debating
any
it.
sense. to
But
use-
in all fairness, you're using 4 and 5 year leases too, so.
Not with terms of 4 and 5 years.
My point is you seem to have issues with the.
With 4 and 5, but that's, Mr. Chair, that's what the market is. The market is 5-year leases.
Well, he's provided 75% of his leases are
But why does it
5-year.
provide any that are below market, that are not necessarily reflective of market?
Okay,
We'll
weigh the
I'll make a small
evidence.
point on this.
Yeah.
I find the questioning of my robust package that I presented here today, not only with my package that I presented here today, but with all property type classes that we reviewed and turned into the office, bringing it into the market here. I don't find that tax agencies bringing in this case here, a few handful, or less than a few handfuls.
Okay, yeah, fair enough. That's your opinion, yeah,
Yeah.
that's, we'll weigh both arguments.
I think the onus is on the assessor, not on us.
That's great.
You're here to question it, don't forget that, please. It's an important issue.
Okay. All right, so,
Now it's our turn to question him, right?
yes.
Oh, yeah, sorry.
Him.
Yeah, right.
So you're
It's been a
done,
long
Mr.
day.
Paul, yeah,
You
kind
done?
of. Okay, Marla, any questions?
No.
Okay,
I do have to ask one question,
Marcel, any questions?
Mr. Chair. Sid, you brought in the appeal from last year.
Yes.
That was a recommendation by Mr. Root at that time, and you accepted it.
Okay. I don't remember, but okay, I'll accept it. If that's a question, okay.
If you look at the thing, you'll see it was a recommendation, it was a verbal recommendation by Mr. Root.
Okay, I didn't let the
And you had accepted it at the meeting, and that was at 1398 a square foot, and 12,642 with a 7 cap. If you look at the order itself and read the bottom line, you'll see that was a recommendation of the city.
Okay, I will just give me a minute to find it.
Page 26, I believe.
Okay.
My memory holds me.
Give me a minute. Oh, here, 22. Okay, so it says the decision is based on the assessment, oh yeah, recommendation, you're absolutely correct, yeah. But that doesn't tell us how they got to the recommendation.
Okay, I got no other questions.
But are you suggesting, I'm confused by the question, Mr.
You had agreed to it.
Yeah, I'm not disagreeing to it, I'm just
But
showing
you had agreed to, this recommendation is what you agreed to. That's all we agreed to is, you and Mr. Root had agreed to a number and we agreed to it. And it was his recommendation, so.
Okay.
Okay,
Yep,
okay. Okay, that concludes 365 Osborne Street, and we have to take a
Do we?
8-minute recess. These are
Sounds good to me.
what's that? Oh,
You're being called to the secretary.
Okay, call the hearing back to order. Okay, 275 Portage Avenue. Mr. Poole, would you ready, please?
Roll number, file number is 194663. Roll number is 13052150000. Civic address is 275 Portage. The 2020 assessment is for $12,510,000. The property is a downtown office building. It is 18 stories. It's built in 1974. We have an effective age of 1980, and there's 93,103 square feet of leasable area. There is no parking on the site. If you turn to my page 10, we have two pictures of the property. And page 12, another picture of the property. On page 13 are the INEs. They don't indicate a percentage of vacant space, but they do indicate that the 10th floor and the main floor is vacant, although they don't report what the areas are. And on page 14, they don't report any vacancy loss. So, the rest of it is just a summary of costs. This is a gross building. I'll kind of get to, I looked at this property in detail. We'll start at the beginning. If you turn to my page 29, there's a 2014 certificate of agreement endorsed by the municipal board, signed between, I actually wrote this one, and Mr. Story, for a value of approximately dropping from $1,850,000 to $7.5 million. It's been a long day.
Are you on page 29?
Yeah, on page 30.
Are you sure the number's not 8,150,000?
That's pretty.
Yeah, that's what it was,
thinking.
and it was dropped to 7.5.
Okay, yeah.
So on the next page is a rental rate agreed upon that increased from $10.21 to $10.68. We also have a small increase in area from 93,103 to 93,830. Combined with this was an increase in vacancy from 8% to 15%. That was reflective of the vacancy that was going on in the building. So we did a full review of this property as far as vacancy, rentals, to see what was going on. So if you turn to the next page, a couple pages over on page 33, this is the last municipal board that was actually heard between the department and Fairfax. This was heard in 2012, over 2 days, and it was heard between Mr. Michael Cortrevant and Mr. Sid Story on page 34. You may remember it, I was in attendance on this hearing. I wanted to see this particular property, as it relates to mainly with gross rents, and how they would deal with an analysis on a gross rent basis. So, well, we're not getting into gross rents today. The reference date was for April 1st, 2008, so we have a 10-year fast forward ahead. But at the point of the reference date, there was substantial vacancy in the property. That vacancy is dealt with on page 37, where the and I'll highlight 1, 2, 3, 4 paragraphs down. The assessor rejects the 25% vacancy proposed by the owner. The assessor submits that the vacancy rate, that magnitude, is reserved for buildings with chronic vacancy. These buildings are totally empty for a substantial period of time. The subject property does not qualify, but given its consistency and lengthy history of vacancy over the past several years, it does present a case for higher vacancy for buildings of similar qualities. The assessor cites 2 other Class B buildings which have vacancies of over 10%. The assessment department recommended 15%. Property owner wanted 25%. So analysis and conclusions are on page 39. We go forward to page 40. Highlighted in blue, the owner's application of average net rent for that time of $10.73 per square foot seems reasonable on the surface. So based on an April 1st, 2008, we had $10.73 being recommended by the appellant at that point in time. We know that market rents have gone steadily up since then. We go through the analysis of vacancy. The assessor, and the commentary is below, the assessor's argument on vacancy is more persuasive. The subject has consistent recent vacancy, but it does not qualify for a chronic, a condition which is reserved for the 25% vacancy. I argue it's about 20% when you start looking at chronic vacancy, and then pushing 25, you don't get about 25%. I will adjust for market up to about 15%. Anything past 15%, between 15 and 20, I'm looking at what's wrong with the property in order to create a barrier to market coming into the property. So they awarded the 15%. The reason why this is important here today, we have an established rent then at about $10.73 recommended by the town. But the vacancy is what I was really looking at. So on the following pages after this, to see how it performs, I reviewed 12 years of vacancy and how the building is performing. So I went back right from this date. Because that was happening for an April 1st date, we can now retrospectively go back and look over a number of years and say, how does that actually perform? We can now look at all that stuff because it's not post-reference for this hearing today. So for a horizon of a 10-year investment, the board awarded a 15% recommended for vacancy recommended by the assessor at that time. So if you look at page 2, this is a summary from the 12 years leading up to the reference date today, in 17, the vacancy that actually occurred in the property. So in 2006, it was 53% vacant. In 2007, it was 24% vacant. In 2008, it was 24% vacant. Hence the application or asking of the 25% chronic by the appellant, and the assessor recommending the 15%. You don't go point for point based on vacancy. You have to look at it as an investment vehicle. And at that point, the municipal board made a decision based on an April 1st, 2008, that 15% is accounting for the market. There was no chronic vacancy issues. They refused to award it. That chronic vacancy would be considering, if you look at it in, say, a 10-year horizon, that'd be 25% vacant every single year moving forward. As you can see, in 2009, it dropped to 13%. In 2010, 2. In 2011, 2. In 2018, it starts pulling back up to 18. 2013 drops to 5, 2014 at 10, and 15 at 10, 16 at 14%, and it's 17 it's sitting at 19% vacant again. So for an average, 12 years, the assessor recommended a 15% vacancy as of April 1st, 2008. For a 12-year average, it was 16.1 calculated. For 10 years, it was 14.1. 5 years leading up to the reference date, it's 11.6. And 3 years leading up to the reference date, it's a little higher at 14.3. So again, with that rent in place hovering around $11. So getting back to the analysis on the property, we're doing it on a net basis. Even though it's managed on a gross basis, we're simply applying net. Marketplace would be, we're not going with contract rent. We're not valuing the leasehold interest in the property, we're valuing the fee simple interest unencumbered by lease to determine what a market value is. So that's the appropriate method to do an assessment on, and that's what we're doing. It's an OFB, we're looking at the same comparable that we've already looked at prior. We have on page 3 and 4, again, the same exact comp sheet that we looked at for an average of $14.96 a square foot, weighted average of $13.99 and a median of 14. Cushman Wakefield for 3.5 million square feet of inventory has a $15.65 average weight. And I don't talk to this, but I should, and I apologize if I skip over it. If you look at the CBD percentage of vacancy in space, it's about 8.4%. So in tandem with that contract rent at $15 or so, you have a vacancy of about 8.5. So page number 5 is the Class B the Class 3 properties. If you go down, it shows all the vacancies that are in place. For about 4 million square feet of inventory, they calculate about 5% is vacant. And if you look at 275 Portage, which is on the list, they have about one space in there that's a little over 3,000 square feet, advertised at $13 net. So, getting to the actual workup. Is on page 6. Again, 93,103 square feet. There's a little bit of fluctuation in rent, or rentable area. I'm not changing it from 92,103, that's reasonable. We have $11.28 a square foot, which produces a potential income of $1,050,263. Our 9% vacancy, again, even though reviewing of the property, our 9% vacancy is associated with our market rent that we're putting on at $11.28. When we review the actual market, yeah, we see leading up to the reference date 13, then to 2%, 2%, 18, 5%, 10%, 10%. So our average 5 year is about 11.6. We're in at 9. That's still pretty reasonable and close. So I'm not changing the vacancy. Given the fact that we are also not putting a higher rent, if we put a higher rent on, that'd be a little bit more risk. You would then have to adjust for that, possibly an increasing of the vacancy associated with a higher rent. So, our effective gross income is $955,739. Our expenses at 2%. Non-recoverable expenses at 2%, and our shortfall at $11 for the vacant space. Gives a net operating income of $844,452, capped at 6.75%, gives us our rounded value, assessed value of $12,510,000. So, based on the analysis that we have, I feel that that is an appropriate assessment. We've reviewed the vacancy in full. We can see that even though it's not an issue today, because I can anticipate the vacancy allowance being asked for. We can see how putting a large amount of vacancy, 25% or 20%, when a building's leading up to 53%, 24%, and 24%, shouldn't really be done, because that's not a stabilized vacancy that's projected into the future. You wouldn't expect that. And in this particular case here, it gave us the opportunity to review a situation which indeed proves our point. So we should go with market vacancy for market rent to determine a market value based on a fee simple approach. All things being presented, I feel that a market value of $12,510,000 is reasonable and should be maintained today.
Thank you, Mr. Poole. Mr. Story, any questions?
Yes, have you been in the building?
Not on this one.
You've done a vacancy on your page. On your page 2, you've got a vacancy that goes back to 2006, where it was 53%. Correct?
Yep.
And are you aware that up until about 6 or 7 years ago, they were mostly government tenants in the building?
I was at the appeal, like I said, when it was.
Oh, you were there, you would know. So you know the floor plate is 5,500 per floor?
I believe your argument was the floor plate is not conducive to attracting tenants for government now based on
It's
the
inefficient.
changing of the needs of the typical government agencies.
Yeah, you can't even respond to a tender in the provincial government if you have less than 8,400 square feet, and you can't respond to a federal tender if you have less than 10,000. They have 5,500. And that's, you were saying earlier, you can't understand why there's vacancy. You've also got a piece of land.
I said that.
Yeah, you mentioned earlier, you said that if I can't understand why there's vacancy. I thought you said that, maybe you didn't. You're aware that this has a 4,000 square foot piece of land underneath it?
Yeah.
And it's 18 floors up. It's like a space needle.
Yeah, I'll give you that. The land to building ratio is basically the plan area, is the same as the land area. The land area is 5,700 square feet, the plan area is 5,200 square feet approximately.
Well, the architect says 4,400, but I'll take your word, it's small anyway.
I didn't do an engineer review, an architect review, just going on
Yeah,
what we have on record.
4,460 square feet. Okay. And then if we can just for a moment go to, go to your page 6. And you got 3 tenants there, 1, 2, 3, 4, 5, 19,903, 19,901, 19,894, and
I'm not sure what page you
the
on.
one, oh, your page 6, I'm sorry, 6.
My 6?
Yeah. Your model rents,
Oh, okay, sorry, I thought you, yeah.
and your model rents for the government agencies are $10 to $11 a square foot, is that correct?
Yep, that's what we have
Can you
included.
tell me who the government agency in that building is?
Well, that would just been our internal coding for what was there prior. I don't put much weight on whether we have a park test standard C2 or whether you have it C7. There's not gonna be that much difference. What I'm looking at is the overall PGI that we projected, which
Are you
that's
of the
why I'm doing
opinion
the
that there's
average.
government agencies in there?
No, I believe most of them were.
They're all gone, yeah.
I never
All
said.
right, I want you to be aware, Assembly of Manitoba Chiefs is not a government agency, it's funded by the government.
No. Sometimes agents get a little bit tied up on our class coding of particular premises. I don't really
I'm
do
guilty of that.
I review the actual rent associated with the space, so
Okay.
how we have internally coded for the development.
And you had some, I'm gonna ask you to turn to page 13. And if you think back to that hearing some, I don't remember what years it was.
That's a long ways back.
Yeah, but this is the same information that's been provided by the same lawyer every year on these questionnaires. So on page 13, those appear to be the expenses of operating the building and appear to be the rental rate, the income, correct?
Mhm.
Okay, so you have no problem with that. Flip it open, you said that there is no rent roll that showed vacancy. Just have a look at
I
your
never-
page 15.
I never said that. I said on page 14, highlighted in yellow, there is no vacancy loss reported. There's a rent reported on page 13 at 1.5
Well, I'm
million.
on page 15. Let's go to
But
15.
they don't actually report a vacancy loss, and on page 15, the main floor and the 10th floor, they don't actually report the spaces, the actual areas. They just.
Well,
say
every
vacant.
floor is 5,500 square feet, but the main floor is vacant and has been for over 10 years. Are you aware of that?
Yeah. I did the vacancy study, I have it recorded.
So it hasn't been vacant, it hasn't had a tenant for 10 years.
If you look at my pages, starting at, where did I go here?
Well, let's finish my page.
Well, you're
Pages
asking,
later.
we're sticking on vacancy for now, so
Okay, go to
if you
page
look at my
15.
page, just please, if you let me finish. If you look at my page 42, you're starting with the income and expense statements that have been assigned to us, and that shows you all the vacancies within the property for all the years leading back. So we have every year covered from 2006 leading up until 2017.
Okay, did you ask me to go to page 41 of your brief?
Well, you're asking about vacancy for the 10th floor. I said I reviewed it in full. So we have a detail of every INE that was sent in, the property owner didn't miss one.
But your
We have
page
every
40,
year.
your page 41 is this is the word this I think it's the wrong page. What page number?
42, starting at 42, we have
42.
2011.
Okay, so you sent these all in, and why? Why'd you do this?
Because I did a vacancy study. And if you look at page 43, we have from 7 to 12 Public Health Agency of Canada, and they're occupying the 10th floor. So,
Well, they weren't at the reference date.
well, you said it's never been occupied.
No, the main floor has not been occupied for 10 years. The last tenant was Service Canada. If you go through your brochure, so you'll find.
It indicated they left in 2011.
I thought it was 209, but it could be 211. Okay, so let's go back to the rent roll.
What page and what year are we talking about?
Page 15 is the 17.
Page 15, 217 rent roll.
Okay,
So just looking at it, and
so we'll try to keep it relevant here, shall
well,
we?
it is relevant.
Okay.
Yeah, there's vacancy on the main floor, 3,500 square feet, and there has been since 2011. I thought it was earlier than that. I thought it was 10 years. Then the second floor, you can see each, that 60,000 is a typo, it's one extra zero, I presume. If you go down to the 10th floor is vacant, and you'll see the 11th floor, we get more detail on this, has vacancy as well. But I agree with Mr. Paul that it's not specifically reported as, it's clearly you have to do a calculation to determine what it is. Okay. So, we can carry on. Are you aware who the tenants are in the building now?
As far as what the rental's been reported to us, yes.
But you have one, so you, yes, this shows the Winnipeg adult education is occupying 3 floors.
I don't look at post-reference information. I don't actively look at post-reference information.
It's not close reference, it's in the original.
Okay, you know what, Mr. Story, the assessors presented the rent roll for
Yeah, you're talking
2017, that's all he knows to answer, so
7 to
That's
if you
9.
want to present something different, then,
Yeah, no,
Yeah.
I said,
You go ahead,
does
okay.
that reflect the Winnipeg School Division?
okay.
Well, you see what I see when I pay Adult School Division.
Yeah.
So I thought you were leading into vacancy or rent roll after the reference date.
No, I'm trying to understand the reference. I don't have any more questions.
Thank you. Marla, any questions of the assessor?
I do actually, on your page 13 and subsequent expense questionnaires, makes reference to airspace rent.
Yeah, there's a bit of a cantilever out of the building over top of the.
Over the sidewalk.
Yeah, I don't know if you can pick it up in the picture, but I guess on this one
It's
here.
4 feet.
Yeah,
Yeah.
you
Oh,
kind of see
okay.
it there, so you can see the charge.
Okay, so that's the
City
charge to
charge.
the city?
Yeah, it's
And that's
not-
actually, he calls it near rate, it's actually an encroachment fee.
Okay, I was wondering, so I thought that would
Been
fall
paying it for
under an
years and
encroachment
years,
limit.
since they built.
You'll see stuff like that for skywalks, different cantilevers, different buildings. It's
Right.
not uncommon, but.
It was just an odd wording, because I would thought that would have been an encroachment fee or something.
Just a big balcony.
So it's an encroachment fee, just, okay, thank you.
Thank you. Marcel?
No, there.
Okay, thank you. Okay, Mr. Cole, quickly, have you ever, what's the net rent being paid in this building? Have you analyzed that INE or is it?
I did not go through it as far as, to analyze it on a gross basis.
Okay.
We don't do contract, but that's mainly the reason why we don't release whole. If this was at the municipal board level, as what Mr. Boardroom may go through it, but it was quite an in-depth.
Okay,
Because you would then have to go out and get gross
fair enough.
leases from comparable to better houses
yeah, fair enough.
But you have been much more in depth.
on a net basis.
Okay, Mr. Story, when you're ready, please.
Okay. I'll find out if I can. Just rework the numbers on.
Is it?
Sure.
Are you gonna rework the numbers now, Tim?
Yeah, I had before. And this is just, I don't know if you want interest only, this is the history of the building, architecture. It's an issue. Okay, let's go to the building. This is the Kensington building, it's, I think we all know the building, it was vacated by Indian and Northern Affairs many years ago and has suffered with vacancy since. I think it's about 11 years. We've taken, I'm gonna stick to that document because this is the way we've done it.
Well, you need some down?
Yeah.
One for you. Well, there is another one here. Oh, sorry. There's another one for you.
On pages 3,
So is this rebuttal to my information, or is this your
What?
information?
What's the rebuttal, Sid?
oh, it's just the, it speaks to Capwood, the fact that the building, the age of the building, and it's on a, there's no.
So what are we doing
plan.
first, your presentation or?
Yeah, but I'd like to go to the rebuttal because it's the way we've done it in the past, the way we evaluate it. And this is just a recap of the information in the IE that you referred to already, from 13 and 14. So if we go to page 3,
Of the rebuttal,
yeah,
okay?
we're just gonna cut to the quick, we'll go to the rebuttal.
Please.
Okay. So, the building is acknowledged and has been, as far as I know, and I've done it for many years, is to have, they go floors 2 to 18 with no 13, are 8,800, 5,500 a floor. And that's just the basic square footage minus the elevator shafts. That's how they've done this. And they treat the lower level at 3,500 because there's some mechanical rooms in the back. So the building itself is 91,500 for all intents and purposes, as long as I've known it. Going through, these are the actual in-place leases at December 31 of 17. And first I said vacant for 10 years, I thought it was, but it sounded like it's 8 years. So that's the lower level. And there's a problem because of the configuration of the building that some of the government tenants, when they were occupying the building, had concerns about construction. If there was any food service on the main floor, they thought the building would act like a chimney, and so they stayed away from having any food service, and there's no parking in any case. The Assembly of Manitoba Chiefs have become a big player in the building, and they've got the second floor. First Nations Health is also the Assembly of Manitoba Chiefs. You'll see the fifth is them, and they're about 40,000 square feet of the building, they're half of it, I would think. And then Winnipeg Adult Education, 7, 8, and 9, those are the classrooms, and then post-reference year they've taken the 10th as well for their administrative offices. All of the leases are offered at $20 gross, except the school boards, where you have to spend $600,000 building classrooms, and that's at $25 a square foot. To get to net rents, what we've done over the years is we've taken the gross rents, which are here, flip to page 4 of the brief, and you'll see that that's his financial statement that's provided, it's in the assessor's brief. And this shows all of the various expenses that he attributes to the property. Every year we give back, and it's even in that decision at the board. He has 2 people, Barb, who's been with him for 40 years, and Lloyd for 37 years. And their wages are there, but they also do daily, because they're government offices, they do daily janitorial. So it's a little different, it's a little more management than typical. But we take those 2 employees out because they show property management at about 5%. 76.9 is actually paid. So we have 817,000. If we go to page 1 of the brief, or the rebuttal, I'm sorry, page 2 of the rebuttal, we take the 1,856,000, which comes directly from page 3. From that we deduct the property costs, adjusted property costs, we put back the wage costs. And if you take time and read that decision, this is all referenced in there. The fact that he has staff that are full-time staff, it's not typical that off-premise management, he's got on-premise management. And he does all the leasing himself. I don't think anything's ever charged through here. He's a lawyer by profession. So you take the 817, you see what the typical expenses are. Business taxes, that's for the management office on the 3rd floor. Tenant parking, there is no parking for this building. That's really the challenge. And thank God he's got the English is a second language. He's got this Winnipeg School Division where there's no demand for the tenancies for parking. Otherwise, he couldn't accommodate them. He does have to have some administrative parking. It was on the roof of the Marlborough. Up until the school board came along, they insisted that they wouldn't go onto the roof of the Marlborough to pick up their cars. So it's now the Radisson, it's across the street. So they pay $1,900, he rents a few stalls annually across the street. Everything else, just heat, light, water, elevator, some professional fees, property taxes. Janitorial offices, 114. It's now pulled of cleaning up until recently. It was a staff, about 3 or 4 people, that did the day, because it's day janitorial. And that takes you back to page 2, and it shows a net rent of $1,139,111. I've taken the 15% as a stabilized vacancy, because that's supported by the analysis that the assessor did.
11.6, I believe, for the 5 years.
Yeah, I came up to a different number, but we'll have a look at it in a minute. So we use 15% as the vacancy stabilized, and that gives you 883. We're asking for the 5% to be back in. And this is a Class B building, and in my opinion, because of the land to building ratio, the fact that and this is something very interesting, the fact that it's on the border of but not in the shed has been expressed as a negative by people looking at renting the building. So the shed district is half of, it goes right down Smith Street, the middle, but he's outside of the shed. He's not subject to the tax incremental zone. Across the street is. So that doesn't help him with respect to 7.25. And not only does he not have parking, he doesn't have proximity parking. This is Smith and Portage, and you can go to the Dreamin' Parkade, but that's an indoor parkade. Inside parkade, people are reluctant at night to go there. So the closest parking he's got is paid parking at the Marlborough and Howard. So there's no parking. He has no amenities. There's no coffee shop. There's no UPS. There's no bank. So this, in my opinion, is going to be the highest range you're going to get of a Class B office in downtown Winnipeg, and that's 7.25% based on Collier's report. And Cushman-Wakefield, which is referenced often, there's more to that report, and I think it indicates that some of those rates they're quoting are asking rates, not in-place leases, so you have to be careful with that. So this building, he gets what he can get from the tenants. He's got to be very specific in who the tenants are. If it was a law firm, there's never been a lawyer, a doctor, or a dentist in the building, and it's been there for many, many years ago. This was Broadway Florist that burnt down, and it was built in 1974. Since 1974, there's never been a doctor, a dentist, a lawyer, other than Leo himself in the buildings for government agencies. And that's because parking and for customers and for the tenants can be difficult. So I think the 7.25 is obvious. That if there is a 7.25 Class B office building downtown, this would have to be it, I think. He's even got some small problems that have to do with this. The particular glazing he has on the windows, he can't replace it. If he gets another window broken, he's got a problem. The company that manufactured it is gorgeous. It's a reflective. It looks like a mirror on the building. That company's gone. He can't get that anymore. So issues like that. It's just an older building. It was built. He had overinsured the florist. He was a young guy, didn't understand how it all worked, and ended up with replacement cost insurance. So he had the ability to build this building. Broadway Florist was just a 1 or 2 story building on that corner. So that's a history of the building. It's in that architectural report I passed around. So I think that what we're suggesting here is using in-place leases, because there is nothing really comparable to this in terms of the challenges. The elevators are a big thing. He now has full-time security because the market's changed. but the elevators are difficult. It's an 18-story building with 3 elevators. So I think it's a 7.25 cap, and I think we should be using the actual rents and the identifiable expenses, and that would, we would arrive at an assessment of $11,246,872. Thank you.
Okay, so to confirm, we're throwing out page 3
Yes.
of your workup?
Cross it out,
Okay,
please.
thank you. And
That's
your-
why I was
your-
kinda,
Your rebuttal is actually your new workup.
yeah, and
Yeah,
that's
it's
why I
just a
was getting at
recalculation.
it.
Yeah, my apologies.
Okay.
So
All
now
right,
he's got a total number of 11,246,872.
247 round.
So,
Right.
just to be clear, that's what you're asking for,
Yeah,
this is
that's
your new workup.
We're doing, we're
You've
we're going to
changed your
actual.
position in rebuttal, it should have been in the brief.
Change which position?
Um,
Well, exactly what you said, it's very difficult to find comparable leases, gross leases.
Let's call it a revised valuation, how's that?
I think
So-
it's-
So,
It's actually higher.
Yeah.
So I'm a little, part of the rationale, and I'll get back, because we have to touch base on it, the last actual order that, the hearing that happened in 2012, for the 2000, what was it, the hearing, for basically April 1st, 2008, you were recommending a $10.73 per square foot rate on the building.
Calculated in this fashion.
Right, I'm just saying, based on the hearing,
Yeah,
page 40,
yeah.
you recommended a $10, or was wanting a $10.73 per square foot. The board did away with the rent analysis that you're suggesting, and instead went with the gross analysis based on the assessor. So the assessor went through the building on a gross basis and then went out into the marketplace to look for gross buildings.
Yeah.
Did a complete gross analysis, which is deviates from our net approach, how we're applying it today and how we principally do it everywhere, simply to try and match the building. What I'm seeing here is, and correct me if I'm wrong, we're coming up with a gross rent at $20.29.
Correct, yeah.
Then you're subtracting the
Actual
costs
expenses, yeah.
to make it reflect.
We're trying to get to actual because that, this building, that is
So
probably the only
you
way to
shouldn't,
do it.
so then you're looking at the net rent, right? When you're declaring as net rent at $11.35.
Mhm.
Okay. But shouldn't your comparables then, I'm looking for your comparables. Where are your comparables
A
coming
Class
from?
B?
Yeah,
$12.
so your comparables are on what page?
Well, in all the briefs. Oh, you're talking about the 4 or 5 that just identify with,
Yeah, I'm just kind of going
yeah,
back.
I know, I got one.
I don't see them in your brief. Maybe you have them in your brief.
In the brief, I just have it. Hang on.
But what I'm trying to get at is, in order to determine market values, be simple, unencumbered by lease, you have to have market comparables. Here you have an actual contract rent, started at a gross, and you have a net effective rent of $11.35. That's, you're doing leasehold interest then?
It's gross, it's gotta be lease fee because it's just one rent. It's $20 a square foot.
But how,
You have-
how the assessor did it is he went out and he justified it with a comparable analysis. You've not done the comparable analysis for gross buildings
No.
to see what they net out at,
I don't know what building we would use as a
Okay.
comp for this one.
so.
We're
and-
suggesting that the Class B rate should be $12 a square foot. We think that all our properties today should be
So
$12.
why are you blending the approach between gross, come to a net?
Because that's the nature of this building. This building can only be leased on a very unique property. There's no parking, not even proximity parking. You can't even go out the back door and find a parking stall. So
Parking
it's
is
got a parking
irrelevant
issue.
towards how you come up with the net
It's the
rent.
reason you
Market.
can, it's the reason that this building has suffered for all these many years. They got away with it when they had the last number of tenants in there. They had English as a second language and things of that nature that didn't require parking, bus service.
So,
That the perfect tenant is the Winnipeg School Division, adult education, who are there now.
Okay, so let me bear with this for another way of looking at it. I see no market comparables in your brief.
No, other than other Class Bs.
You come to a effective rent at $11.35.
I came to 1,008,000 less
Your
870.
net effect.
I'm not sure if that's where
Your
that
net-
came from, to be honest, I gotta check.
Let me finish. Based on your work that you just submitted to me, I've had 5 minutes to review it.
Yeah,
You have 1.8 million, 56,000.
right,
Then you take off your property costs.
Right.
Right? You come to $11.35.
so we presume is a net.
Right, but that's indicative with the vacancy inclusive in that. And then you're adding vacancy on top.
Now, 91.5 is a potential rent.
No, you would essentially come up with your effective gross income at $11.35, encompassing your vacancy and the cost of carrying that space. That's vacant. And then you're double dipping into the vacancy at 50% again on top of it, to come to your analysis, which leads you down to 11.2 million.
I disagree.
That's all the questions I have.
Thank you. Marla, any questions?
No, I don't.
Okay, thank you.
No, I've got no questions. I think Sid has answered all my questions.
Okay, thank you. Okay, my only question is, so we're, Mr. Story, we're right next to the Marlborough Hotel on the south side, right?
Right.
You got a parkade across the street
Which
from
one?
the Marlborough Hotel.
Yeah.
A drive-in parkade, what, 4 stories? You've got a vacant or a surface, huge surface lot right across from the Burton Cummings Theater.
Yeah.
Just down the block, so why is, and then you got the Radisson parking in the corner across Portage Avenue. Why is parking a problem?
Because you're across Portage Avenue. You're not proximity parking, you can't come out of your office and walk to your car. And the building itself, as it sits there, doesn't have parking. It's the same as 220.
But there is parking spaces within 1 block or half a block.
Well,
quite a
with
few
due respect,
parking
would you be happy parking at the Marlborough Hotel parking lot? I don't.
I parked at Ma's Garage.
Yeah, it's, anyway, it's,
Okay.
it's
that's
parking
my-
has always been a,
That's my only comment.
has always been a
That's my
problem.
question, okay. All right, any requirement for summary?
No.
No, other than looking at market
And
approach.
Mr. Story, you've, yeah,
I think I made my point.
yes, you have, thank you. Okay, now we go back to
Let's get this last one.
the heritage one. At 153 Lombard Avenue. Last but not least, okay. Mr. Cole, when you are ready, please.
Give me 1 second.
You must go through a lot of those yellow pens.
I do. I got color coded stuff too. Okay,
And this was the easy one, right?
Yeah, this is easy.
you never really know when you're coming to these things, if they're gonna be easy or not.
I'm being
All right,
sarcastic.
I know. File number 194177. Roll number is 1306070500. Address is 153 Lombard, commonly known as the Grain Exchange Building. 2020 assessment is for $21,704,000. Building was built in 1906, and another addition put on in 1971, I should say. Effective age, we have about between 1945 and 1971 overall. It's an older building. It is heritage building. We have a gross floor area of 356,000 square feet and a leasable area of 247,000 approximately. There is no on-site parking. If we look over to page 12, gives you a good idea of property, aerial photo of the property. Page 13, the side view, as well as 14 and 15. Shows an addition put onto the property, and 16 shows another picture of the property. So, downtown, just off of Portage and Main. This is an advertising from Artist Streets, again, portfolio on their website, for 167 Lombard. Is a secondary address, 167. The Grain Exchange Building is a 10-story Grade 2 heritage building constructed in 1906 and has been undergoing extensive 4x4 renovations since 2007. Located in the Exchange Waterfront District of downtown Winnipeg, the building is connected to the Winnipeg Square via underground retail concourse. It is on the Skywalk underground system. The Grain Exchange Building comprises of 235,000 square feet approximately leasable area, and the major tenant is a Public Works and Government Services. In 2011, a 3-story, 270-stall parkade was developed adjacent to the building. We have that under appeal as well, so we know that that building that parkade is predominantly dedicated to this property and other street portfolio. The building, back to in 2011, the parkade was developed for a building parking ratio of 1.1 stalls to 1,000 square feet of leasable area. So we do have a parking, although it is offsite, we're not valuing that. It's on a separate property. The property info itself, as you see, is as such. They class it as with the extensive renovations as a Class C. Artist Reed is a knowledgeable and sophisticated property owner. We have it as a Class D. So on the next pages is simply again off their website, showing the heritage front of the property. On page 20, again just confirms what we have. Just gives you a view of the property as you go through. Page 23 is the parkade. And the rental rates that are in at that time. The basic rent for the actual building itself is at $12. You see it highlighted in blue on page 20. We then have the available units on page 24 of the reference date. So, and you have a good set of pictures giving you a synopsis of the renovated space and the condition of it on the following pages. After review, I went through full on page 28. The renovation work, the major interior alteration permits, and again, floor by floor, CRU by CRU as it's been going along. I look back to '99, although that's a little older. Most of the value of the permits are starting at again about 2007, where it starts at 1.2, 980,000, 1.2, and leading up as you go through. The last 15 or so years leading up to the reference date, there's been approximately $10 million spent on the property.
12 million.
From 2007 onward. So if you're looking at from 1999, about 12 million approximately spent on the property. So the building has been extensively upgraded. If you look on the following pages is the income expense questionnaire that was sent out. It is again blank. Artist Reed removed that. It's filled out annual income statement. As you can see, the commercial rent highlighted in yellow is 2.6 million. Storage rent at around 150,000. Rental is as attached as well. We have the major non-recoverable expense, $412. Major recoverable expense, $48,000. And they have that as owner expense. I talked to Lindsay Jones about this. I got a little confused because they're declaring a recoverable in lieu of a non-recoverable. And this is one of the things that threw me off on the expense statement. They said that she explained to me as they go through this, they have to, from their accounting perspective, they have to declare what it is in full in that year, and they term it as such a recoverable. Now, that's what it costs, but then they take the cost out as the years go on. So you can't charge back to a tenant the full price of a upgrade, so they do it in the years following, but they do have to declare what it was in the year that they spent it, the year that it cost them. So that recoverable $48,000 is basically irrelevant to what we're dealing with today, but it does show up in our annual statement. So, getting back to how we've done it, just want to go through. It's a long rent roll, apologize. We go to the very back. They didn't include it, I'm just checking those vacancies that they reported. Bear with me. Here's they didn't have a summary page. Nope, didn't put a summary page. Usually Artist puts a summary page of the vacancy. Just looking through here. Just want to make sure it wasn't included somewhere else. No, they didn't include it, so based on our analysis, we go back to the property for OFD rents. We'll start at page 3. Okay. So now we're getting into our actual analysis for the city. Obviously, Lombard is included in, the grain exchange is included in here, 167, it makes up a large portion, comparables 22 down to 45, but there are other comparables as well. So you can see how in relationship to what they're asking at $12, they have rent ranges in between $9.75 up to $14, and they do average out to be approximately just at around $12. So the rest of the comparables for downtown for OFDs, as you can see, there's many at 11, 15, 13, 12, 12, and again include some lower quality stock at a 50, 75, just for comparison. These are what's been reported. OFDs do typically fluctuate a little bit. Their average comes in at, for 269,000 square feet of inventory, $11.40. The weighted average is at $12.70 and the median is at 11. But again, this property has been extensively renovated. We look at page 4, which is page 62 of the Johnson report. Class C buildings, they have this rated as a Class C building.
Speaking to you, what page here?
Page 4. Next page you're looking at page 3. So just after the ones. So Johnson report has this.
Oh, I see.
Johnson report has this reported as a Class C, even though we've reported it as a Class D, and Artist Reap has reported it as a Class C. There's about 33,000 square feet of vacancy in the property. We're asking $13. Information we have from Artist website is 12, so a little fluctuation there. Even if you use it as a Class D I've also highlighted below. The rent range reported is a little bit different than some retail space at $20. We exclude the $20 plus rents. The average about $11.95, $13, $10, $9, $12, $14. So we're right in range with what we're presenting today. So on page 5, with the actual spaces, page 6 and page 7, again, there are multiple series in this property. We have an average rent of $9.62 a square foot. That is under what we have advertised for this building. Again, there's most likely some spaces in it that have yet to be renovated. The majority of it seems to be renovated. So we've accounted for that in our rental rate at $9.62. We then move across to page 8, where we put in our parameters. That produces, sorry, I should speak, the actual PGI is 2,381,000 approximately. When we put on our 14% vacancy, that produces a effective gross income of 2,047,000. That 14% vacancy is our standard rate for OFDs. Expenses at 2% for non-recoverables, shortfall at 750, produces our net operating income of 1.7 million, 47,000. Capped at 8.05 gives us our 21,704,000 rounding value. So, just want to get back to. So we have a PGI projected gross income at 2,381,000. They're on my page 31, which is their income statement, page 1. They have a PGI just for the commercial space of 2.6 approximately, with another 149,000 in storage. So when you balanced all that out, they put in free rent, then they take it out, they put in their tenant reducements, which we shouldn't be taking in. You see that their actual PGI is greater than what we're putting on the property. So with what we have, I feel that our analysis of the property is reasonable. At 21,704,000, I think it's defendable and it should be maintained today.
Thank you, Mr. Pope. Mr. Story, any questions?
Yes. Page 3 of your brief, comparable number 38. That is a government services lease, right?
Yep.
76,000. And you're suggesting here the rent, the market rent is, or the lease rate is $14.54. Is that gross or net?
That was reported as net, I should say. So that's what we're using.
And are you familiar with Government of Canada rates, or leases, how they're written?
If you're asking me, have I seen the internal lease, I have not seen the internal lease. We're going off the rental that we presented.
And then flip the page to year number 5, page 5, please. And you're going to see also at
16.
78 from the bottom, you see the 74 through.
Yeah,
And there
price.
the market, the model rent, this is the first time in my history dealing with the city of Winnipeg, the model rents have been less than actual, but 882 is what the city is using here. So using 1457 on the rent comparables.
That's only one comparable, and that's what they reported.
No, that's one lease.
Yeah, I know, but that's
Okay,
what they
so
reported.
you got, so, yeah, but I'm asking a question. That's why I was asking if it's net or gross. So the 76 in your rent, just yes or no, in the 76,539 government services lease at 1454 has a model rate for your modeling of 882, is that correct?
Correct.
Okay. And there's another one, two above it, 42,871, also at 882.
That's correct.
Okay.
Notice that they're not $14 rents that we put on the property.
No. Probably not $8 rents either.
That's why you don't look at one rent in isolation. You look at it.
Well, but isn't it odd to you that your model would be at 882 and your market rent comparable is at 1450?
My point is, even if we remove those two comparables from the marketplace, it would barely change the averages. That's why you rely on a marketplace. So in case there is some outlining information that we don't know, we can't ascertain, it doesn't change the value. If we work from a tax agent perspective of grabbing two or
You know
three
that that's
rents,
half of the space. It's not a one-off. You can't.
You know what, Mr. Story, that's what he's presented and
Okay.
he's
My
standing.
point is, when we actually apply the model, we don't see a $14 rent on any of the spaces, right?
I'm looking at the government services.
For the spaces in question, I should say.
And the capitalization rates, where do you get the cap rates when you have downtown offices that are worse than a B?
Well, if you look at my page, I'm may not have included it on this one, I thought, but we've talked about it earlier. 177 Lombard, that is pretty much right across the street from this property.
Next door, yeah.
Yeah, and it had a capitalization rate calculated by myself at approximately 6.38%.
And you believe that the Heritage...
It was reported at 6.35.
Is it a Heritage building as well?
It was a heritage building.
And you
yes.
believe that that is a sale at 6% cap rate?
That's what they
after you
reported in the
generated that
sales
number.
questionnaire, and I hand calculated it to be 6.38%.
And what did you use,
Stabilized over
typical
5 years.
markets or model?
Okay, it's not in evidence here, so, okay.
So is there any, how do we know where the 8.05 came from?
That's simply our market projection from our model.
So there's nothing in here that supports that?
I've spoken to that capitalization rate
It's
on
not evidence,
numerous.
speaking to it's not evidence, okay. Okay, I'm fine.
Thanks, Mr. Story. Marla, any questions?
No.
Thank you.
I'm good, Mr.
Marcel.
Chair.
Do I have a 1-minute break before we finalize? Ms. Washington?
I'm not really,
We better not give it an opportunity.
I was
Let's
gonna,
do it.
okay.
yeah.
Go for, no, we better do a break for him. We can't, we better go to water.
I know, I was not
At
gonna
our
go.
age, it's an important call.
Okay, recess for
Sorry.
2 minutes.
just wanted to-
Go, go.
Sorry.
Okay, I'll now call the hearing back to order.
Sydney says before.
Mr. Story. When you are ready, please.
Okay, I'm just gonna.
So we've got a summary of your work up on page 3, maybe?
Yes, okay. The grain exchange building, which incidentally goes by 2 different addresses, 167 Lombard and 153 Lombard. As a matter of fact, the assessor used the actual as a goodly number of the leases. I did not think so aware of that. We're asking for an $8.50 market rent. The building has a tremendous amount of, not a tremendous, there's a lot of storage in it. Over the years, it's a bunch of catacombs and whatnot. It's an older building. So we blend the rate. The city blended the rate at $9.62. Would have to have added storage. We've used a $5 rate on storage. I'll explain that in just a minute. So we're asking for an $8.50 lease rate. The city's at $9.62, and the city is suggesting an 8.05 cap rate. We're suggesting 8.5. So very close, but we're moving on. Our position is $16,732,000 rounded, and the city's at $21,703,000. We get into page 4 and 5 is just the city workup. The next few pages, we got this extensive rent roll because there's so many properties and has to be deciphered. But I'm going to get you to go past this. This is just a storage summary. So maybe ignore that for now because it's in the rebuttal. Pages 6, 7, and 8, if we can just, I can pull them because they're changed correctly. The client gave us, had a misprint on one of the storage units. Excuse me for one moment. That's all this is. Okay, I think we got to figure that out. My apologies. Right with you there, huh? Okay. Okay.
Are you changing the numbers again, Sid?
Yes, not significantly. Just trying to figure out how best to, the numbers are the same, everything's from the same brief, it's just that there's a different types of tenancy in the property, you have to have the.
We need one more.
So we'll go to right that page 3. This is our position. There's storage space in the building. The storage is all over, some of it's free, some of it has some rates. It's all gross, I don't believe there's any that is net. We're using $5 as market for the storage.
Sorry, I have to object. Are you adding in evidence after submittal?
Everything
Page 3 is your, what are we looking at on page 3?
Page 3 is a corrected vacancy only.
You're putting market rents in. Are these contract rents? Or
Or
is
you-
it making a
you
value
ask
based on
them.
market?
This is a rent roll that shows storage, kicks out storage. It's 25,000 square feet of storage.
So this is a summary of the rent roll that's in place.
Yes. Yeah, the rent roll's 247, 421. But you've used the blended payment, we don't know how it's blended.
Okay, Mr. Story. Page 3 that you submitted with your brief, are we
Yeah.
deleting this, your workup again?
No, we're not.
I'm confused what we're looking at here.
He's just going over the vacancy.
No, I'm using, yes, I'm
The
using
spaces
that,
that
but I
are
just wanted to
storage.
do this.
So you are sticking with this, but you're
Yeah. So that's a
justifying the
summary of
850
what's in
square
the
foot.
IE.
Yeah.
Okay.
That's
Yeah.
right.
I
Okay.
think,
The
the
summary
summary,
of
when
the-
we analyze it, it comes to 884.
Okay,
And I'm suggesting 850. The office space is verified by the client. These are triple, semi-gross leases. They have a 215 reference year, so they just pay the increase. Government of Canada leases do not pay, they do not pay any repair and maintenance or capital, but they do require daily janitorial. And when the landlord works it out, it's very, very close to the amount that the city is using in their model. I thought maybe they had reported that to the city because they had the same number of 882, so we've used that for the government leases. The government is 170, is at half of the space, is Government of Canada leases. You can see them halfway down this list. And then there's a bit of, there's one tenant in the space called Bergman's, which is the former banquet hall of the Chamber of Commerce, and he pays $12 a square foot gross, and it's only because there's no demand for the space, or they would have demised it. So he's got the sixth floor at $12 in the rent roll, and I've used the $750, the shortfall rate, to come to $450 for his space. That's a retail banquet. And then George M. Young is like a test. He's the biggest, longest standing client in the building, pays $10 a square foot. And that comes to $2,172,884 a square foot. I'll ask you, if you don't mind, to just go to page 8. And page 8 are a series of leases in the building that are in that $10 range. And these are typical leases, they're not storage or anything of that nature. And if you go to the next one, this is just an analysis of the assessor had put in that that using his leases was $12.99 a square foot was the average rent in the rent. I took out the government lease because I wanted to see what it was without the government, and it drops down to $10.68. And the reason is the government lease, one we talked about earlier, is $14.54, which really not. That's a gross amount, and other than that, you have the costs. So, pass you back real quickly to page 3 in our brief. And I asked that the rent be considered a market rent of $850 a square foot. And the cap rate be 8.5%.
okay.
I'll have to object just for the record that this is introducing a new analysis for me to review on the spot.
Okay.
I'm sorry, I didn't read that.
This is a new analysis that you want for me to review on the spot. It's different from what you presented in your package. I'll simply talk to it. First of all, what you have here, is this the new rent roll?
It's a
Your package?
corrected rent roll.
Corrected rent roll.
Yeah.
Okay, so this was not submitted to the city of Winnipeg
No,
on the
not today. We just got it, we found out yesterday.
So this is not consistent with what you've submitted to the property, or for the property. I'm speaking not as.
It's what I submitted today.
Right, artistry.
We have to correct the rent roll. for the storage.
Artistry did not submit this with. to
No,
us.
no, I did this.
Right, okay, so please turn to my brief, since this is coming up, and you brought up, to my page, starting at page 33, the end of their income statement. This is the actual INE that they submitted to us. If you turn to page, since you highlighted the two, and this is indicative of every rent that they have on here that we've seen. If you turn to my page 51. For one of the tenant spaces for government works for 41,992 square feet,
Mhm.
do you see what they put on the left-hand side, office net rent?
Well, it's not, but okay.
But this is what they submitted. This is
Yes.
what we base our
Yeah.
information on. This is how we model.
Okay, no, it's not net rent.
Okay.
Government leases are
So
not
you
net.
see it's $17.08, starting in 2013.
Mhm.
This wouldn't have made it into the analysis because it started in 2013, but they're declaring a $17.08. And part of this would be in the space that has been renovated with those multiple $1 million permits, correct?
No,
So this is old, outdated space?
no, the building was rehabbed, completely rehabbed.
Right.
But the majority of the costs are in the parapets and the outside.
What I'm saying is the
exterior.
space that they have, this 41,000 square feet is good space, renovated space.
Yes, right,
extensive.
it's a heritage building.
So you would expect to get a higher than rent than the normal $10 rent, $9 rent, $11 rent for OFD spaces or OFC. They now classify it as an OFC.
D rather than C, C rather than D, yeah.
Turn to the next page,
Yeah.
page 52. Public Works, the rent for the 76,000 square foot space that is there.
Mm-hmm.
Right, left-hand side, office net, $15.33.
Renewal, correct.
Right, we actually looked at the rent, we had some internal conversation, and we reduced the rent down to $14.54.
Okay.
But you do see they're reporting $15.33 net.
But if you reviewed the lease, you'd have to know that their gross lease is not your
We
semi-gross
don't get the
leases.
leases, we get the INEs that they're submitting, and they're
Okay.
submitting their income statements, sworn to be complete, true, and accurate at $15.33. We actually did a little bit of a reduction from this rent downwards to $14 range.
Okay,
Okay, all the way through this rental, you see net. Right? Everyone, when you look through, there's a few gross offices, a few, but predominantly it's net through the.
well,
whole rental.
the only gross I'm aware of in the building is Bergman, and for the catering, because his is $12 gross, and the two leases on the government here are gross, semi-gross leases, because they're all base year taxes.
Yeah,
They
and
just
that-
paid the increase
And that's why we reduced a little bit in rent from the 1533 downwards.
of the R. So the model shows $8.82
We're doing
for
a
these
model
leases.
approach, not a
But
lease.
the model is your number, not the
We're
owner's
doing a
number.
model approach based on market rent. We're not doing a leasehold interest valuation of this property. That's why you don't see a 1454 rent. Or a matching of the rent rates. So,
But
getting
you're
back,
modeling, if you're doing the modeling the way you purport to be, you can't have $8.82 in the model and 14 in your rent comparisons that give you the value to assess the assessment.
let me be more direct. I like my questions to be answered, not with other questions. So to review in full, the rent that you submitted post-submittal for evidence, which should have been in your package, is now being allowed in.
No, you
Is
see, all
not-
that is an analysis to break out what the storage is. And the reason there's confusion is the entire basement is storage.
My point, Mr. Story, is this rent roll was not the same that was submitted to the city for our analysis, to produce our general
The
reassessment
rent roll
for
of the,
2020. This was not what was submitted to the city.
that is an analysis of the
And-
office space.
And you
Of
didn't
the,
submit it
of the,
within your
sorry, of
actual
the
rate.
storage space.
The first the city has seen of it is today, right in front of me.
The storage space, but the 271 is in the brief. There's 247, 421, that's in our brief. But you have to try to break down, look at the rent roll, you gotta try to break down what the storage is and what the office is and what the retail is. You gotta break that down because you can't pick one figure for that, which the city has done, you've blended it. So we have to try to sort out the blending.
But you know what, I'm gonna stop right here. If we look at page 5 of the assessor's modeling, there's many units that are substandard basement storage, and they're at anywhere from $3 to $8.50 a square foot, which is what you're applying to the whole building.
No, we're higher, no, we're just taking the storage at $5,
Well, I
triple
know,
net.
but-
Triple net, $5,
Okay,
none of that.
but in your
That's
workup,
high.
you're using the total square footage at $8.50 a square foot. So
Well, that's
anyway,
just-
so
that's what it averages.
I don't mean to defend the assessor, but
Yeah.
he is recognizing a lower rental rate on those storage areas. So, you know, we're dragging this out and arguing.
Yeah, but my point is, it appears that we're doing a leasehold analysis of the property without actually looking at the analysis that's submitted to the city from taking the statements, if you were truly doing that. And there are no real comparables that you're presenting for market value. I can't make any way here or there for this analysis. If you want to go to what's actually submitted to the city, sworn, true, to be used and inclusive for
That's
generating.
filed by the client, we don't file the questionnaire.
But this is what was
We
submitted.
file the,
Yeah, okay, so we understand where you're coming from, Mr. Pohl.
I'm making
Mr.
it really
Stories,
clear.
yeah, I know, we understand. He's submitted new evidence based on his analysis. You're working off what the property or the REIT submitted. And, you know, we understand.
It appears that there's been no
The
actual
situation.
review of what was actually submitted to us.
I know.
And you can see from the rent for
Okay.
commercial office,
Okay.
it's 2.6 million.
Yeah.
And you see the rent storage.
Yeah, no, point is taken, we understand.
Yeah.
Yeah, we do. Okay.
That's all the questions.
Okay,
This is an artist,
Marla?
No question.
this is an artist problem? When did they buy this one?
oh, years ago, I've been doing this since
Must have been one of the
'92, so
first
not
ones.
in the '90s, early
Must have
'90s,
been one of the first ones.
yeah. This Hamilton Bank.
Question for
Johnson-
you, Sid.
Yes, sir.
Back in 2017, when you signed an agreement with the city for $18,400,000, has something changed the value since then, or?
Of the grain exchange?
Yeah, on this building. You signed an agreement for $18,400,000 in 2017.
I don't recall, but has anything changed? Nothing has changed since 2017. There hasn't been any renovations done. I think there's been a loss of some tenancies. But no, they did build a parkade, an adjacent parkade.
Yeah.
That was a
Added
big
value.
thing. Yeah, that was big. Because the building, they couldn't get tenants, it's a huge building, they couldn't get tenants with no parking.
I know, but you had signed the agreement back in 2017. I'm just wondering if you agreed to it, probably the value of 18,406 then.
Probably, but we were, at that time, we were also going back and forth, we were using the Hamilton Bank building and the
Yeah.
Forks as cap rates, and they're 9%, so I'm not sure why we did, why we signed that, I can't recall.
Okay, good. I've got no other questions.
Thanks, Marcel. Okay, and I have no questions either, okay.
That concludes the matter.
Thank you,
Shut
sir.
it.
Okay.
Yeah.
So that concludes 153 Lombard Avenue, and that concludes our hearing today. Thank you, gentlemen, for
Thank you.
appearing.
Gentlemen, please. I'll be back.